What is that, a game show from a game show?
It's Do You Know the Way to San Jose?
Oh, okay.
As done by the Vince Guaraldi Trio.
You and I we have very differing music tastes, Julie, but I support whatever you.
All right, it is 9 o'clock here in New York City on this Wednesday morning, July 21st. Miles Udland here in studio with Brian Sozzi, Julie Hyman coming to us once again from an undisclosed location. Let's take a look at futures this morning. We got a busy day on our hands. We'll start with what we're seeing in the markets. Dow, S&P futures pointing to gains at the open. NASDAQ futures are in the red. We'll talk a little bit about the dynamics shaping markets a little bit later on in the hour. We get to today's morning brief. And on that note, we do want to talk a little bit about the 10-year yield. We take a look at what's happening with treasuries at this hour. We see 1.24% on the 10-year. And so, Sozzi, we continue to see a little bit of that rotational trade, which is going to favor the Dow and the S&P, certainly the cyclical growers, as the 10-year kind of comes off of those lows.
Tepid trade remains on Wall Street. You're seeing a little bit of nibbling after Monday's rout. Who is seeing weakness off of this 10-year? It's the banks. Financials continue to really suck wind here.
All right, so let's move it on to what we're seeing in the earnings this morning, because, of course, we're getting really into the teeth of earnings season. And we're going to talk about Chipotle first up. CFO Jack Hartung is going to join us in the next hour. Stock here, Sozzi, up 5%, set for a record open as we get towards the bell.
This is what Chipotle does. They come out and they blow away quarterly earnings results. This is now becoming a thing with the company. Same-store sales up over 30%. I liked on the earnings call last night that they suggested they have another menu price increase coming. I know you don't like that, Miles, but it's the reality of being a public company.
Well, they talked about it a little on the call, that they have all their locations open. They're starting to see some of those staff pressures be alleviated. I mentioned to Brian Nichol actually a couple months ago, maybe a complaint of sorts. That my local Chipotle, that's right. My close personal friend, Chipotle CEO Brian Nichol, that my local Chipotle was only open until 7. Mm-hmm. Now it's open until 8. So still some staffing problems, at least on the northern Jersey front for Chipotle.
You're bullish on the cauliflower rice?
The cauliflower rice is not the best thing I've ever had. That's not the best
Jack
thing I've ever had.
All right.
And because, just so the viewers know, I do have some notes on here. So let's go through a couple of them for Chipotle. Sozzi, thanks for giving me the piece of paper right before we came on air. I think the big headline from the call, or from the release, and then we'll talk about it on the call, and we'll certainly talk to Jack about this. Unit margins, restaurant level margins, highest since the third quarter of 2015. Do you remember, Brian Sozzi, what was happening for Chipotle in the third quarter of 2015?
They were selling lots of stuff.
They had an E. coli breakout
at
a number of their locations. And if you go back in time, and the thing, it's crazy to think of, how old we are now. The 5-year chart we have at Chipotle doesn't even show the problems that they came into with the E. coli situation. But I mean, that was a years-long problem for the company. It led to Brian Niccol eventually being named the CEO, and we have now come through that. And again, we can see stock's up 14% year to date, but it is set to open at a record high as we get towards the bell here. Let's also talk a little bit here about Netflix, and we're going to talk to Nat Schindler in just a second on that. But Sazi, last night, company coming out, beating on the top line, missing just a little bit on earnings. Stock little changed here. Quick takeaway from you on Netflix.
Well, they disappointed again on net additions. We set this up for traders yesterday when we talked about Netflix into earnings. I think there is also some disappointment on the street this morning just based on what I've seen, who I've talked to, on their operating margin guidance for the full year. They're going to have a very aggressive original content slate out for the balance of this year, and that stuff costs money. It costs a lot of money.
Yeah, and so again, Netflix, a name that was always in focus, still technically a member of the FANGs, though we've had that conversation, have had that conversation, and again, that stock under a little bit of pressure this morning as we get towards the opening bell. Let's talk a little bit more, Julie Hyman, about Netflix's latest quarter.
Yeah, you guys sort of talked about subscribers a little bit. I did want to mention the forecast for subscribers also seems to be short of estimates at 3.5 million. 5.9 million, give or take, is what analysts have been projecting for this current quarter. Let's talk to one such analyst. Nat Schindler is with Bank of America, and he covers the stock. And Nat, in your note reacting to the numbers, you said really the question is, what is the long-term subscriber growth trajectory for a Netflix? And did we get any sort of intel that leads us to a conclusion on that front from this quarter? Because we have had, 2 years that have been so unusual for everyone and for Netflix in particular.
No, I don't think we learned much of anything from this quarter. Actually, they beat net subscriber additions this quarter by quite a bit. 50% over their guidance. Now, last quarter, they missed by 33. Now, of course, these numbers are tiny if you look at total subscribers. And as I talked with you last quarter, these are inherently volatile numbers. You're talking about, less than 0.25% difference on their total subs was what they got this quarter. On next quarter's guidance versus the street, you're talking less than 1%. So these are very small numbers and don't really mean anything on the long haul. What you should be looking at is the sum of 2018, 2019. It's about 56 million net subscriber additions. They were very consistent, around 27 million in both those years. Last year was almost 37 million. This year, I'm now projecting around 16 million. But is that total going to be roughly the same, somewhere north of somewhere in the mid 50 millions? If that's the case, then all we did in the pandemic is move a lot of subscribers from this year into last year and get a preview of the incredible profitability and cash flow dynamics of this business.
Nat, how disappointed are you that their gaming venture at this point, just based on what they said last night, looks like a little bit of a sideshow for them, not a real core business?
Yeah, I was never expecting much here. Gaming is a highly competitive business and is very difficult to break into. They have some IP that they would like to have games built off of. They've already been doing this. There's nothing all that spectacular about what they sound like they're doing. It sounds like their ambitions are pretty light, at least for now. I think it's rather telling that the last several times they've mentioned gaming, they say, oh, we're all including this quarter. They said, oh, we're already in gaming. We made Bandersnatch, which I think the guys at Activision making Call of Duty might have a little stretch on, say, as a stretch on the term of gaming. That's a choose your own adventure book. And it's fascinating IP, but it isn't really what we think of as really high-end gaming.
Now I'm curious, it's Miles here, and thanks for jumping on again. I'm curious how you're thinking about their share of viewership, right? The way they framed it with, they only have 7% of the whole bucket from that Nielsen survey that they had in their letter. And I'm just, curious what you think maybe the team at Netflix is thinking about that long-term opportunity and how that, maybe plays into your model, if it does at all here.
Well, I think this is the real story, and it's been the real story for years, is and I think people have vastly overplayed the impact of Disney Plus and Amazon Prime and all the other streaming services, because in the end, what's really important is, can you take share away from cable and linear TV? And they have been doing that at a rapid pace. I do not see all these other streaming services as direct competition. They are obviously competition for time, but people will subscribe to multiple because they will go where the content is. And where the content isn't going to be is on cable.
Nat, what do you think is the biggest risk for Netflix at this point?
I mean, I think the risk here is the one you didn't learn anything about in this quarter, or really this year, is that did the pandemic swing forward so many people that we really hit that second inflection point on the S curve of penetration, where we're really completely, saturated in many of their core markets. I don't believe that's the case. I believe there's 800 million cable subscribers globally, cable and pay TV subscribers globally, and they're sitting at 200 million, and they have better content, so they should be able to continue to eat away at that share. But we didn't learn anything one way or the other on whether or not that's the case. If you looked in their UCAN, or United States and Canada region, they were down in 2Q of this year. That's actually not surprising. They were down in 2019 in UCAN, and they will be in almost every Q2 going forward. Last year, 2020 was the exception with the pandemic, but that should be expected simply because this is a low gross sub ad quarter. And you're churning off a larger and larger base each year. But the question is, are we done? Have we gotten to as far as it's going to go? And you're not going to answer that question yet.
Now, we have a graphic here showing just how many streaming services there are. I'm looking at it, right? It's Discovery Plus. I mean, in the numbers, it's almost getting out of hand. Discovery Plus, Apple TV Plus, Paramount Plus, CNN Plus looks like they'll launch in 2022. When is the shakeout going to happen? Do we need all of these streaming services?
Well, it's not all that expensive to create a streaming service. What's expensive is creating the content. And a lot of these guys are repurposing content that they already have. In the end, what matters to consumers is really new original content that they really want to see. And it's going to be very hard for virtually anyone to compete with the budgets that Netflix and Disney and Amazon have put together. So those will be the core. Will you subscribe to Peacock because you want to see that next Star Trek? Maybe, but you're probably not going to keep it on all the time. Or similar to HBO, which is and Max and others that are doing far fewer total shows. Netflix is going for that idea that you can have it as a subscriber permanently because there's always something new to watch.
On that front, Nat, before we let you go, favorite Netflix show right now?
I'm going to say Fauda just because it will make me sound intelligent and thoughtful because it's something I quite frankly haven't actually seen it. But I'm going to say that. That makes me sound really intelligent.
All right, there you go. Very intelligent, incisive analyst, Nat Schindler. Nat, I always appreciate the time. Nat Schindler with Bank of America, covering Netflix. Nat, we'll talk to you soon.
Thank you.
All right, Delta variant concerns continue. Coming up, we're going to hear from the CFO of Johnson & Johnson about a new study involving the company's COVID-19 vaccine. Back with more on that coming up right after this.
Shares of Johnson & Johnson are trading slightly higher in pre-market trading after the company came out with numbers and also raised its profit forecast for the full year. Our Adam Shapiro had a chance to talk to the company's chief financial officer. He is here with us now. Good morning, Adam.
Hey, Julie. Yeah, J&J had a pretty good quarter. I mean, they're beating on all cylinders. The sales were up to $23.3 billion, and that's up 27.1% compared to second quarter of 2020. That's to be expected. Medical devices has recovered, but there's a lot of questions about what's going to happen with the COVID-19 vaccine. So here's what Joe Wolk told us.
What I would say is, the results across Johnson & Johnson is, at least during my tenure as CFO, I don't know that we've ever been in a healthier position. All segments are really clicking on all cylinders. You've mentioned medical devices. So we knew coming into the quarter, it was going to be strong, right? The comps were going to be favorable to Q2 of last year when elective procedures were essentially shut down. But you look at the underlying business and you compare it to, let's say, a more normal quarter of Q2 2019, that business is up 7%. Pharmaceuticals is up 17% and consumers up 6% versus that same time horizon. In medical devices specifically, in addition to the favorable comps, we're seeing just better execution. We are leading in some market share where we were already leaders. We're taking share where we weren't leaders. And we just have a much better level of cadence of innovation coming out. So we've got 17 new product launches in that segment, on pace to have 25 this year. And over the last 2 years, it's been closer to above 30. So we're in very good shape. Ashley McAvoy and her team have done a great job. And we're seeing great growth where we've placed investments, specifically in areas like Asia Pacific, as well as here in the US.
You brought up pharmaceuticals, $12.59 billion in the quarter. Infectious diseases, which includes the COVID vaccine, $1 billion. But in your guidance, and we should point out, you raised full year guidance, $90 billion to $90.8 billion. But if you include the COVID-19 vaccine that J&J has, $92.5 billion to $93.3 billion. You're really expecting demand for the vaccine to increase, aren't you?
We know, it's not only an expectation, it's almost a certainty, quite frankly, given the advanced purchase agreements that we have around the world. There is a lot of people who see benefit with the one shot. Certainly, we had very strong data published in the New England Journal of Medicine a few weeks ago that was peer reviewed, indicating that the durability is at least 8 months, better than other vaccines that are out there. And it really is taking on all variants, inclusive of the new Delta variant.
When we talk about the vaccine, you talked about peer review. There's a study which has not been peer reviewed that says your vaccine might require a booster shot. We should point out Pfizer's vaccine, they've said they're going to want people to get a booster shot. Where does J&J stand on that?
Yeah, so, we saw the study last night as well, Adam. I think we all have to be just a little bit cautious on a test tube study that looks at one element of protection. The data that I just referenced really looks at neutralizing antibodies as well as T cell activity for complete immunity protection. We know that that's very solid data, again, peer reviewed, as you noted. And I think it's really the responsible act to rely on health officials who have all the data at their fingertips to determine when and if boosters are needed for any of the vaccines. At this point, they haven't done that yet.
I want to switch gears when we move from the vaccine to other issues. There are the reports which are not confirmed that you're looking at perhaps spinning off the talcum powder and affiliated talc products into a separate business, then put that new entity into bankruptcy as a way to deal with, I think Reuters was the entity that broke the story, something like 30,000 plaintiffs. How do you protect the balance sheet, the company, the world's third largest pharmaceutical company, from lawsuits, whether they have merit or not, from constant litigation?
Yeah, so let's speak specifically about the talc. We're going to continue to defend the safety of that product based on decades of independent research by some of the best institutions in the world that prove that product was safe. With respect to the current Reuters report, we can only speculate that now attorneys are speculating about our legal strategies. They're probably somewhat frustrated with the Daubert ruling hearing of last year, where much of the so-called expert testimony from the plaintiff's attorneys that was being offered in these suits it has been barred from being presented, as well as experts themselves. So, we're going to continue to defend based on the safety record and let science dictate.
And it's not been announced yet, but a lot of news organizations reporting a potential opioid settlement. This would certainly remove a cloud from the balance sheet, would it not? Can you share with us when this might be coming down the pike?
Yeah, so obviously there's a number of parties involved in that. Adam, it's really been 2 years now that we've been on record saying that we've offered a settlement, we've reserved for it fully. So we'd like to see that come to conclusion in short order, but it is a complicated process, and we'll let that play out. But it's really not new news from a Johnson & Johnson perspective. We've certainly communicated this with the investment community and more broadly in hopes of finding a settlement.
And Julie, once again, one of the reasons you saw shares slightly higher right now is their full year guidance now, sales being anywhere between 90 billion and 90.8 billion. But when you add in sales of the COVID-19 vaccine, that's going to be at the higher end, 93.3 billion. So Johnson & Johnson, the pandemic, certainly not behind all of us. But as we talked about in the interview with Joe Wolk, perhaps the worst of it is behind us. Julie?
Yeah, and Adam, just to put a fine point on what you were just saying, obviously the COVID-19 is important. The vaccine is important for Johnson & Johnson, just as it is for Pfizer, but it is an enormous company. So it's important for revenue sort of more at the margin than anything else. This is not a game-changing product for the company.
No, the biggest driver within the pharmaceutical unit is oncology pharmaceuticals. So, and we talked about that. Their research and development is really based in the cancer-fighting drugs. But the COVID-19 vaccine, which, by the way, the CDC says has about a 66% efficacy against COVID-19, it is not the financial driver.
Right. Adam, great to see you. Thanks for being with us here this morning and bringing us that interview. We're going to take a quick break. When we come back, we've got more earnings to run down for you, as well as the opening bell. Stay with us. Okay. Am I on cam at the top of this? Okay.
All All right, welcome back to Yahoo Finance Live on this Wednesday morning. About 5 minutes out from the opening bell as we get second quarter earnings season really ramping up here. A couple of big names to run through. Brian Sazzi, let's start with what we saw from Coca-Cola out last night. The company coming out beating on its top line, beating on its bottom line. I think a theme we're going to see a lot as we get into second quarter earnings season, much like we saw in the first quarter. But Coke continuing to really see a nice turnaround globally, given the company's breadth.
Yeah, it's definitely a different quarter for Coca-Cola compared to the first quarter. And then, of course, the quarter this time last year, it's just a different company as more people go back to sporting events, restaurants. Those are key businesses for Coca-Cola. Those away from home categories could represent more than 40% of their business in most cases. But I think why you're seeing the stock up here in the pre-market, up about 3%, they came out and they raised their guidance. So for this year, they're looking for organic revenue growth of 12 to 14%. That is pretty good. They were looking for about a high single-digit increase before. They also raised their earnings outlook for the year as well. And for them, I think they're just sending a message that we're starting to see restaurants come back. We're starting to see sporting events coming back. People are still buying lots of food for their home, and they're trying to bake that into their guidance. I will note this, too. If there is concern here, they mentioned twice in asynchronous global recovery. They mentioned it twice, and I think that could be them saying, you know what, we are seeing the COVID Delta variant impact certain locations overseas. Let's just be a little cautious here.
All right, asynchrony, a new theme for second quarter earnings as we get into the heart of it here. Also, the company's CEO, Jim Quincy, on another competitor network, let's say, saying that volumes for the business, he said, just a, quote, whisker shy of 2019 levels. And of course, for so many businesses, as we were just discussing with Netflix and others, 2019, really the benchmark here, and seeing a lot more companies just come out and give us the comp instead of making everybody back into what that 2-year stack might look like. Let's go over to another major airline. So we've seen so far Delta with its results out. Southwest has come out with its results. Now United out here, company losing, as we see here on the bottom line, $434 million in the quarter. But Julie Hyman talking about profitability in the third and fourth quarter.
Yeah, and that, it seems like, is leading investors to overlook the fact that the loss was a bit worse than estimated last quarter. So the promises of these profits in the future. And by the way, it's adjusted pre-tax profit. So just to make that clear, that's what the company is predicting, not just net profit flat out. It's adjusted pre-tax profit. But CEO Scott Kirby of United did say that this was a turning point for the company. What's also interesting here is that this is happening even as we're seeing fuel prices go higher. The company said cost per gallon of fuel was up 67% in the second quarter. So that's something to keep an eye on going forward, even as demand increases, what's going to happen with the cost for these airlines. Another note here is capacity, right? One of the things that we are also going to be watching as travel comes back, as the airlines start to recover, are they going to be able to have capacity discipline here? In other words, are they going to react to this return in demand by just adding lots and lots of flights and thereby diminishing their profitability? That it's too early to talk about that, but it's something to look ahead to. And the company said it's going to fly 74% of its 2019 level capacity in the third quarter. So again, promising sign at this point when you look at those capacity numbers.
Yeah, and again, we're seeing the stock up this morning, but I think just to maybe put in context the damage that's been done to the airline industry from a stock market perspective, again, a financial perspective through the pandemic. At 46 and some change, 47, let's call it, in pre-market, the stock's at its highs that it hit in 2007, ahead of the financial crisis. If you look at the recovery from that, the stock is back to 2014 levels. Now, shares were lower than 47 when you had really the price of oil collapsing and all kinds of problems with the global economy, following from that, 15, 16. But again, this is a stock that was trading in the hundreds ahead, or, let's call it high 80s, 90s into and towards $100 per share ahead of the pandemic. So here at 47, it's had a very nice recovery off of its lows. We have seen the airlines become a big part of a recovery trade. We have seen that really, Sazzi, be a favorite of retail investors. But I think that when you see this action, it is worth keeping in context the damage that's been done to long-term United shareholders.
Is that a head and shoulders pattern?
Doesn't look like a head and shoulders to me, but we'll check in with Jared Blickery in the next. We'll go through. We really should do a little more of the technical. Like, what are the ones we look for? Head and shoulders, cup and handle.
I like the cup and
handle is really my favorite pattern that the technicians like to bring in. So again, we're about 30 seconds out from the opening bell here on this Wednesday. We're looking at a mixed open. Dow and S&P futures are pointing to gains as we get into today's session. NASDAQ futures are the laggard. This coming off a big rally in yesterday's session, really accentuated by what we saw in the small caps, value names. The Russell 2000 yesterday gaining almost 3%. That as the 10-year yield came back up, about 7 or 8 basis points or so. And there we see live pictures from the floor of the New York Stock Exchange. This Wednesday of trading officially open for business. And again, we'll check in with Jared Blickery in a few minutes here as we get through today's opening bell. Let's talk a little bit, Brian Sozzi, about our still parent company for now, though pending sale of our part of the business. That, of course, Verizon, out with a better than expected quarter, as we've seen from a lot of companies. And postpaid, like people actually signing up for cell phones, seem to be a big driver for Verizon. And in fairness to us, we are but a small, tiny speck on the Verizon enterprise.
I'll get to that in a second, but I think the Verizon quarter here strengthened, I would say, versus the first quarter. Ultimately, I would say a bullish tell on the potential quarter coming from an Apple. This is a 5G supercycle. We're in it. Your friend Dan Ives is always promoting the 5G supercycle theory. I think you saw that in this quarter. And you noted media. Got to give our team a shout out here. Verizon Media, $2.1 billion in sales in the quarter, up 50% year over year, up 13% from the second quarter of 2019. Of course, just a better run business, but also ad spending has come back very aggressively. You've seen the BuzzFeed IPO. That's about to happen. You've seen the Discovery AT&T deal happening. Lots happening in the media space.
Yay, us. I also wanted to mention one more thing when it comes to those postpaid ads. Verizon, in part, got that improvement in subscribers by paying for them effectively, by offering promotions. So after that miss in the first quarter on those postpaid subscriber additions, the company decided to get promotional, offering as much as $1,000 to customers for trade-ins. Also, kind of offered some various promotions in order to get people to sign up for 5G service in particular. So that's something to keep in mind, too, that Verizon has these levers that it can pull when it does need to try to juice some of that subscriber growth. And again, to Brian's point, we'll see how the Apple growth ends up also juicing the numbers.
Just exciting, right, to be part of a fast-growing unit as we look for a potential parental change here in the coming. I don't know. I guess more people are paying attention to this, and they're seeing the three of us and like, oh, do we want to invest in these guys? Do we like them? Do we not like them?
They like us.
Right? This is great. This is great. Everybody's happy. All right, let's quickly talk about Harley Davidson coming out with its latest quarter as well on this busy morning. And Brian Sozzi, I know you're a recent buyer of a car. Did you also buy a motorcycle? Because their sales doubled in the most recent quarter.
No motorcycle.
On motorcycles, obviously, we see the revenue not quite that.
No motorcycles for me. I will leave that up to our producer Nick Monty, who is a big Harley Davidson fan here. But North America retail sales, like you mentioned, up 43% year over year, but up 5% versus second quarter of 2019. I love these 2019 comparisons. I am surprised to see the stock down a little bit here. If anything, I would point to overseas weakness. This remains a company very much in transition with a new CEO. They're pulling back on some European markets here, so maybe some concern on the street if they can sustain what they are seeing here in the U.S., modest recovery, and not really just fall off a cliff overseas.
Guys, just like I'm really curious to see how the Ford F-150 electric version goes, the Lightning goes, I'm really curious to see how Harley is going to do with its new suite of electric bikes, a company that is traditionally known for the sound of a Harley, right? That is pretty distinctive. And for people on Harleys who give the little sign to each other when they drive by each other, what's going to happen when these new electric bikes sort of join the club, so to speak? And there are a couple of new ones, right? The Livewire 120, which is an electric bike, the Sportster S, which is a lightweight bike as well. So, those are two new bikes. I don't know if both of them are electric. But in any case, We'll see how those electric ones do. What were you going to say, Brian?
No, the LiveWire, Julie, they released it about a year and a half ago. It is an expensive bike. It's a race bike. If you hop on it, it will rip all of our faces off. I mean, it is a race bike, and that's why it hasn't sold very well. They have to come out, I think, with more approachable electric bikes that actual human beings could drive, and the LiveWire is ultimately not for us.
I guess my question is, can you get the same kind of muffler tone on an electric bike? Like, can you announce your presence rolling down the street on a couple of Harleys, but it's not gas powered? There's got to be technology.
It would have to be fake. It would have to be,
Yeah.
I mean, it wouldn't.
That's fine.
It would, yeah.
But there's got to be
Grow the Harley mustache, get the bike, and let us know and report back.
There's got to be. Yeah, I'm not growing a mustache over here. There's got to be a way to make that work because that seems from a distance that seems the appeal. Hands up, hands up. You kick the thing. Take the Instagram photo with the other guy. You're sitting you got your feet up high. It's a whole. Yeah, it's a whole.
Broing
thing.
out.
I'm not sure it's a bro vibe, but definitely mostly men. So anyway, all right, let's get out of here. On the other side, Jared Blicker is going to join us live from the floor of the New York Stock Exchange for a closer look at today's action. Back with that coming up right after this.
Well, the Dow starts the day up about 0.5%, and that means, as Jared Blicker just told me in the break, that we have recouped the losses from Monday. He's got lots more intel for us from the floor of the New York Stock Exchange. Jared?
That's right. I was just looking at the Dow. It has climbed back to Friday's close, so that is called filling the gap. It gapped down yesterday. So now it's like it never happened, right? Everything clear. We got the signal, by the way, yesterday. I was speculating it could be a bottom yesterday morning or Thursday afternoon, and that was based on the bond market and bonds getting bought with the yields going down. They got a little bit too far down, and so they're just bouncing back right now. What does that mean for the future? Probably get back to those record highs. It's not a far distance for the Dow, the NASDAQ, and the S&P 500 From there, what happens? Well, I think we've seen some of the signs of an emergence of a rotation back into value and cyclicals. So if we see any tech weakness, and we're going to get a lot of earnings reports with respect to tech, we might see some of the mega caps fall off a bit, might see the general market go down, but if we do continue to see that stealth rotation, that just sets up another huge bull leg for the next few weeks. So we get through earnings season, especially those big tech earnings, without a major disaster. I think we could have a nice resurgence of that value and cyclical trade. We'd see that in the financials, the industrials, and also the energy market. Now I'm watching the energy market because crude didn't really rebound that much yesterday. Energy was really lagging. If we get the participation of energy, that's a sign that my theory is on track here.
Now, Jared, we're also seeing a bounce this morning over in the crypto complex. Bitcoin back above 30,000 yesterday. That concerning break below didn't really seem to stick around. But what are you seeing in the setup for Bitcoin here?
Yeah, I wish I had a chart, but I'll tell you what. There was a really interesting price action when between 29,500, as soon as that was hit, in 30,000. So we saw the buyers come in at 29.5, the sellers come in at 30. Now we're popping up to 32. 32 is a big, big level. I think if we pass 32, that could be the all clear, but really not safe until we pass 35. But we keep seeing signs of life in Bitcoin, and yet it keeps trading in a range. And Brian Shannon of Alpha Trends, friend of the show, he likes to say, if they don't scare you out, they wear you out. And that could be what's happening here.
There's also today, I believe, a conference that's going on where Jack Dorsey, Elon Musk, and Cathie Wood are apparently going to be in conversation. So I imagine there could be some potential catalyst from not just that conversation, but that conference going on all day long.
Yeah, we know Jack is involved in crypto in a big way, especially with Square, not so much Twitter, of course. You add Cathie Wood to the mix, that could be some, could generate some interesting headlines there. And yes, I would love to be a fly on the wall. Hey, I think price always precedes narrative, and so we'll get the story after the fact, and we'll know if the accumulation has taken place by the price action looking in the rearview mirror. But yeah, I'll be watching out for those headlines. So thanks for the heads up, Julie.
Should be cool. Thanks so much, Jared. Appreciate it. Well, coming up next, we will get the latest from inside Miles Udland's brain, i.e. the morning brief. Stay with us.
Charger.
The reflation trade was the subject once again of Miles Udland's morning brief. This is something we've talked about a lot, of course. And as we've seen the zigzag over the past couple of days, Miles, what was interesting on Monday, even as we were seeing the sell-off, you were watching a few key stocks that were higher, Peloton, Wayfair, among them. And so you were looking at what was going on through sort of that micro lens. But in this morning's morning brief, you zoom out and look at a different kind of chart that applies a more macro lens to all of this.
Yeah, and this data comes to us, or this chart comes to us from Capital Economics. And really what it does is it breaks down three distinct components of the rally, or just of this market moment. And so it's a little bit involved here, but what we are looking at in the purple line is the NASDAQ's performance relative to the Russell 2000. So big cap, tech growth stocks against smaller cap, more value and cyclical focused stocks. And what we saw, in the beginning of this chart, during the beginning of the pandemic, was that growth outperformed. Everybody knows that story. Tech was the leader. A lot of those names are stay-at-home focused. They're also just, as you would say, secular growers, businesses that are expected to grow, let's call it double-digit rates, even in an economic environment where things aren't growing that quickly. Now, the decline in that ratio, the decline in the purple line, is the Russell starting to outperform. That's smaller caps, value, cyclically focused stocks that do better when the economy does better, having outperformance relative to, your big cap FANG names. So think about it quite simply. Local regional bank, they make money extending loans to households and businesses. They do better when the economy does better. Relative to Facebook, which is, probably just going to grow 15% forever as they continue to take over the world, right? So you have a relative preference in a high growth environment to a regional bank over Facebook. So that's the decline. And then we've seen that trade come back. FANG, we've talked a lot in the last month about FANG's leadership within the market. A lot of questions about the growth cycle. What does it look like on the other side of COVID? How much longer can this go? That's, a reversal of sorts in the confidence investors had about the reflation trade. And then the blue line that follows that line is just the 10-year, right? 10-year, you can think about it. You can decompose the 10-year yield in a lot of different ways. Brian Chung can come tell us about how it's really the geometric average of expected 3-month yields rather, over the next 10 years. And, he can tell us what that exactly means. Or you can say, as I like to, and it's an imperfect thing, but the 10 years basically expected economic growth, at any point in the cycle. So a slight oversimplification, of course, but as we saw the 10-year move higher in the beginning part of this year, that's essentially investors saying, we think the economy will grow faster. The 10-year coming in, it's done that for a number of reasons of late, but a part of that story is that there's less confidence, guys, that the economy is going to grow as robustly as we get through the pandemic as perhaps we thought, really in that March and April timeframe. We're talking about trillions in infrastructure spending, more fiscal, let's call it a looser fiscal stance maybe, and also easy monetary policy. Questions about all those trends have come up, and so we've seen, some of the heat come off that trade a little.
Well, Miles, if we do in fact get that second half growth slowdown, could these stocks reflate?
Well, I think the thing to always remember with markets is that that's what's been priced in now. Mm-hmm. So what we're seeing now is in anticipation of the reflation trade coming off in anticipation of slower growth in the second half of this year. I think what this week maybe is serving as the nadir, perhaps, of the reflation trade and a realization that, okay, the Delta variant is very serious. Maybe the second half of this year isn't quite as strong as we thought, but we are not going to see 2020 situations here in the U.S., at least in 2021. And so while there's a reason to, as strategists like to say, re-rate the trade, maybe there's not a whole reason to bail out of it wholesale. And so that's why, and as Capital Economics notes in their commentary on this, we've seen about half of the move retraced. So let's call it investors are half as confident in the economic recovery as they were a few months ago, but they haven't, fully lost their nerve on that.
What I'm curious about too is sort of where's equilibrium on this? I mean, markets do tend to have these sort of seesaw-y kind of movements, right? When they're trying to, when we're sort of in this uncertain environment like right now, which is really most of the time if you think about it, I guess. Mm-hmm. But so maybe we're already in equilibrium, right? Maybe what you're describing, this sort of seeking of an answer on these questions about reopening and on economic growth is already equilibrium, and where we are right now, where these two groups are sort of switching back and forth between what's in favor.
Yeah, and you know, something that I didn't, and look, the morning brief, it's only supposed to be a couple hundred words, right? I'm not going to get into it every day. Well, I like chatting about it, right? Because I could talk about the things I didn't put in there. One of which was this idea, you know, Julie, as you talk about, this is like I would call this a descriptive chart, right? We are describing the market as it has happened. I don't think any of this conversation is particularly prescriptive, right? Here's what will happen next. None of these trends specifically augur towards any outcome in any of these asset classes, but I think it is important during these more volatile moments to find really clear descriptive ways to say what has happened, how has the market acted, you know, and to kind of your point, be able to say, okay, here's the lay of the land. We can all guess at what happens next, and you know, we are not paid to make a bet, right, on what happens next. That's for the folks who come on, the strategists who come on this program. That's their job. But I think this was a nice entry point into being, you know, pretty clear about here's how things have gone, and these are the trends that are interacting with one another on a daily basis.
Miles, new Slack message from our very own Brian Chung, loyal viewer of the program. He said, "You're overpromising, I guess I would suppose, on his ability to analyze geometric shapes," whatever you just mentioned before.
Well, I just know there's a difference between the average and the geometric average. But I don't know what it is. It's just different.
Yeah.
Well, he's going to be here in the next hour.
That's what I've heard, yeah.
You know, challenge accepted, and we'll see what he has to say on the geometry lesson.
He has a master's. I don't have a master's degree. So that's what we signed him up for.
Then obviously he'll be able to do this. We're going to take a quick break. When we come back, we are going to get the benefit of intel from Brian Sozzi on what's going on in the hotel industry as we get a mid-year state of the industry.
All right. Day one. We talked earlier about the recovery in the airline business. Brian Sozzi got his eye this morning on the recovery in the hotel industry as well. Saz.
Yeah, right, Miles. I am here with your daily dose of depressing data, and this we're locking and loading on the hotel industry. And this data comes compliments of the American Hotel and Lodging Association looking at the outlook for hotel jobs. And they're saying 1 in 5 hotel jobs won't return by the end of 2021. So there you see 2021 here in this purple bar chart here. By the end of this year, the hotel industry is said to or potentially directly employ 1.86 million people. Okay, it's great that they have jobs, but look where it was pre-pandemic, 2.34 million jobs. So the association is saying that 500,000 jobs or so will not return this year, despite the recovery in the lodging industry. Why is this happening? Of course, a lot of competition for labor out there. A lot of these workers may have taken retail jobs, construction jobs, you name it. They just don't want to work in hotels. And then also, too, the association coming out with occupancy. They're looking at the potential for occupancy to recover as the global economy recovers. Occupancy is only supposed to come back to about 55.9% levels, average annual levels of hotel occupancy. Still not good. In a perfect world, you want 100%. You want all of your hotels stocked out with human beings. But that is only supposed to be 55.9% in 2021. Again, still below pre-pandemic levels of 66% in 2019. And then ultimately, occupancy lends itself to hotel room revenue. The Lodging Association is still looking, or they're looking at about $125.3 billion in room revenue this year, up versus the depressed $85.5 billion last year. But again, still well below 2019 levels and 2018 levels. And I think this is why you're still seeing a lot of the lodging stocks, a Marriott, a Hilton, a Choice Hotels, trade a little cautiously. There is concern on if these hotels are able to continue their recovery this year and into next year. Ultimately, last week I caught up with Marriott's CEO, and we talked. Tony Capuano talked about the company's outlook for this year, but also, can he get enough workers to just satisfy the demand they're seeing back in the hotels? Here's what he said.
Well, the good news is this is a brand that has a lot of passionate associates. Mm-hmm. So we were able to bring back many of our well-trained Edition associates. But labor in markets where demand is accelerating rapidly is a bit of a challenge for us. So if you look at Florida, Texas, Arizona, California, the good news is there's lots of leisure demand in those markets, and we're seeing demand rise rapidly. But we are competing with labor. We're competing with our traditional hotel competitors, and there are some industries that have thrived during the pandemic, and they need more workers as well.
Have you had to raise wages?
In some markets, we have.
We were sitting in a pretty large luxury Marriott hotel in New York City, almost 500 rooms. To me, it felt staffed, but the reality is, and I don't want to bring a lot of bad news here, but if you go to a hotel, you may just get a little bit less service than you're used to or you were used to pre-pandemic, just because they don't have the bodies necessarily to take up the room, to change over the room, put new sheets on the beds. This stuff is actually happening, but ultimately, it's just a sign of the times, Miles.
Well, Saz, you guys were in the penthouse suite at the Marriott,
That's
I believe in Times Square.
Yeah, that's
as viewers of the program may remember, we had a long conversation about what the use of those rooms actually are. Usually for events like that, when LeBron comes to town to do media, he goes there. No one stays in those rooms.
Well, I'm glad you mentioned that, because he did say for New Year's Eve, they tend to rent that room out for over $100,000. So there's your socially shareable fun fact from Yahoo Finance today.
And something else, you mentioned that the rooms just aren't going to be serviced as much. Mm-hmm. And I don't know if you got into this with Anthony or not, but I do wonder, does Airbnb make the hotel chain's life easier in a way? Because at an Airbnb, you don't expect that level of service. Mm-hmm. At an Airbnb, you're like, I got to change my own sheets, or I got to make my own bed, right? I get one set of towels when I show up, and 5 days later, it's the same set. And what Airbnb does is they say, you could wash it if you'd like. There's a washer dryer in unit, perhaps. Does that make the hotel's life easier?
No, let's be clear. If I go to a hotel, I'm not touching those sheets other than sleeping on them. I'm not touching hotel sheets. I'm not touching that bed. I'm not filling up my own toilet paper. That is why I'm paying $200 a pop to go to a hotel and have these things done for me. I'm not an Airbnb guy.
Guys, I have to say, one of my sort of pet post-pandemic peeves now is that if you do certain rentals, not even necessarily to Airbnb or whatever, they make you bring your own linens or pay for a linen service.
I'm okay
and I
with
think
that.
the excuse now,
That's great.
I think the excuse now, I don't think so. They can provide the linens and wash the linens. I think the excuse now has become COVID-19. Oh, we can't handle the sheets because of COVID. What? You wash the sheets. It's not a big deal. It's just a way of pushing that cost onto the customer rather than the rental doing it themselves.
I want my own sheets.
I will say, in some ways, though, Julie, I mean, I remember back in the 90s going down the Jersey Shore with my family, and we had to bring our own sheets to the rental. And then Airbnb was like, no. Rentals can now be, a more upscale experience. So now we're reverting back maybe to that time when every rental.
Perhaps that's what it is.
But I mean, we could do a whole bit on whether Airbnb actually reinvented the rental market or they just capitalized on something, because rentals have existed for a long time, certainly in vacation-prone areas, but we'll table that. We'll table that for. We're going to have slow Fridays, right, coming up in August as people are going on vacation. Maybe we'll just, yap about this for 12 minutes to kill some time at a later date. All right, let's get out of here on the other side.
Deep tease.
Yeah, deep tease for August the 13th content here on Yahoo Finance Live. Let's take a look at markets as we head to break. All three majors in the green. Russell 2000, once again, outperforming, up more than 1% in early trading. On the other side of this break, we're going to talk a little bit more in depth about the state of the economic recovery. Ellen Zentner with Morgan Stanley will stop by for that conversation coming up right after this.
You want me to stay off mute?
It is just after 10 a.m. on Wednesday, July 21st. This is Yahoo Finance Live. I'm Julie Hyman, continuing to be in my undisclosed location, aka New Jersey, while Miles and Brian Sazzi back in the studio. I'll be joining them next week. Let's take a look at what's going on with stocks here a little more than 30 minutes into the trading session. And as Jared Blickery pointed out to us earlier, the Dow has now made up all of its losses from Monday. It's back to Friday's levels, has come even with those, has filled the gap, so to speak, as it rises some 255 points today. The S&P up better than 0.5%, and the Nasdaq is up 0.4%. We continue to watch the bond market closely as well here as of late, because we have seen yields continue to be at relatively low levels, although not as low as they were certainly earlier in the week, 1.27% today. Spicy, Chipotle shares opened at a record after customers gobbled up burritos and with them higher prices last quarter. CFO Jack Hartutton is going to join us in just a few minutes to discuss. Bitcoin bounced back, and with a rebound in the cryptocurrency, news of a big fundraising round for one crypto exchange. We'll have details. Also, what's old is new again. Brian Sozzi gets a look at Bed Bath & Beyond's revamped store in New York City's Chelsea neighborhood. Got a personal tour from the CEO, and we will get a little piece of that. But first, let's start with the economy here and what we have seen as the sort of changing perceptions of where we are in this economic cycle and how alarmed, in some cases, investors should be. Ellen Zentner is with us now. She's Morgan Stanley chief U.S. economist. Ellen, it's always great to see you. There has been what has seemed to be this changing perception on the part of market participants that, oh no, we're on the downslope of growth, and sort of some alarm being expressed on that point. How are you thinking about post-peak? I know you've written about it quite a bit as of late.
Yeah, so I think post-peak doesn't have to be a bad thing. I mean, within a business cycle, there are ebbs and flows. There are various turning points within a business cycle. And we've come out of a very rapid phase of recovery and expansion. And so it's only natural that we would move into the moderate phase. Now, we've been helped along that path pretty quickly toward moving into the moderate phase as we have shut the door on the second quarter, because it's so obvious that we're leaving the peak of fiscal stimulus behind us. You know, the last round of checks that were received in March on the cusp of the second quarter. But that's created, you know, what we've been talking about, this excess $2 trillion in savings that households can draw upon at any time if they feel things are rough or if there's a hiccup in the labor market. And that's a cushion. So that's sort of a tail of earlier stimulus that could still help the consumer along. I mean, buying power is still going to be quite strong this year. So I don't think the fact that we're moving out of peak growth rates should alarm anyone. But of course, as you know, markets speak a different language than economists. And for markets, you've got to always push higher at a faster and faster rate, or else investors do get worried.
And Ellen, of course, on the market side, we've seen some concerns, at least in some pockets of the market, around the Delta variant, spread of the Delta variant. And I've seen some of your peers on Wall Street maybe consider a 0.2 of second quarter GDP coming out as a result of that. Are you guys thinking that the spread of COVID, renewed spread of COVID in the U.S. will have any impact on growth, or is that savings really going to buoy us here?
So as yet, I feel no need to take down GDP growth forecasts on the risks around the Delta variant. I think we've done a good job of self-policing all through COVID, and that means that it can dampen some of the effects because there may not be a need to put in reversals of the reopening, renewed restrictions. Also, if there are renewed restrictions, oftentimes people have already been self-policing. Some of the evidence of that could be in the state of Alabama, where here's a state that ended the unemployment benefits early, and we've not seen any bump in the labor supply there. It also happens to be a low vaccination rate state, where people and businesses are probably reacting to the rise in cases there on their own. So I just don't see a need at this early stage to even, think that I would have some idea of what kind of impact that could have on GDP. I'm looking at consumers that are telling us that their concerns over COVID have now reached another new low. I'm looking at mobility metrics, which daily metrics continue to rise. I'm looking at data from TSA, which shows that air travel in the U.S. is back to 85%. Now, that doesn't mean that all of that can't bobble. But I think it's disingenuous of an economist to sit here today and say, I know what kind of effect this variant could have on the U.S. at some future date.
Ellen, so many of us are now returning to our headquarters. Look, we're back in our studios here. The banks certainly are going back to their offices. What does that return to office life mean to productivity in the country?
So, we hope that it's a lift of productivity. Now, I think what we saw during the pandemic was because output remained high after that one quarter that one quarter plummet. And we lost a lot of employees from the labor market. Productivity rates soared. And I can tell you from my perspective in the financial industry, productivity rates absolutely soared. But I do think the longer work from home remains high, I do think you start to lose some productivity over time, some connectivity over time. And if certainly this varies across sectors, there are some that are going to do work from home very, very well, and others that aren't going to work very well. I do think, though, that there are cross currents here that mean that we can't just assume that rates of productivity will be permanently affected negatively after COVID. I like to focus on some of the more positive aspects of it. So one, yes, you're going to have companies with rising wages that tends to pressure companies to seek out efficiencies, capital deepening toward technological advancements. That means they need less employees over time. But you also, with increased work from home opportunities, do open up more prospects for women to enter the labor force more fully, for the disabled community to enter the labor force more fully. And so I think there are areas where we can pick up productivity and pick up labor force participation over time. So I think right now the jury is out. I mean, we are still in the moment of COVID, very much so. And so I think it's going to take time for the dust to settle in order to see exactly where we end up with productivity, labor force participation, structural impediments.
Ellen, something I've been really curious about as we come out of COVID is how, if at all, the study of economics is changing or going to change. And I say that because of just sort of the vast uncertainties that we now have. But I don't, you tell me, you've been at this a while. Was it always like this? And it just feels more acute right now that there is just a level of predictability that just becomes that much more difficult, or was it always this tricky?
So it's a good question, Julie. So I think, we saw in the last cycle, very steady, at least in the last half of it, very steady growth. And I always joked that I could have just turned in a forecast for $200,000 a month every single month for payrolls, and I probably would have hit it more accurately than consensus. Like, it almost took no effort at all. But when things aren't steady, and this is the case in any downturn, not only do the uncertainty bands widen around anyone's economic outlook, but getting the data right, those error bands also get quite wide. So of course, when the downturn is extreme, after the financial crisis, during COVID, for instance, those error bands just blow so wide that we really have to go back to the drawing board. And so what I think we've learned in the economics community is that economics over time has moved away from being so theory-led, steeped in historical models, to more statistical based, where statistics, mathematics, econometrics, you have to be very strong in those to be an economist. And we relied more and more on those models to tell us what the data would be doing and where the economy would be going. Now, when you have these very uncertain downturns, those models are practically obsolete. And we have to go back to being sure that you've got experience on an economics team. And I'm not just touting my own, I call myself the old salty dog on the economics team, but you need somebody that's lived through downturns, that can understand when and what a model cannot pick up and make those adjustments on the back end. And you're going to have to understand how long you need to do that before typical factors fall in place again and those models make sense. And so I think that's what it's done to economics, is that we've almost put our sleuthing hat back on and gotten back to the basics in these downturns.
As the old salty dog on this team, I can appreciate that most definitely. Ellen Zentner, Morgan Stanley Chief U.S. Economist, thank you so much. Appreciate it this morning.
Thanks.
We are going to take a quick break. When we come back, Chipotle seeing avocado prices go higher. Prices for you at Chipotle are also going higher, but it seems like people are happy to pay them. We'll be right back.
Chipotle just served up a very spicy second quarter for investors. The company blew away analyst sales and profit forecasts, powered by demand for new quesadillas and a whole bunch of food ordered digitally. Chipotle signaled that the third quarter has started well, sending the shares to a record high this morning. Joining us now for more is Chipotle CFO Jack Hartung. Jack, always good to see you here. Have you seen any resistance to the price increases that you took a couple months ago?
Hey, good morning, Brian. Listen, so far it's only been about a month and a half, and so far we've seen no resistance whatsoever. And keep in mind, before we took the price increase, we announced in May that we were going to make a very important move. We're going to raise the wages of all of our crew employees up to an average of $15. And we said the way we're going to fund that is with a modest 4% price increase. And so a lot of our customers understood what we were doing, and they understood the magnitude of it, and they were very much in support of it. So far, so good, though. No resistance whatsoever.
The cost of doing business, you can appreciate this. It's going up. It's labor, it's food, it's packaging, you name it. Are you looking at another price increase for the second half of this year?
Yeah, we've not made any decisions. We know that there is some inflation coming. What we don't know is how much, and we don't know how much of that is going to be permanent, meaning it's going to stick, and how much is going to be transitory. And I suspect it's going to be a combination of both. So, Brian, we're going to be patient. We're going to watch how inflation on our ingredients unfolds over the next several months and the next few quarters. We'll watch what happens with the labor force. I mean, the action we took with raising wages has had the intended impact. So we've been able to recruit a lot more people. Our application flow has been fantastic, so we feel good about that. So we're going to be patient, and we'll watch how things unfold. The thing we don't want to do is raise prices and then find out inflation that we're trying to cover actually is transitory. So we'll want to get as much information as we can before we take any action at all.
Harry, you guys, I believe, are planning to open about 200 new Chipotles this year. I have two questions related to that. One, where are you planning to open them? Where do you expect to see opportunities? And secondly, has the cost to open stores also gone up?
Yeah, I'll deal with your second question first. There is some materials inflation for sure. We've all seen what's happened with lumber and really the entire supply chain. There is pressure, and there's pressure either in terms of availability or in pricing. So we do think there's going to be modest inflation in terms of the materials that it takes to build our restaurants. That's more likely to be transitory. And I'm saying that mostly because it's because of supply chain imbalances, and those things have a way of working their way out. And already we're seeing lumber is coming down. So it's likely that's going to ease over time. In terms of where we're going to open up restaurants, they're in the same markets we're already in. 90% of our restaurants are going to be in existing markets. Those are markets where the brand is well known. We've got great teams, and there's still demand for Chipotle. And most of the restaurants we're opening include a Chipotle. So even if you've got a restaurant in your area that's convenient to you, when we open up a restaurant with a Chipotle, it just takes the convenience opportunity to a whole nother level, and our customers really love it. And those restaurants with a Chipotle are doing fantastic.
Jack, something else you guys called out in your release is restaurant level margins, highest since third quarter of 2015. Of course, that was another separate issue away from COVID that the company worked through over a several year period. And I'm curious, how you're now thinking about restaurant level margins going forward. Is that 24.5% the beginning of an improvement? Do you want to hold it there? How are you thinking about that part?
Yeah, listen, Brian, it's been a long haul, and we're really delighted that our volumes are back to our peak volumes. I know our margins are back to what they were 6 years ago. And it's really been a lot of hard work for our ops teams. Our ops teams have focused on hiring great people, developing those people to deliver a great experience, and then running the business effectively. And this is the kind of outcome you get where we've got rising sales and rising margins. And Brian, the margins from here, they go up again. We're not stopping at this $2.5 million volume, which is our peak volume. We think we can get to 3, and once we get to 3, we'll be looking beyond that as well. And when we go from the current $2.5 million volume up to 3 or beyond that, our margins go up. They don't stay stagnant at this 24-25%.
Jack, you had a hiring event, I believe, last week. How many folks did you hire?
Well, our goal is to hire tens of thousands. We're still in the process. I tell you, I'm very pleased to say that not only from that hiring event, but also since we took the wage increase that we announced in May and took effect in early June, our applicant flow is up multiples compared to what it was back in April. In fact, even though this is the toughest labor market that I've seen in my whole career in the restaurant industry, where it's tough to get labor, it's tough to hold on to labor. So you've got to have a compelling proposition, which we think we do at Chipotle. Our wages now are averaging $15 per hour. We offer debt-free degrees. We offer mental health opportunities. We offer, probably most importantly, is when you join Chipotle as crew, you can realistically expect that you can, if you want to invest in yourself, we'll invest in you as well. So you can get to a manager level within a few years. You get a restaurateur, which is an elite manager level, within a few years. And those come with 6-figure salaries. And so when you join Chipotle, you have a career path ahead of you. So, labor has been very, very challenging, but in terms of not just the career event we had this past week, but the wage action that we took, our applicant flow is as good or better than it was even pre-pandemic.
You exited the quarter, Jack, with $1.2 billion in cash, a $500 million untapped credit facility. The raises you gave workers this year, is that just the first round? Do you envision yourself going up a couple dollars more to get more workers into the restaurants? You're opening 200 plus restaurants. Do you need more workers, and do you think you're going to raise those wages up even more?
Yeah, I don't think we'll need to do anything in terms of a significant another $1 or $2 raise right now, Brian. But listen, we're not afraid to invest in our people, and we've been investing in our people all along the way. Again, whether it's invest in their development within Chipotle, invest in their development through debt-free degrees. And if it means that the wages need to go higher to make sure we get great people, that we keep great people, we'll do that. We're not afraid to invest in our people. We know that when we've invested in our people, we get returns for many years to come. When you're a growth company like we are, opening up more than 200 restaurants per year, we need a pipeline of great people, and that investment is definitely going to pay off. We have a lot of cash in the balance sheet. That's given us a lot of room to maneuver during a pandemic like this. You might remember last year, early on in the pandemic, even though all businesses, including ours, were under pressure, we made investments in our folks with discretionary bonuses and making sure that we invested in their future. If they were, in an educational program and didn't meet the hour requirements, we waived that kind of stuff. So, we'll continue to use our financial strength, whether it's the balance sheet or operating income, to make sure that our people feel valued, that they know they have a career with us, and we'll continue to invest in them.
All right, well, let's keep that cauliflower rice on the menu. I like the lime taste. Chipotle CFO, Jack Hartung, always good to see you. Stay safe. We'll talk to you soon.
Thank you.
All right, coming up, former Trump advisor Tom Barrack arrested on foreign agent charges. Our very own Julie Hyman is back with some stories you need to know about right now. We're back after this short break.
Some other business headlines we're watching right now. Tom Barrack was arrested yesterday in Los Angeles and charged with acting as an unregistered agent of a foreign government, also with conspiracy. Barrack is a real estate investor and longtime ally of former President Donald Trump and is being accused of working with officials of the United Arab Emirates to influence Trump's policy positions. He's also being charged with lying to federal investigators. A cryptocurrency derivatives exchange founded 2 years ago by a now 29-year-old California native was valued at $18 billion in its latest funding round. FTX raised $900 million from investors, including SoftBank, Sequoia Capital, and Dan Loeb's Third Point. FTX does not allow Americans to trade on its main exchange to avoid running afoul of U.S. regulators. And we've also got some sports headlines for you that obviously have implications for business as well. The Milwaukee Bucks bested the Phoenix Suns in Game 6 of the NBA Finals to take their first title in 50 years. It's also a win for the team's hedge fund investor owner, Mark Lassery, who was part of a group that bought the Bucks in 2014 for $550 million. Forbes calculated the value of the franchise at $1.63 billion. And that was back in February, before this win. And Brisbane, Australia will be home to the 2032 Olympic Summer Games. It's the first host to be selected under a new system that removes competitive bidding. So they were the only one in the running, Miles.
All right, Julie, I gotta say, I am disappointed that we did not get a run at Giannis Antetokounmpo from you. The star, of course, of the Milwaukee Bucks.
Wasn't gonna go there.
I know. Well, we are standing by here with basketball enthusiast Brian Chung, who I know mostly would like to talk about last night's game, but we will talk about what's happening in the Treasury market. So looking here at the 10-year over the last 5 days, and a couple stories being told by what we've seen in the yields market.
Many stories, and obviously the story for this week, and especially the market sell-off that we saw on Monday, was a lot about the 10-year yield, longer-term bond yields really going down amid that risk-off trade. We saw that on Monday morning. It actually happened before the 9:30 open, which kind of preceded the harsh sell-off that we saw in the Dow. But you've seen that the 10-year yield has come up from really the bottom, which is something close to about 114 basis points as of yesterday. So obviously, by the way, reminder that when yields go up, that means price down. So just a reminder that red and green isn't necessarily as easy to read on the 10-year. But I think the big narrative is something that we need to look at from a year-to-date standpoint. So the big story has really been the 10-year going up really in the early spring, right? And a lot of that was the reflation trade. The idea that markets were trying to get ahead of the inflationary data even before we saw those hot PPI, CPI, PCE prints. But then what we've seen is bond yields come back down. But I would argue that the story isn't necessarily the same. It's not that, well, inflation expectations were going up and now they're falling back down because of the Delta variant. I would say that if you look at 5-year break-evens, which we don't have the chart here, that's really a market-based measure of inflation expectations. It's been staying steady through the last month and a half at about 240 basis points. So expectations still, at least over the 5-year period, anchored at around 2.5%.
All right, so if we still have the market looking for inflation, and I saw some data this morning, 10-year break-evens, something like 2.75%, right? So essentially the market is telling you the Fed will be exceeding its target over the next decade with respect to inflation. What is driving the decline in Treasury yields then?
Well, there's a number of other factors. For the same reason that stocks can go up and down for no seeming reason, it's the same story with bonds. And I think that we need to understand that it's not just inflation that weighs on bonds. People love to take a look at nominal bond yields and say, okay, well, yeah, this is just us measuring against real expectations. You have to adjust for inflation. But there are a number of other reasons why people can go there as well. Think about an investor that went risk off on Monday, right? You're not going risk off because you're only talking about that inflation story. You're just going to risk-free assets because you're looking for somewhere to hide because you feel like the risk of equities or whatever else you're trying to invest in just simply isn't worth it. So risk premia, I think, was the bigger story this week than inflation.
We can also get into maybe the plumbing of the mortgage market.
You can go to geometric means if you want, man.
Well, I mean, we don't need to do that. I don't know if we're doing 10-year, not the Fed funds rate, right? So
not yet, we're not.
Not yet, we are not. Yeah, I mean, we could go into the plumbing of forced buyers of duration as part of MBS portfolios as yields come down. Big news with FHA waiving that refi fee maybe brings a little bit of a bid into that market. We'll table that for another time. Maybe a Yahoo You.
We could.
Brian.
MBS. Agency MBS.
There is nothing I like more than assigning you work here on Yahoo Finance. So you can get working on this Friday's Yahoo You, digging into the agency MBS market.
Boss.
Looking forward to it.
Why not? I'd be looking forward to a little agency MBS work as well. I mean, there's big money in that still. That's what's so interesting. All right, we're going to take a quick break. When we come back, Brian Sozzi, he got a little bit of bed, he got a little bit of bath, a whole lot of beyond. Coming up next, his preview of a revamped store in New York City with the CEO of the company.
All
Bed Bath & Beyond has given a major facelift to one of its most important stores. The home goods retailer is set to reopen its flagship store in New York City on Thursday. Consumers that come by for a visit at the 92,000 square foot location will be greeted by an entirely new vibe for the brand. I got a behind the scenes look at the revamped store with Bed Bath & Beyond CEO Mark Tritton.
In this store, in this space for 30 years, servicing Chelsea, servicing New York with both local residents and tri-states and tourists. So this is an important landmark destination and in a landmark building. So in our 50th year, we remodeled the store. We started talking about it in December. We began our plans, COVID hit. We still believe in New York. We still believe in this space. We continued. So it's an iterative process. We closed the store in December 31st at the end of 2020. And then we spent the last 6-7 months remodeling. So here we are.
You spent time, you're an executive at Nordstrom, executive at Target. What is Mark Tritton, what did you think about when you walked into the store? You haven't seen a remodel really in 30 plus years. How do you go upon redesigning it?
You know, I think it's about the customer experience and the customer journey of who we want to be and what is the easy evolution of the business. And I think that the store we inherited here was incredible. It was large, but it was a pretty daunting experience, if I can call it that. It was more like a warehouse.
You put it nicely.
Yeah. Well, everyone remembers it. It was dark. It was jam-packed with merchandise. It was kind of a bit of a bazaar. And that was fun, but it really wasn't standing for the brand that we wanted to create. So really thinking about how to modernize the experience, and that starts with creating an omni-channel experience here in the store. So it's about the physical and the digital merging, but let's celebrate the home. Let's make home happier and celebrate rooms, categories that we dominate and that customer expect from us. Behind us here, an incredible bath area like you'll see nowhere else in New York. Bed, kitchen, storage and org, health and beauty, indoor decor. This store has it all. And the physicality of everything from the lighting to the floors, to the fixtures, to the layout and the details, much more residential, much more modern. And so customers are able to envisage themselves in their own homes as opposed to shopping off shelf and then trying to work it out later.
Where did the racks go? I walked in here, I stood one end of the store and I saw the other end of the store.
Yes.
Bed Bath & Beyond, known for their really high racks and you can't see anything.
No, well this really, 92,000 square feet is a lot. Opening it up and having sight lines from front to back and creating that sense of discovery in a store was really important. So light, bright, fresh, great signage, great value signage, but experiential shopping. And I think that people are so hungry to look and touch and feel and kind of just wander and find things in store, and we really wanted to play off that.
There are a couple different elements in here. You have a SodaStream shop.
Yes.
You have buy online, pick up at the front of the store. You have scan and go. What are some of the other innovations?
You know, I think the Omni stuff is really important, that you can take out your phone and you can literally shop and scan or use it as a map. Or we have a great coffee shop. You can stop and have a great cup of coffee here. You can actually check the menu on your own phone beforehand if you want. But we've got things like, Nespresso, as you said, SodaStream. We've got a really cool innovation in our vacuum area. So I've worked with vacuum cleaners for a long time, and customers always say, I can't take that off the rack. I can get the box easily, but what am I actually buying? And it's a big ticket item. We actually have an experience space, carpet, dirt, and great vacuum cleaner assortment. You can pick them up, they're plugged in. You can see what's the weight of this, what's the power of this.
I'm going to try this out.
I know, it's super cool. But I think this idea of more experiential and more in-home expectations of how a customer shops and wants to iterate with the product is really important. I think coming down here, we have the Casper shop. You can lie on a bed. You can test
part of a new deal. You just struck a new deal with Casper.
Absolutely. I think the first ever major in-store presentation in the US. Think about bed, think about sleep, think about us, and think about Casper. It's a natural progression. So here we have a full assortment of Casper, but it's also experiential. Pillows, pet beds, mattresses, you name it. So the idea that you can come in, you can touch, you can feel, and you can experience and find that easily and navigate and discover in the store is really important to us.
92,000 square feet. I imagine to lease the store is not cheap.
No.
Why are you so confident New York comes back?
We never doubted it. We really didn't. I think that it's not a vanity project. It's not about we have to have this flagship to kind of put a stake in the ground like a castle and like a lot of retailers used to do. We have a thriving business here in New York. We have a thriving Chelsea business. We have a thriving New York business.
So you have 4 stores. With this, you have, what, 3 other stores?
Yes, we have Tribeca. We have Lincoln Center. We have Kips Bay and the store here, and we'll look at the total real estate across New York over time. But this for us was a landmark store for our customer and for the space. I think the area of 6th Avenue we're in is definitely home orientated. It's a great destination space. Whether you're a college student or an apartment dweller, this is the place to come. So we wanted to be here.
How much will this store make in terms of sales in a year?
There's the surprise. I would say to you, it runs, 5 to 7 times our average suburban store. It's that big. And so there was a revenue hit there, but it has to be profitable. It has to make money. And that's what we've been focused on all the way in. So we will have maybe a few more of these across the country in the right markets where we have the right real estate, where we can fully express the ultimate expression of the brand, like a hub and a spoke, but there won't be anything like Chelsea.
So you are also remodeling, 450 stores. What components from this store will be in those stores?
Yeah, look, I think this is really emblematic of the 450 stores we're going to remodel. We've already started that process. They're off and running, doing very, very well, exceeding our expectations on both the ROIC and the sales and margin. But what you'll see is these open sight lines, this sort of more residential feel. The sight lines being brought down, actually a curation of the assortment, about 20 to 30% less product in the store than there was traditionally, and a celebration of great national brands and our own brands that differentiate and create exclusivity. So I think better lighting, better freshness, better ease, and this sense of discovery again at Bed Bath & Beyond.
Can you get enough workers to work on this store? I mean, this is a 2-level store.
Yes.
There's a lot of different shops. How many people work in here, and how have you been able to find the talent?
Yeah, about 350 people work here on rotation. We have been able to find staff here. I think we've pulled from all our best talent across the business, as well as we've recruited brand new talent. Look, people are still passionate about working in retail and working in a great environment, and this is a beautiful environment to work in. But where companies focus a lot on being people-powered and how do we invest in team members and their experiences as well as their benefits. And I think just creating a community for our associates that they can believe in and belong to has been really important. So yeah, we have the team.
Straight ahead, JP Morgan CEO Jamie Dimon's digital bank account could be about to get a whole lot larger, believe it or not. Stay tuned for that.
All right, welcome back to Yahoo Finance Live on this Wednesday morning. Taking a quick look at the markets here. We see all three majors are in the green, about an hour and 15 minutes into the trading session. Well, we've talked a lot on this program about the competition for labor out there, and it even goes all the way up to the C-suite. Jamie Dimon yesterday awarded a special stock retention bonus by JP Morgan. Now, he must hold on to these shares granted to him, 1.5 million shares, granted to him by the firm. They are not exercisable for at least 5 years. The grant was at yesterday's closing price, $148.73. And the shares cannot be exercised for an additional 5 years. So he can exercise the grant in 5, then he can sell the shares 5 after that. So according to the Financial Times, source familiar tells them that the internal modeling from JP Morgan suggests this will be a $50 million stock award to Jamie Dimon, but it would not actually turn into that money for at least 10 years. But I think, Julie, always interesting to see executives continuing to be incentivized to stay at their firm. Jamie Dimon, of course, famously longest-serving bank CEO. And I think his presence at JP Morgan, his presence, frankly, as, the spokesperson of a sort for American business continues to be an important one, and kind of signaling here that he's likely to stick around for quite a bit longer in that role at JP Morgan, and then, by extension, in the broader business community.
Yeah, just a couple of thoughts here. When you say he's longest serving CEO, he's been there for 16 years as CEO. During that time, the stock is up nearly 300%. That compares with only 18% or so for the KBW Banking Index and under 50% for the XLF, the broader financial ETF. So just to give you an idea of what shareholders have come to expect from Dimon. And of course, he is viewed as sort of a best-in-class CEO. He's 65 years old, by the way. So if he does stick around by the time he retires to take advantage of that money, he'll be quite a bit older, right? And something else to consider, of course, is that he has had a couple of health scares. He had a bout of throat cancer, then he had to have emergency heart surgery. So that's something to keep in mind as well. You guys, one tiny note that I noticed when it came to the awarding of this stock option grant, that he will still be eligible for it if he leaves the job for an unelected or elected government position. That's something that has been whispered about as a possibility for him for some years as well.
Well, good for JP Morgan here, locking up its main guy. You can't see Jamie Dimon going off and trying to correct Wells Fargo here. So they're keeping their guy here, as they should. I mean, he's driven tremendous shareholder value. But I will mention this. So you had that leadership shakeup at JP Morgan several months ago, put several potential successors in line. But to what extent does this perhaps send a signal to those potential successors that Jamie Dimon is unlikely going anywhere anytime soon? Do you want to stay in this position? Do you want to try to go out there and launch your own hedge fund? Do you want to go to try to lead another bank? I think those questions might eventually start to swirl yet again. JP Morgan has lost a good number of executive talents through the years because Jamie Dimon has stayed atop the company for so long.
Yeah, and Julie, it's a good catch in there that if we see Treasury Secretary Dimon, for instance, that this would, this award wouldn't be clawed back in that instance. It's also, possible that he doesn't exercise the option and they just, it goes unfilled, right? This is a special grant for a future point in time at which he exercises, and then of time after that, he's actually eligible to sell it, and then of course would have to deal with the tax implications on that sale, so on and so forth. I mean, it's not just like, they gave Jamie Dimon $50 million or whatever. Like, this is a very long-term, situation for him. But I think it also just speaks to your point, Sazi, a little bit about what's the future of this bank and what's the future of the banking industry, right? Because I think it's an industry that has been obviously shaken up over the last decade from regulatory reasons. Now we see additional kind of neobanks, fintech competitors coming in, and there are questions about what is a bank? What does a bank want to be as it matures? Do you want to have it be led by kind of a strategy type, which really Dimon is? Do you want it to be an IB type, where you see that direction happening at Goldman, but that was a big change from the trader type. Lloyd Blankfein really came from Aaron, and so it's just a lot of questions I think about who leads any of these firms going forward. And I think JP Morgan maybe just making life easier on itself, that they can count even more than they already could on Diamond's leadership.
No, it's a great point, Miles. I think what you're seeing is that the future of the banks, you probably will need a strategist, someone who understands the bigger picture. You have Jamie Dimon, you have Jane Fraser at Citigroup that I would say falls into that strategist level, and I think Wall Street has spoken.
Guys, one more comment regarding what you were saying, Miles, about whether this award gets awarded or not. I just Google at least tells me Jamie Dimon's worth $1.8 billion. So if he gets another $50 million, give or take, is that enough of a motivator for someone like him who already has that kind of wealth?
Yeah.
I don't know.
Yeah.
Okay.
I mean, you would know more than us, right?
Yeah.
As we established during this. Look, I mean, maybe this is the space grant. Like in 10 years, so he exercises in 5, sells them in 5, then retires, then takes this pool of money and gets on a Blue Origin flight. Maybe with you, Julie, and Mark and Jeff and hopefully Wally's still around kicking it for another flight.
We have a group text actually going about that.
Yeah, I'm sure. Texts are just lighting up now, asking which flight you'd like to be on. I know Sazi, of course, still on the waiting list, unfortunately for him. All right, coming up on the other side of this break, final look at the market action here as the three of us get set to hand you over to Zach and Akiko on the other side, or at the top of this hour. Just a look here at the three major averages. Dow leading the way, up about 230 points.
Well, regular viewers of the program will have noticed there are many themes that we tend to explore, many themes that come up again and again. One of them is that Miles Udland doesn't like churros. Another, Brian Chung, born in 1993. Something people may not have realized, because we don't always make it as explicit, is that Brian Sazi is a productivity machine. And to that point, his day is not done with the end of our show. he's got more coming up later in the day today, more interviews.
You're bringing tears to my eyes, Julia. I ever think about what's actually going on in the world. I'm always looking 25 steps ahead, to your point. But anyway, I'm going back to the New York Stock Exchange later today. It's my first trip to the New York Stock Exchange, probably in going on over 2 years, in large part because of the pandemic. And we're going to be speaking with United Wholesale Mortgage CEO Matt Ishbia. This is a SPAC that came public earlier this year. Now, the stock has been under pressure over the past couple months, down close to 30%, in large part because you've seen rates on the decline, concerns about the profitability in that type of environment, also concerns about housing affordability. So looking forward to seeing Matt Ishbia up close and personal for once, instead of interviewing him from the inside of my kitchen next to a fridge with a lot of Beyond Meat meatballs. So good to meet him in person. He has big energy. He was a former basketball player in college. Looking forward to chatting with him.
And you're also going to talk SAP, right, in the next hour?
Yeah, we got a lot of things going on. SAP CEO Christian Klein, we spoke to him earlier this morning. We'll have that full interview at about 11:30 today. One of the takeaways for me with that interview is that the COVID-19 Delta variant not yet impacting that company's business. But again, a good quarter out of SAP. Shares are under a little pressure here today, I think in part because of their operating profit margin guidance, a little squishy.
Meanwhile, I do want to mention one piece of news about another CEO that we all have been closely watching. That's Adam Aron, who, of course, is the head of AMC. We've talked about him a lot because he has taken a lot of advantage of the stock being a so-called meme stock and going up so much to sell shares. Now he's also going to be the chairman of the company. And this is interesting because so many companies have split those two roles. AMC, though, is bringing them together. I guess, Miles, this is maybe just another award for the guy because he has kind of struck while the iron was hot on AMC.
Yeah, I think this was as part of the company's shareholder vote. This is the one where they had a proposal that would have allowed the company to sell 25 million shares, not before next year, but then they took that proposal out because the AMC commentary, the AMC community, pushed back against that. Of course, the company has already sold hundreds of millions of shares into the market. They had to last year, right? The company was in dire straits, but now, as many viewers know, has taken on a life of its own. So Aaron cemented there at the top of the company as both chairman and CEO.
I wonder if he changes the ticker symbol to APE.
Could.
That would be the utmost in sort of catering or I don't know.
There is no APE currently. There's no.
That's why you got. That's why I got paid the big bucks.
That's APE. There's APEN, Apollo Endosurgery, and APEI, American Public Education.
So AP is available.
APE is available.
Adam, are you listening?
You're welcome, Adam.
All right.
You're welcome.
We're going to leave it there, you guys, with all three major averages in the green. That does it for Miles, Brian, and me. You've got Akiko and Zach taking you through the next 2 hours. Have a great day.
Welcome to Yahoo Finance Live. I'm Akiko Fujita along with Zach Guzman, and we are seeing Wall Street looking to extend its rebound rally in this session. The Dow now gaining about 240 points, the NASDAQ up 61, and the S&P 500 up 24. Better than expected earnings certainly helping to lift the broader market. Sector by sector, we're seeing energy stocks continuing its bounce back with WTI climbing 4% right now about 69.89 a barrel. Meanwhile, we've got the yield on the 10-year Treasury yield or 10-year Treasury note crawling back from its 5-month low. The bipartisan infrastructure bill getting its first test in the Senate. Lawmakers moving ahead with a procedural vote this afternoon. We're going to discuss the state of play in Washington and a renaissance in space exploration 1 day after Blue Origin's successful mission to the edge of space. We're going to talk to the CEO of Virgin Orbit to discuss the rapid advancements he sees in the space race. But we are beginning this hour with an earnings roundup, and Zach, a slew of earnings to walk through to. But let's start with United Airlines here, because we have seen that stock move in a big way on the back of their numbers. The company reported its 6th consecutive quarterly loss, but the stock moving on a more upbeat outlook. The company is saying it expects to return to pre-tax profit in the 3rd and 4th quarter. And Zach, the story is really one of continued improvement, and one we've heard from a lot of other airlines here. With revenue coming in at $5.5 billion, it is down more than 50% from the same quarter in 2019, but it's up nearly 70% from Q1 this year. Bookings are up, losses narrowing, domestic leisure travel really leading the recovery on that front. And we did hear the company, along with other airlines, really talking about trying to lobby the administration to lift travel restrictions for non-U.S. citizens who are coming in from the UK or the EU. They certainly feel like that could provide an additional bump in travel, especially during the busy summer months.
And it comes after Delta, surprise to the upside too last week. 2-day wins here though for the Jets ETF, the one focused on airline stocks. Their best 2-day stretch that they've seen since November 24th. So a couple big wins there, not just for Delta, but today United putting together a pretty big pop, pretty nice pop, I should say, for some of those airline stocks. Also want to highlight the results we got from Coca-Cola, another one of those names that we have seen show some strength off their earnings. Overall, Coke now sitting at a 16-month high after beating what some analysts called sky-high expectations there. Excluding currency or acquisition impacts, Coke's organic revenue was up 37% for the quarter. That was above what analysts had expected at 29.3% growth. Earnings 68 cents a share, topped the estimate there, 56 cents. We also got the update from CFO John Murphy talking about how comfortable he is for moving forward here in the expectations that Coke has, particularly around inflation. On a 2-year basis, you saw that only up by about 2 to 3%. The consumer prices there for Coke relative to what they had pre-pandemic. And full year guidance there at Kiko, when you look at full year organic sales, the same number we're talking about there, range of 12 to 14%, which is well above the prior high expectations there that Coke gave of the high single digits. So you think about all things coming back. We had talked about the pandemic impacts for a company like this as they kind of saw soft drink revenues, restaurants and on-premises fall, but that's coming back now. Overall, though, strength here. Coca-Cola shares up 2% after that report.
Yeah, really a good indicator of where the bounce back is, especially in the food and beverage industry. And we're going to keep that theme going because another big mover in the session today, Chipotle. And I wonder if we can pull up the stock chart here because it is up nearly 10%, hitting a new high in the session on quarterly revenue that exceeded pre-pandemic levels. Now, let's walk you through the numbers here. Earnings per share, $7.46, a revenue of $1.9 billion roughly. Now, digital sales here, this is one we've been watching very closely with Chipotle because we saw it up significantly during the pandemic. That slowed compared to last year, but it was still up more than 10%. But dining room sales, roughly 70% of what they saw during 2019 levels. So similar with Coke story, this tells you where the bounce back is, the recovery, and those customers now feeling a little more comfortable going out and dining indoors, in this case over with Chipotle. Now, food and beverage costs, this is an interesting one for me because we saw that in the quarter down about 3%. The company talking about menu price hikes that they implemented as well as lower beef prices. But CFO Jack Hartung said he expects to reverse those numbers this quarter because of higher beef and freight prices. He also talked about the shortage of workers, and Zach, something we've talked about a lot, but having to pay a little more, add a little more incentives, that's expected to add to the costs overall.
Yeah, and all working out well, though, if they can still raise those prices and still see improved growth there for them. So everything seems to be working. And that's a standout, really, when you look at the movers today off of earnings to the upside. We also got a standout to the downside to discuss in Netflix after we got that update yesterday after the close. Mixed results for Netflix for the latest quarter. Revenue topped expectations. Earnings came in a bit light there on the bottom line. And as we always talk about with Netflix subscriber numbers, very much in focus here. 1.54 million added versus the 1.12 expected. But investors focusing on the weaker forecast for the coming quarter. Netflix there only saying that they expect to add 3.5 million subscribers for Q3. That's well below the 5.86 million that analysts had been expecting. We got a little bit more of an update there in terms of what they're trying to do with the gaming initiative that we had discussed leading into earnings around some of the series that they have on the platform. Mainly Stranger Things is the one standout that I would be excited for. But Akiko, I mean, when you dig into the more regional aspects around the numbers, you could say that they topped expectations for this quarter. But almost all the growth in subscribers came from two markets, Latin America and their Asia Pacific region, which are not really the ones we focus in on because they're Netflix's two smallest regions. Back here at home in the U.S. and Canada, for the first time, though, you saw the numbers actually shrink. First time in 2 years we saw that. So a lot of weaknesses there to point to, I suppose, on the Netflix front when it comes to specifically what we're expecting to see for Q3. And another one of those companies that's in a tough spot relative to the growth they saw in the lockdown kind of period of the pandemic last year when we were all constantly looking for something to do and turned to Netflix during that period.
Yeah, and of course, Zach, Netflix has been touting their global growth for some time, but you look at the subscriber ad numbers dropping in North America, it certainly does raise questions about whether, in fact, it is about increased competition, although co-CEOs Ted Sarandos and Reed Hastings seem to sort of brush that off to say, well, it's not necessarily what the competitors are doing. For another voice in the conversation, let's bring in Michael Pachter. He is Wedbush Securities Managing Director. Michael, we know you have strong opinions about the gaming side. I'm going to wait for that just a bit, but let's talk about the global subscriber ads here, because that's a number that a lot of investors have been focused on. Things slowing down here in North America. How much of that you think is just the result of the demand being pulled forward last year during the pandemic? How much of that are you looking at and saying there's a little trouble on the horizon?
You know, I actually think it's all because demand was pulled forward, but as they pulled that demand forward last year, I think that they got that much closer to market saturation. And, they love to talk about global numbers and 800 million internet households, and they're at 209 million, so plenty of headroom. But the truth is, there's only about 85 million households in the US that have internet, and they're already at over 60 million of those. So, the right question is, are they going to get that last 40%? Maybe, or sorry, 40%, 25 million, maybe, but I don't think it's going to be a fast path, and that's where competition kicks in. Competition plays two ways. One, for wallet, because you're subscribing to multiple services, but probably far more importantly and overlooked by my competitors is competition for content. And Disney and Fox aren't giving anything to Netflix ever again. Universal is not, Paramount is not. So I think it's really going to be tough for these guys competing against Disney, Peacock, and Paramount Plus when those guys are holding back all their content. HBO remains a question. I think AT&T has no idea what they're doing. We'll see how the Discovery partnership works out. They might get desperate and maybe license some older content, but I really think the content pipeline is dried up for Netflix.
Yeah, that had always been a concern, particularly when we look at how much money they were spending and how much cash they were burning in negative free cash flow. But it kind of got a little bit disrupted in the pandemic because their production costs came down for the quarter, though, and you saw that negative 175 million of free cash flow versus positive 899 million. Of course, those comps, as I said, tough when you're thinking about the pandemic and production costs there. But moving forward, they're still expecting full year to be about break even when it comes to cash flow. I mean, it's an improvement based on kind of this trajectory we've seen for Netflix. So I suppose that would be the counter to some of what you're saying around competition costs and production costs for Netflix. I mean, is that the case, or is it just kind of a head fake based on the fact that we did see production fall off a cliff in the pandemic?
No, 100%. You're spot on. Cash flow is improving. I think that these guys can be a profitable company and generate cash consistently for the next, 10, 20, 30 years. They're not going away. It's a good company. The open question is, what are they worth? And, my $362 target is giving them credit for $1 billion of free cash flow growth each year for the next 10, discounting it back at a 5% free cash flow yield. And I can only get to 362. So the guys with $600 price targets are making stuff up as they go. I mean, you cannot say Netflix is less risky than a treasury bill. It just doesn't make any sense to me.
Michael, let's talk about the gaming strategy. The company made it pretty clear they see this as a new content category, sort of comparing it to the expansion they made into original films and animation, as well as unscripted TV. If the issue is trying to keep the subscribers you have, bring on additional subscribers at a time of saturation, is gaming going to be it for Netflix?
I think Zach actually summed it up when he talked about being excited about Stranger Things. Netflix has been doing streaming for 14 years, and Zach mentioned one show that's a big hit that they own. There aren't very many that are good. There are many that are hits, but not very many that are good. And those IPs don't lend themselves to games. As bad as I am on Netflix, I'm probably equally really good on games. This is a tough business. I've covered 8 public companies, gaming companies, that have gone bankrupt in the last 20 years. It is really tough. And Netflix shrugs it off and says, well, we're going to go into mobile. Take a look at Activision, EA, Take-Two, Ubisoft, and Nintendo, and tell me what their mobile prowess is. They've all bought their way in. None of them has created a mobile game that's been successful until Activision created Call of Duty just a year and a half ago. So no, this is a really, really, really hard business. And I think the bigger question is, how do you get a game on the TV? Let's say you get it there because Amazon's figured out how to do it. How do you control the game? Not with your remote control. You're going to need a game controller that talks to every TV, every Fire TV stick, Roku stick, Chromecast. That technological challenge is nearly impossible. I do not see Netflix surmounting that challenge.
Yeah, they were also flexing. I mean, that is one that is going to have to be answered moving forward. We talked about how kind of the mobile emphasis there might be something that could get them around that if people are going to take them up on the offer to play mobile games. But outside of that, they did flex kind of their technological advances when it comes to streaming. And that is something that I do think maybe gets overlooked when it comes to Netflix and the way that they have made it easier relative to some other platforms out there, maybe a Peacock, maybe a Hulu. When you look at kind of how the process works and how the next show might load, what do you make of maybe how Netflix has been able to make those advancements to still, content aside, maybe flex the experience of streaming over their competitors?
They actually don't power the streaming technology. They use AWS and the others. In gaming, the only company outside of Microsoft, Amazon, and Google that's tried to stream games is Sony. They spent over $1 billion on Gaikai and on Live, and they announced a couple of years ago they're going to partner with Microsoft Azure to deliver their streaming initiatives. So you've got the 3 biggest cloud providers in the world who are struggling to actually make this work. Microsoft is succeeding. The other 2 guys are so far flops. And here's Netflix, audacious little Netflix, popping up and saying, we can do it better. Good luck. It is really, really hard. They don't have the expertise internally to pull it off. And I think that they're, some would say ambitious, I would say audacious.
We'll see if they do, in fact, pull it off. Michael, it's always good to talk to you. Michael Pachter, Wedbush Securities Managing Director. Let's turn our attention back to the broader markets right now. As we said, all 3 major indices in the green today. Sector by sector, we're seeing energy, the biggest leader here, that is up roughly 3%. Let's bring in Yahoo Finance's Jared Blickery, who is tracking all of the movers for us today. Jared.
That's right. Big reversal in the energy market. And that was one of the laggards yesterday. So good to see that. And let's take a look at the Wi-Fi Interactive, where we have the audacious little Dow now recovering all of its losses that it suffered on Monday. So we can see it's just barely in the green from there. NASDAQ doing a bit better here, up 1% this week. And the Russell 2000, well, that's up 2.6%. It was the outperformer yesterday. You take a look inside the market, NASDAQ 100, another solid day. And some of the standouts, tell you what, the chip sector is on fire. Only one big red negative square, that's Netflix. Just talking about that, no need to add to the conversation. I just want to jump into the chip sector because guess what? NVIDIA may be joining the Dow. That's a theory of CFRA, and we can see pretty close to its record high. We had chips fall off a bit lately, and that's a trend that we've been watching, a little bit concerning, but nice to see a rebound in this space. And another milestone here, I'm going to go to our pharmaceuticals intraday. This is a mixed one, but check out Moderna. This is a stock that's up 51%, and it's just joining the S&P 500 today. So nice to see that stock as well. We've looked at the travel sector briefly. Just want to point out, as Zach said, we're having the best two-day run for the airline sector, at least in the JETS ETF, in 8 months. And a lot of green there. You take a look at what's happened over the last 2 days. Some powerful rebounds. You look at Royal Caribbean, that's up 11%, Norwegian 15%. So it looks like the scares that we had with the potential for additional lockdowns and restrictions, that is abating. Now, I want to look next at some of the high-flying sectors. We've got energy and banks. So we'll start with banks. Nice two-day rally here. I'll show what's happening today. No need to get into a lot of specifics, just coming off of most of these guys just reported earnings. Here is the energy sector, kind of a canary because we weren't seeing it participate as much yesterday. It is today. So nice to see that coming back as well. I would be remiss if I missed out on showing everybody what's happening with meme stocks. Another solid run. We're seeing some of these guys come back. They've been struggling as of late when we saw this return to growth stocks. And just kind of round out with the sector action here. We have energy that's up 3%, financials up the second most, over 1%, then materials, tech, industrials, discretionary. Bottom line is we're seeing some pretty good breadth here, and that bodes well for the market. Only sectors in the red are utilities and healthcare, and then we also have real estate and staples rounding out the laggards. That is a bullish setup because those are defensive sectors. I said that was going to be the last, but guess what? We're going to take a look at Bitcoin here. Bitcoin trying to survive. It gets above 32,000. That is the first hurdle. Then we got to go for 35, but it is at the Rubicon right now. If it fails here, who knows? I've been watching it consolidate for a while, so I'm just going to hold my breath and see if we can climb above 32,000, guys.
Yeah, and as technical as we always look at that, at the cryptos, Jared, we got the big chat coming up, the B-Word conference. Kathy Wood, Elon Musk, and Jack Dorsey all going to be discussing Bitcoin later today. We'll be covering that in the afternoon hours here on Yahoo Finance Live. I want to shift our attention over to one other stock we're watching today after they reported earnings. That would be Johnson & Johnson. Shares slightly here in the green, beating expectations on the top and bottom line, revealing it expects to book $2.5 billion in sales of its COVID-19 vaccine this year. The company also raised its full-year earnings and revenue guidance. J&J now expects full-year profit of $9.50 to $9.60 a share. That was versus its prior forecast of just $9.30 to $9.45 a share. At least one study, however, has recently raised questions about the efficacy of Johnson & Johnson's vaccine, hinting at reduced effectiveness against the Delta variant, with some saying a booster might be needed. But earlier this morning, Johnson & Johnson CFO Joe Wolk defended the company's vaccine against those claims. Take a listen.
I think we all have to be just a little bit cautious on a test tube study that looks at one element of protection. You know, the data that I just referenced really looks at neutralizing antibodies as well as T cell activity for complete immunity protection. We know that that's very solid data, again, peer reviewed, as you noted. And I think it's really the responsible act to rely on health officials who have all the data at their fingertips.
And Akiko, we focus so much in on that pharmaceutical side of the business that includes the vaccine just because it's gotten a lot of the attention as of late, but not to be overlooked. You got also kind of the consumer unit, which has Neutrogena there, up 13% from a year earlier, as well as the medical device unit up 62.7% as some of those things that had been put off in the pandemic start to come back there. So don't want to overlook those pieces of the business either.
Yeah, it could be potential catalyst, but no question, all eyes have really been on the COVID vaccine and that part of the business. All right, coming up, the bipartisan infrastructure bill gets its first test in the Senate. Lawmakers looking to move ahead with a procedural vote this afternoon to start debate on that $1.2 trillion package. Rick Newman's going to walk us through the state of play on the other side. We'll be right back. Well, the bipartisan infrastructure bill looking to get its first test in the Senate this afternoon. Lawmakers were looking to move ahead with a procedural vote this afternoon, but could Senate Republicans potentially be looking to stall the vote? Let's bring in Yahoo Finance's Rick Newman. And Rick, I guess that's sort of what the Democrats have alleged, right? To say that, well, Republicans are saying, well, they want a little more time to write the bill. Democrats are saying they're trying to stall and derail all this. What's actually happening?
Yeah, there's a lot of posturing going on. So to figure out what's really going on, this is not even a vote on an actual bill. The so-called bipartisan bill doesn't exist yet. So this is a vote on procedures, and this is basically to determine whether it will be possible to vote on a bipartisan bill, which requires 60 votes, in other words, at least 10 Republicans joining 50 Democrats to pass to overcome the filibuster, or if this thing just falls apart, the bipartisan thing just falls apart. And if it does, Democrats would then move forward and just do their own bill, but that would be 5 to 7 times larger than the bipartisan bill. So one way or another here, we're probably going to get this infrastructure spending. The question is whether we get it in 2 bills, one a smallish bipartisan one, and then a much larger Democratic one to follow that, or if Democrats just lump it all into one gargantuan bill that would just pass with Democratic votes and then have to go through the so-called reconciliation process. So again, what's happening this week is a lot of posturing that's basically going to determine how this gets done in coming weeks and months.
I mean, I guess that begs the question, Rick, what was that photo op over at the White House when we had Republican and Democratic lawmakers meeting with the president? I mean, ultimately, where does the president stand? You sort of broke it down into where the lawmakers want this infrastructure bill to ultimately go, but what is he likely to sign off on?
I think Biden is actually in a pretty good spot. He wants voters to think that he favors bipartisanship and that he is able to work with Republicans. That is a big part of how he ran. That helped him get some centrist and independent votes that put him over the top last November. But if that doesn't happen, Biden is still likely to get a lot of what he wants through this Democratic-only bill. So there are, the question is, do these senators actually care about bipartisanship, or do they only care about making voters think they care about bipartisanship? And it's probably a mix of both. So there are still a few members of Congress who want their voters to think, yes, they can do bipartisan things and make deals. But for the most part, that is not what's going to happen here.
And meanwhile, you've got infrastructure investments sort of on hold, right? So we'll continue to watch.
The investment is probably going to come because, I mean, for Democrats, it's almost as if they need to go through this bipartisan exercise, almost as just cover, so that if it doesn't happen, which I think is the most likely, I think it is more likely we will not get a bipartisan bill than we will, then Democrats can say, we tried. And they do need to bring on board those moderates we keep talking about, Joe Manchin from West Virginia, Kyrsten Sinema from Arizona. And those, senators like those, there are a few of those. They need to be able to go back home and say, we tried to get a bipartisan bill and we just couldn't get Republicans to go along with it. So once they have done that, that sort of provides the top cover for Democrats to lump everything into a very large infrastructure bill.
We'll continue to follow all the back and forth. Rick Newman giving us the state of play. Thanks so much for that. Coming up, devastation in China as record rainfall and floods kill more than 24 people in the central region. We're going to have that along with other stories in our worldview after the short break. you today, at least 25 people have died in China after record rainfall triggered flooding across central China's Henan province. A majority of those deaths occurred in the capital city of Zhengzhou, where rising waters trapped passengers inside a subway line. Images on social media showed people hanging on to ceiling handles as they tried to keep their heads above water. Roughly 100,000 people have now been evacuated, with roads and train lines disrupted, while the military has been deployed to help with rescue efforts. More than 24 inches of rain fell in the city between Saturday and Tuesday. That is the equivalent of its annual average. More rain is forecast across Henan for the next 3 days, and scientists say the extreme weather is almost certainly linked to global warming. The Tokyo Olympics are officially underway, even as more athletes test positive for COVID-19. The Summer Games kicked off with women's soccer, where the U.S. suffered a stunning 0-3 defeat against Sweden. In women's softball, both Team USA and Japan won their opening games. Meanwhile, nearly 70 athletes and Olympic personnel have now tested positive for COVID-19, including a member of the U.S. men's beach volleyball team. The opening ceremony is set for Friday, where organizers say the event will be scaled down to, quote, match the mood. And Australia is set to host the Summer Olympics yet again. The city of Brisbane was officially picked as the host of the Games in 2032. The city celebrated the announcement, but it wasn't much of a surprise. The IOC gave Brisbane exclusive negotiating rights back in February, making this a one-city race. The Games returned to Australia 32 years after the Sydney Games in 2000 and Melbourne hosted back in 1956. Coming up, a conversation with the CEO of SAP on his company's outlook as we see the stock slide in the session. We'll be right back. Shares of SAP are sliding in this session, despite the company raising its outlook for the second time this year. Brian Sozzi has that story for us, along with his conversation with the CEO of SAP. Brian.
Thanks, Akiko. Yeah, you're seeing SAP shares under pressure here. The company raised its full-year sales outlook, raised its operating profit margin outlook, but still looking for operating profits to fall this year. That margin is going to be under pressure. I caught up with SAP CEO Christian Klein to talk about the quarter and the company's outlook.
It was a fantastic quarter again for SAP. Actually, it was now the third quarter in a row, which was very strong. We saw the highest order entry growth in half year one since 5 years, all organic. Our cloud backlog actually also accelerated again to 20% to almost 8 billion euro, which is the leading indicator for further cloud revenue as acceleration in half year two and next year. So yeah, our cloud business is stronger than ever, and our customers follow the new strategy and they want to transform their business with SAP.
Talk to us about the pivot you are making to the cloud. This has been ongoing since you took over as CEO. What inning are you in?
I mean, when the two of us met in Davos, so it was actually COVID was just, actually coming up in China, and then it actually, went through across the globe. And in this crisis, many customers just, also acknowledge that the digital transformation is without any alternative. And actually just the move to the cloud is not enough, because you're not transforming any business by just moving your IT landscape to the cloud. So our new strategy and our new offering, which we launched just in January, is actually saying we move you to the cloud, but we also help you to transform your business. We are changing your sales from traditional sales to commerce. We are making your supply chains more resilient. We are enabling the future of work. And this is what our solutions do. And we do this in combination. And RISE with SAP is actually also the main driver for our accelerated cloud growth now in half year one.
What did this quarter tell you about the state of the global economy? Lots of focus right now on the COVID Delta variant, how it is impacting U.S. economy, the European economy. How do you see it from where you sit?
Yeah, in my conversations with many CEOs around the globe, yes, indeed, I also see that there are increasing concerns about the Delta variant coming up, increasing infection rates here and there. I mean, for the technology sector and for SAP especially, I'm still really optimistic, because our technology helps to overcome the pandemic. For example, we developed here in Germany our tracing app. We are helping our customers to join the business network to create more resilient supply chains. We are helping them to flip the business model, and they are aware that they have to do that to actually emerge stronger out of the crisis.
Does it look to you, though, that the economy, the global economy, is slowing down versus second quarter, given these concerns?
From what we see in the technology sector, absolutely not. I mean, our pipeline is stronger than ever. We just also raised our outlook. From what I see, of course, in certain industries, for example, with the chip shortage, that could, of course, also have an impact on the economy in certain industries. But for the tech sector, I'm super optimistic.
This segment before I came in here reminded me that I need to put some expenses into Concur. You own Concur. How did that business do in the second quarter? Are you seeing some stability back in the business?
Yeah, look, it's time to travel again. I started to travel again also now in the last few weeks. I see many more CEOs and customers who also now want to meet in person. Obviously, it's not comparable to the level before the pandemic. This will take time, but we also saw in Q2, signs of recovery. We expect that to continue in half year two. And next year, actually, we're already expecting that our Concur business will be back to the levels before the pandemic.
What about, just staying on that thread, what about the U.S. business? The U.S. is your largest market. Are you back to pre-pandemic levels there in the cloud, in Concur, and other lines of business?
Yes, especially I'm very positively surprised about our market development in the US. The order entry was the highest in North America compared to all of the regions. It's also the highest base what we have of cloud revenue. We have by far the most customers there. We see high level of spend in IT. And of course, we see many industries also in the US where also the public sector now is also granting funds to further accelerate the transformation, which also helps at the end SAP.
So in the guidance today, you raised your full year sales outlook, raised your full year operating profits, but profits, I imagine if you're going to get some pushback in the quarter, it would be operating profits, still expected to be flat to down 4% in constant currencies. Why is that? And when might that return to growth?
When we pulled off the strategy last year, we actually said we want to follow our customers and they actually moving to the cloud. And for SAP, this means a business model shift. We are actually also changing upfront software licenses versus ratable subscription revenue streams. On a long term, this model has a lot of beauty because you have a larger recurring revenue share, which gives you a lot of stability. Short term, of course, this is impacting your profit because you're not realizing your revenue upfront. But also our commitment is that starting 2023, once this transformation is completely done, we will also see operating profit increasing by double-digit growth rates again.
Are you still on track to hit an 80% gross margin by 2025?
Absolutely. We are doing our homework. Every piece of software what we develop in the cloud has always in mind that we need to also scale the solutions. Our customers just expect the most resilient, the most secure cloud solutions, and we are pulling a lot of efforts in. We are still consolidating, the acquisitions and bring them on one infrastructure. We are partnering with the hyperscalers, which is also a competitive advantage against some of our competitors. So we are absolutely on track, and we are very confident to hit the 80% gross margin. Yes.
SAP has over 103,000 employees globally. That was up 2% year over year in the second quarter. Are those employees back working in the headquarters, and what's your philosophy on that?
The picture is pretty different when you go region by region. In Asia, a lot of offices are already open. In Germany here, for example, in Europe, we are opening up. In the US, the same. Latin America is still very impacted by COVID, so it's a mixed bag. But of course, going forward, we also use our own technology to feel the pulse, to feel the sentiment of our employees with Qualtrics. And what our employees are telling us, they actually like much more a hybrid work environment. So they see moments where it's better to work from home, but they also need, certain situations where you need to be in the office. So we actually made a commitment to flexible work. We trust our employees, and we also feel that this will help us to attract even more talents from the industry to join SAP.
Do you want to see them back in the office, though? Is that helpful to see them?
As I said, in sales and consulting, it's actually even better when they're with the customers, when they're out there. But in development, for example, it's a different bag. Sometimes you can also, work from home. You can code from home. But also there are certain sessions on design thinking. When you talk about the next generation of innovations we're gonna release, this is the moment where it's also good to be in the office. So we give this responsibility to our employees because they will decide best, what is good for SAP and what is good for our customers.
So top takeaway there, Akiko, get those expenses into Concur. You cannot outrun the machine that is Concur.
Oh, I have nightmares about Concur sometimes, Brian. I don't know. I'm not the best with
Don't we all?
expenses. I think my bosses will probably attest to that. And Brian Sazi bringing us that interview. Thanks so much for that. Before we head to break, you can step up your investment strategy with a free 14-day trial for Yahoo Finance. Plus, you can get expert research reports, actionable investment ideas, advanced portfolio tools in an ad-light experience. Check it out today at yahoofinance.com/plus. Coming up, a renaissance in space exploration. One day after Blue Origin's successful mission to the edge of space, we're going to be talking to the CEO of Virgin Orbit to discuss the rapid advancements he sees in the space race.
Who wants a Skittle?
Oh, yeah. Turn one.
With your arm, I'm going to pull you down. All right, see if you can catch this in your mouth. Yeah, well done.
That video never gets old. You are looking at images from inside Blue Origin's New Shepard capsule yesterday, following the successful launch into the edge of space. Jeff Bezos' mission, just one of many firsts that what you have seen in space exploration over the last several weeks. Virgin Orbit, which is a satellite launching arm of Virgin Galactic, it just sent its second mission of the year into orbit last month. For more on that, let's bring in Dan Hart. He is the CEO of Virgin Orbit, joining us from Long Beach, California today. Dan, it's great to talk to you. And before we start the conversation, I always feel like it's worth reminding viewers about where exactly Virgin Orbit, or what exactly Virgin Orbit does, because you are under the Virgin Galactic umbrella, but you're on the satellite launching arm, not the space tourism side of things. Having said that, I am curious to just get your thoughts on what we have seen transpire over the last 2 weeks. Your boss, Sir Richard Branson, going out into the edge of space, followed by Jeff Bezos. What is all this? How are you viewing all of these firsts that have happened, and ultimately what it means for what you are trying to accomplish in space?
So, first of all, a clarification: we are actually a separate company from Virgin Galactic under Virgin Group. But as far as the overall activity in space, I mean, if you look broadly, there's an enormous amount of innovation and movement forward in space. As far as space tourism goes, we're a close-knit community in the space community, and it's great to see colleagues successful. It's great to see leaders taking leadership roles and going first. And it's great to see the joy of the experience of just beaming out. I was with Richard in New Mexico when he flew, and it was just palpable, the concentration of joy and excitement there. I think you could see it from space.
And kind of interesting to see the way that these companies, different companies, are tackling the space race, if you want to call it that, in different ways. And your guys' kind of custom launch technology and the modified plane to get the rocket up there. I mean, when we talk about what that does for Virgin Orbit and the way you guys work to kind of put satellites into space, talk to me about what that model does to separate itself from the other competitors out there now on the satellite side.
You bet. So, our focus is putting a new generation of satellites in orbit. And satellites are really the workhorses for space. They're the items that connect us, tell us about our planet, bring information, connect machines. Our system is an air launch system, as you mentioned. So our rocket, which is right behind me, doesn't have to do any work until it's already at 35,000 feet and going the better part of Mach 1. So that makes for a more flexible system. It makes for a more efficient system. So more efficiency, lower cost, higher flexibility. We get our green light to launch from the airport tower and can turn any airport around the world into a spaceport instead of being connected to Cape Canaveral or Vandenberg Air Force Base or somewhere like that.
And Dan, we're looking at images of Launcher One rocket, which of course is designed to carry these small satellites into space. It's been fascinating to see how quickly the technology has evolved on that front. And as you look ahead, not just to the second half of the year, but next year, how quickly are you looking to ramp up activity on that front? And ultimately, for those who are watching this, what does that all mean for the viewers?
Well, the team, I could not be prouder of this team. In 13 months, we performed our first 3 launches. We had 2 brilliant commercial successes, putting satellites up for NASA, for international governments, for the commercial sector, and for the DoD, covering all sectors. So it's been an incredible year already for us. We have another launch that's coming up this year. We'll then be doubling our launch rate next year to 6 launches, or maybe a little bit more. And then we will more than double that going forward. So you can see there's a stack of rockets behind me in the factory, and the factory is just burgeoning and moving forward.
And we've had several reports here about the company looking to go public through a SPAC that would value Virgin Orbit at $3 billion. What does the timeline look like on that front?
Well, that's an area I just can't really comment to at this point. But our focus right now is just moving the business forward.
Okay, we'll have to leave it there. Hopefully have you back on when the official announcement is made. Dan Hart, Virgin Orbit CEO. It's great to talk to you today. Appreciate the time. Coming up, we are talking about longer commutes in exchange for lower prices, the new priorities for home buyers as they look ahead to a post-pandemic world. That discussion, part of our hot takes on the other side. New home buyers are increasingly prioritizing lower prices over longer commute times. That's at least according to new analysis out from Zillow. The Wall Street Journal is reporting that home prices in areas with longer morning commutes to business hubs actually rose faster than neighborhoods with shorter commutes. And Zach, here's an interesting stat because they looked at, in this journal story, the Boston metro area, and they found that in this 2-year period that ended in May of this year, home values in neighborhoods with a 70-minute commute rose 30%, as opposed to 9% in areas that were a little closer. And I guess this kind of speaks to the new work environment too, because we've been hearing more and more companies that are using this hybrid environment to say, you may not have to come in 5 days a week anymore, maybe 2 days at home or 3 days at home and 2 days in the office. And that, I would imagine, changes the whole calculus of where you want to live.
Oh, yeah, for sure. And I mean, it's not just Boston. I mean, we've been seeing that play out over here in Texas and Austin for quite some time as kind of the home prices in those pretty far out neighborhoods. Some might have said too far just a year ago, but not the case anymore. We've seen prices skyrocket there. And, you know, you do wonder, I mean, obviously it could be a short-lived thing. We keep talking about maybe companies taking longer to get people back in the office than what the expectations were. We saw Apple announce a delay in getting employees back to the office. But at some point, you know, you can debate the new normal there versus what we saw pre-pandemic, but you do have the idea that maybe you're going to eventually have to get back into an office, and that commute, though you might be doing it less, still going to be long. So you do wonder how much longer some of these changes might hold when it comes to those farther out neighborhoods seeing these price gains. But it is something we have seen not just, you know, regionally, but pretty much across the board, no matter what city you're looking at.
Yeah, you're right. I mean, even if you don't have to go in 5 days a week, you do have to commute in weekly at some point. So, what that payoff is, I mean, that's something that home buyers clearly have to sort of determine what the priorities are. But it does sort of jive with the trends that we've seen in home buying, which is during the pandemic, we saw so many people move out of the cities, which I imagine would have a much longer commute time. Zach, one of the things that struck me in this journal article, though, they point out commute times, average commute times to work in the U.S. 27 minutes in 2019. That's up from 25. I mean, I don't know. Maybe we just live in areas where there's a lot of traffic. 27 minutes doesn't seem that significant to me, if that really is the average. But maybe I'm looking at this all wrong.
Yeah, I mean, you're talking if you're looking at people in LA and San Francisco, I know New York has always been maybe traditionally not the best of commutes, but it's always been one of those things that's tied to happiness, right? The commute time is always a large variable in how happy you are. And I think that's probably why we've seen, some people not want to go back to the office, because then once that aspect completely disappeared from their lives, it's tough to add it back in. As you lose time, especially if you're driving. That is one thing that you flex over other cities out there. If you're able to ride the subway, you're able to get some work done on there. You don't have to worry about driving. Maybe that's also why people are so amped up about their self-driving Teslas when they get behind the wheel of those. But I mean, it is something that I think it's going to be something that we're watching closely here. If you're a realtor out there and you're trying to flex that for those outer cities, that is definitely something where you might fall on the other side of the camp and say, look, you're never going to have to worry about commuting. You can live out here in these far-flung neighborhoods, and you're going to try and stretch that for as long as you can and run with it. But it is interesting to see it all play out and how it's impacting things. We'll see how long that lasts. We're going to take another quick break here on the show, but when we return, digging back into the earnings reports we got out to discuss today, Netflix shares off more than 4% off the wake of weaker than expected subscriber forecasts for Q3. We'll break that down on the other side. Stay with us. welcome into Yahoo Finance Live as we cross the noon Eastern Time trading hour. I'm Zach Guzman alongside Akiko Fujita as we have this relief rally continuing for a second straight day after Monday's big sell-off. The NASDAQ right now hitting new session highs here, up more than 0.5%. As you see the Dow, the biggest gainer there, up by about 0.75%. We got big earnings here to talk about, perhaps delivering another wave of confidence for the market. Not the case for one individual stock, though. That would be Netflix. Argus research analyst Joseph Bonner is going to be breaking down his bull case despite the weaker than expected update we got from Netflix for Q3 subscriber growth. Plus, the largest ever private funding round in crypto as exchange FTX rakes in $900 million from the likes of Sequoia, Coinbase's venture arm, even Paul Tudor Jones's office getting in on the mix. CEO Sam Bankman-Fried will join us for more on what he plans to do with that major windfall. And after a year of isolation, so-called cave syndrome that has people afraid to get back into crowds, well, you're not alone, and why the phenomenon could weigh on a full return for some hard-hit industries. But first, let's start with the second day of this relief rally. Right now, the S&P 500 is about 18 points above where it was at Friday's close, almost as if Monday's major sell-off never even happened. But for more on those jitters and whether or not we're in the clear fully, I want to bring on our first market guest in the back half of today's show. Willem Sells, HSBC Private Banking and Wealth Global Chief Investment Officer, joins us right now. And Willem, I mean, when we look at it, a complete reversal in the VIX. I'm not sure if you're able to say we're out of the woods yet, but how are you looking at kind of what happened on Monday versus the relief rally we have now?
I think I'm with the people today, actually, with the action today. I think on Monday, there was a little bit too much concern around rising COVID cases. We do continue to remain optimistic about the consumer. The labor markets are good, and the reopening continues to happen. And then the equity markets were trying to make sense of what the bond market was doing. The treasury yield drop, but that has more to do with structurally low yields, the inflation that is temporary, and then obviously position unwinding. So I wouldn't read the treasury yield move as a sign that growth is about to stall completely. So we remain optimistic, with earnings growth continuing here and the Fed being very gradual.
So, Willem, in hindsight, how should we be looking at the sell-off that we saw on Monday? Was this just kind of a necessary correction, a bit of a shakedown that was needed in order for the market to move a leg higher, or you think it's sort of symptomatic of what's more to come?
Well, it was actually quite helpful because to some extent, we've actually had quite a decent positioning adjustment in the equity market, taking some froth out of that positioning in terms of the most levered or the most risky trade positions that were on there. Maybe a little bit of profit taking as well in the biggest consensus calls. So if we can now continue to look at fundamentals more, then those fundamentals, as I said, are positive. You will have, continued economic growth, albeit with a little bit less momentum, right? I mean, some of the PMI indices have come down a little bit from very high levels to high levels. That's still very supportive, and that means that the risk of overheating is less. The Fed can go slow, so that's a good mix for riskier assets.
Yeah, that was one of the dynamics we were discussing yesterday is whether or not kind of the blip, and who knows if it's going to just be a blip or whatnot. But when you think about maybe those concerns around the Delta variant and the reopening here in the U.S., whether it might be a little bit of a relief on the pressure that the Fed was facing, perhaps moving too quickly, and whether or not they could wait a bit more if you think about a potential slowdown to the rate of the reopening and what the economy has been experiencing, particularly on the inflation front when it comes to airfare and some of those other things that have shown some pretty high snapbacks in prices. What's your take on maybe how it could buy the Fed just a bit more time to maybe start tapering or starting to unwind off their accommodative stance?
I think that's fair. The if you become a little bit more cautious around the economic outlook, then you have to become a little bit more dovish around the Fed outlook. And I think that's what the bond market has been doing over the last few days. Is they had become a little bit too hawkish and pricing in too many rate hikes in the very short term. Now they're taking those out. So for an equity investor, it's two sides of a coin, which
therefore sort of compensate for each other. With regard to the Fed, we do think that they can be slow. We think inflation will actually remain around the current level, core inflation, up to potentially the year end and going into the first quarter of next year. But at least it shouldn't accelerate further. And there is still no real sign that these inflation pressures will be durable. Where we are seeing inflation is very much in those areas that have to do with reopening, that have to do with bottlenecks, etc., but not yet feeding into things that become much more systematic. So I think the Fed can still stick to its view, and we stick to our view that inflation pressures are temporary, and therefore that they can be very gradual in their approach.
And real quickly, lastly, before we let you go, I mean, we've seen that kind of trickling through other people's forecasts for the back half of the year. Fundstrat notably kind of rotating back into the idea that some big tech stocks could carry the growth in the latter half of the year. I mean, how are you looking at maybe how right now would be a good time to readjust portfolios, perhaps to lean bigger into tech? What are you seeing for sector strength in the back half of 2021?
So you have had yo-yoing between the performance of value and growth this year, but basically year to date they're almost flat relative to each other, and that's because that relative performance is very much a function of the real yield, and the real yield to us remains very low, again determined by the Fed to a very large extent. We buy tech from a longer term perspective, and that's not just the IT sector, that's automation, that's health technology, that's cyber technology. You need to think outside of the box, and if you think about that longer term, then you're somewhat less sensitive to the gyrations of the bond market.
HSBC Private Banking and Wealth Global Chief Investment Officer Willem Sells. I appreciate you hopping on here to chat with us today. Be well. I want to turn back over to one individual mover we're watching in today's session as we got updates on the earnings front. It's a standout as it's under pressure today. That would be Netflix, seeing shares decline by about 4%. We got the update there that Q3 subscriber growth forecasts look a bit weaker than expected, but the company did give an update in terms of what it's thinking of pursuing around its gaming entrance as they try and add games to the platforms. And for more on that, I want to bring on Yahoo Finance's Dan Howley, who was listening for details last night. Dan?
That's right, Zach. They're going to move into what they said is mobile gaming first. And really, it's not their first foray into gaming. They do have one or two titles tied to the Stranger Things franchise, but they never really blew the doors off of the gaming industry. And so they seem to want to focus on games for iOS or Android. I think the better question, though, is they want to use this as a form of increased subscriptions for Netflix, as well as retention and engagement. The issue, though, is if you have an app on, say, iOS or Android, how does that get you then to go back to Netflix, right? Just because you're playing a game that may be tied to, say, Stranger Things, doesn't mean that once you finish the season of Stranger Things, you're going to go back and rewatch it. I think that that's one of the issues they're going to have to come up and deal with. And so some of the experts that I have spoken to have really said, look, there's a handful of ways they could handle this. They could try the kind of cloud gaming platforms that we've seen, but those are incredibly difficult. The only company that we're really seeing able to do that is Microsoft at this point, and even that isn't full blown yet. Google has struggled heavily there. Amazon still in a beta phase for their own Luna. We've seen NVIDIA. They kind of are still struggling there. And there's a few others. I think one of the big issues for this cloud gaming aspect, though, would be how much bandwidth it would take. HD Netflix is already a monster, or 4K Netflix, rather, is already a monster at 25 megabits per second. That's a lot for a lot of households to be able to handle. So that would be something very difficult. The other issue then is, okay, if you go into AAA games where you launch on something like a PlayStation or an Xbox or a Switch, how much do you put into that? Those games are not easy to build. They're 4 and 5 years to develop at least. That's no guarantee for success. We've seen companies try to get into gaming with their own studios. I'll look at Netflix and Amazon and Google again. Google launched its own Stadia game studio. They've shut that down in less than 2 years. Amazon has released 2 games that they've pulled back and canceled because they weren't successful enough, and they're struggling on a new one that they're hoping to release. So this is not an easy category to get into. If you do something along the lines of a putting games on Netflix itself. Well, what kind of games do you put on there? I know we had Michael Pratcher on earlier discussing how do you even control them, and that's a very good point that he brought up. The controllers for these kinds of games. If you have a Netflix, you have it on your smart TV, you have it on your Roku, your Fire TV, your PlayStation. What do you use to control that? So I think this is going to be a very difficult journey for them. But if they do manage to pull it off, it could pay off enormously. I just don't know if it's really going to be a huge growth opportunity for them based on what they're trying to do for the primary Netflix platform.
All right, Dan Halley breaking down the initial read on the gaming update we got from Netflix yesterday. Let's broaden that discussion out just a little bit more here. Argus research analyst Joseph Bonner joins us now for more on that. And Joseph, you just heard Halley kind of walking us through the expectations there for what Netflix might be looking to do. And you're going to price target of $650 on Netflix with the buy rating here. How much of a boost are you expecting from the gaming initiative, or is there enough there that Netflix has been able to prove so far on the streaming side that it might not matter?
Right. Well, do I expect much of a boost from gaming? No, frankly. And if you think, we both listened to that call last night from management, and they don't expect much from gaming right now. Gaming is a trial at the moment. You got to remember that this management has a kind of an iterative management process. They're going to trial something. They're going to start small. This is not going to be a big factor in the near term for sure. And you're talking many years out. I think, what they're trying to do with gaming is to, again, make that subscription stickier, attract new subscribers. That's the theme that management talks about all the time. And that's what they're laser focused on. Getting back to the second quarter, I'd like to boil that down to just one number. The companies release lots of numbers, but just that loss of 430,000 subscribers in the United States and Canada. I think that's really what the market's looking at today. Mm-hmm. And it's fueling a bit that kind of the fire of that investor debate around is it increased competition in streaming video? What's causing that loss? We had all these new streaming services, Disney Plus, HBO Max, Peacock, Paramount, Discovery, all launching in the last couple of years, all launching in the U.S. And there's a debate there. Management has lots of reasons why. That second quarter.
How do you view that headwind, though? Is it really about increased competition in the space? Is it about maybe the lack of content as a result of some of the production shutdowns that happened during the pandemic? What can you point to that you think suggests why those numbers came down, at least in North America?
Sure, you're right. The new releases have been sluggish due to the content shutdown, and you got to remember that the second quarter is seasonally weak. You go back to 2019, washing out the COVID stuff. They lost 100,000 subscribers in the second quarter of 2019. So there's that. There's economic reopening noise. People doing other things right now. So there's a lot of other reasons why the second quarter was particularly weak.
Yeah, I almost wonder if the gaming piece of all this might be a distraction from what looks to be, that slowdown. You look at Q3 and that coming in well below what analysts were expecting there. Having gaming to talk about would be a kind of a nice distraction rather than focusing on 3.5 million versus 5.86 million, and whether or not that is a result of competitors kind of stepping up their game here. How does that maybe start to need to be something that we're talking about if you think about how Netflix really benefited from not having to spend so much on content before, and financials had always been kind of the biggest thing that people harped on who were, not necessarily fans of the stock. Where do you see it going when it comes to competition moving out of the pandemic and how costs could start to rise?
Sure. So costs will rise as production rises. That's going to happen. You have to remember, though, that they also added 300 basis points of margin in the last year. So that's a pretty good metric there. We will have to see, from the other services how they report. But you have to remember that my thesis is that Netflix is the number one at 209 million subscribers. They are the incumbent in streaming. They're kind of the anchor tenant here. They had that first mover advantage in the United States and international. We'll have to see this play out. And, I'm more looking at, instead of a weak second quarter, the fourth quarter is really going to tell. They usually come back in the third quarter and build into the fourth.
It isn't worth noting, though, we have seen sort of a slowdown in the momentum in those like Disney Plus as well. So just so much growth that we saw last year during the pandemic. But we're going to continue to follow this story. Joseph Bonner, Argus research analyst, it's good to talk to you today. Let's turn our attention to one stock that is taking a big hit in the session, and that is Harley-Davidson. You see that stock sliding more than 7% right now. Inflation worries certainly weighing on the shares there. Supply chain concerns and soaring costs of raw material sort of dampening the outlook for the second half of the year for the company. Those headwinds already shaved off about 5% from the motorcycle makers' profits in the quarter that they just reported. Now, Harley did report earnings that were 16 cents above estimates. Also, revenue grew 77% to $1.5 billion. Retail motorcycle sales increased about 24% with a growth of more than 40% in North America. So it's big growth here in the U.S. and Canada. Now, the company did say shipping delays are likely to contribute to delays in deliveries of these bikes, especially in Europe as well as Asia. So, Zach, despite the strong numbers they posted in the quarters, it certainly feels like the inflation worries are really taking over the stock today, with it down nearly 8% now.
Yeah, steep drop there. And again, the emphasis being on what you can do in the next couple quarters, how you're positioned, particularly around all those, not just supply chain issues, but inflation worries as well. We're going to take another quick break here on the show. When we return, stacking up all the fines that Robinhood has started to pay or expects to pay here. The latest one around anti-money laundering concerns, and the $30 million they are expecting to pay there. You start adding it up, significant chunk of its Q2 revenues they just reported. We'll break down how that stock's faring up ahead of the IPO, the excitement around Robinhood's IPO. We're back in 2. Welcome back to Yahoo Finance Live. Earlier this week, Robinhood, ahead of its much anticipated IPO, disclosed that it was expecting to pay about $30 million as a fine to settle a probe into potential conflicts around anti-money laundering when it comes to their crypto arm here at Kiko. And when you look at that fine, I mean, you start stacking these up, $30 million for that, as well as we talked about before, the $70 million fine for FINRA, $65 million settlement with the SEC for payment for order flow issues. I mean, that's $165 million across those three fines. That's about 30% of the revenue they showed for Q2 here, which, you don't expect these fines to keep happening, hopefully not, as the company matures past the IPO. But you wonder how much that overhang might have cause for concerns here on the mind of investors as the company looks to IPO here. I mean, 30% of Q2 revenue, that's nothing to sneeze at.
And that's a long list that could potentially be growing. We've got our very own Alexis Keenan, who has a story out on the regulatory hurdles that the company faces. And she's talking about at least 50 proposed class action lawsuits stemming from the meme trade and what happened there, too. So the regulatory risk, as well as any lawsuits that can come with what transpired around GameStop. I mean, that is a big overhang for a company that has said in their S1 filing that while they saw explosive growth in the first half of the year, things could potentially be slowing down. And Zach, we talked about this a few days ago when I was looking through their filing. One of the things that stood out is, number one, the company's estimating a net income loss between $537 million and $487 million in Q2. But when you think about where the big drivers have been, options trading as well as crypto trading, Robinhood says a slowdown may be coming on that front as well. So it makes sense in many ways for the company to come to market right now. We're expecting the shares to begin trading next week. But remember, they wanted to come to the market even earlier, but that was held back because of some of the regulatory investigations that are happening. So to the point you made, I think earlier this week, you have to wonder if they've sort of missed that prime window, at least in listing publicly here, because that list, I would imagine, is going to get longer.
Yeah, well, luckily, I mean, if there's any silver lining here, we have seen the volatility that kicked off on Monday at least come down a bit. So maybe not going to be in that pocket of turbulence if they do come out relatively soon. But you're right. I mean, the concerns and the overhang here is definitely something I wonder how much pause it will be when we think about payment for order flow. In the first quarter, it was 81% of the company's revenue came through payment for order flow. And you have it coming at a time when the SEC is talking about that being a major focus, not just for Robinhood, but for other companies that are doing it as well, whether or not there is conflict of interest around the way that these companies are making money off of processing customer trades. And of course, that's why the SEC went after them with that original fine. It was kind of the way that they were framing some of the way they were communicating that to customers. And now everyone knows about payment for order flow. And we've heard Congress talking about payment for order flow. And you just wonder if you are a company out there that makes that much as a percentage of your revenue from something that is now getting so much attention. It does definitely dampen the excitement for Robinhood coming to public markets. But of course, they're making their ways around that, and they're trying to steam up some excitement from retail traders, even customers on the Robinhood platform. And I do wonder how much, that excitement we saw earlier in the year, how much the retail trade matters. I think we might get another look at how much, the retail trade matters when it comes to an initial IPO pop in the case of Robinhood, since they were public enemy number one when it comes to payment for order flow.
Yeah, I mean, Robinhood does kind of address that in their updated filing, which is to say that despite the explosive growth that they saw around the GameStop squeeze and then, the other meme trades that transpired after that, there are questions about how many of those who opened those accounts will remain. And they specifically say if those users don't grow their deposits or trading frequency, our ability to expand and grow a relationship with these customers will be impacted. So there is a bit of a warning there on a potential slowdown. Of course, you could argue if you are looking to buy into the stock, well, it's tough to match up to the kind of activity you saw early on in the first half of the year. And Zach, finally, you mentioned sort of the brands of Robinhood. They've talked a lot about democratizing investment. They're staying true to their brand. They're going to be having a roadshow for the retail investors, a public one this Saturday. So it'll be interesting to see how many people tune in and eventually decide that despite everything that's happened, they still think this is a good investment.
An hour-long live stream, July 24th, CEO Vlad Tenev, who of course has been on the show. I respect it. I respect it. Going to the people, the road show out there, what is normally, dwarfed in secrecy in locked boardrooms, now coming out for the people who might be able to get in on the IPO itself. It's an interesting, break from tradition. We'll see how it all goes. But Robinhood coming to market with some different context relative to where we were thinking we might be last year. Coming up, though, we're going to be taking a quick break here. On the other side, discussing the deal between Salesforce and Slack closing that $27.7 billion monster. The latest there as the companies come together. Our own Julia LaRoche will break down the details on the other side. Stay with us. Well, it was Salesforce's largest ever acquisition, a $27.7 billion monster deal to take over Slack, clearing the hurdles of a look by the DOJ, and now officially closed. And for more on what it takes, what it's going to take to get these companies chugging on all cylinders here now that the deal is officially closed, I want to bring on Yahoo Finance's Julia Roche with the details around where the companies go post-deal. Julia?
Well, that's right, Zach. Quite the anticipated record deal for Salesforce here, that $27.7 billion acquisition of Slack. And it really speaks to the big bet that Salesforce is making on the future of work, which, as we have talked to CEO Mark Benioff about several times on our air, is one that will be one where you can work anywhere in this all-new digital world. We did get some commentary from Mark Benioff just a few weeks ago on our air as to what this integration with Salesforce might look like on its journey to become not just the #1 CRM, but the #1 enterprise applications software company. Take a listen.
But we're going to do one more important and exciting thing, is what you're saying, is we're going to rebuild all of our technology once again to become Slack first, to help our customers have a harness to work in this new world where you're working at home, you're working in the office, you're working at events, you're working anywhere.
One thing I'll note, it was interesting in Mark Benioff's annual letter, just kind of giving a little bit of insight on the integration of Slack and how it's helping Salesforce work well. They were seeing a 26% increase in, or decrease rather, a 26% improvement in their case close time rate for their Service Cloud, which is an interesting stat because when you think about it, when you go across their enterprise applications, what that might mean, but maybe even more importantly, Zach, is what it will mean for the thousands of customers. And when you think about Salesforce, wow, they really do know how to sell and sell in a major way. You have an incredible sales team there. So think about what that could look like when they start to bring some of these applications into Slack. And if you see more companies embrace that more hybrid model of work, it's certainly an area to watch. Zach?
Hey, you always wonder too. I mean, you think that all the hard work goes into finding a target, getting the deal approved. Now there's the extra hard work of getting the end result, the improved efficiencies here on the other side as Salesforce combines with Slack. But interesting to see it all come together. And I know Julie LaRoche, appreciate the update there. You're going to be discussing a little bit more here in terms of where these companies go later on our air discussion with President and Chief Operating Officer Brett Taylor, joining her later on Yahoo Finance here at 3:15 Eastern Time. Do not miss that as we continue to learn more about how these companies will integrate with each other. Coming up, more excitement in the crypto space as we got the largest ever private funding round coming for FTX, the exchange that's been raising a lot of eyebrows, raking in $900 million from the likes of Sequoia and other big names in the VC space. Stay tuned. We'll have a discussion on that with CEO and co-founder of FTX, Sam Bankman-Fried, joining us on the other side of the break. Stay with us. Welcome back. Crypto and the sector as a whole has a new reason to celebrate when it comes to enthusiasm for the space, and one company in particular has 900 million reasons to celebrate. the largest ever private crypto funding round coming for FTX, the crypto exchange led by Sam Bankman-Fried, that now sees its valuation up to $18 billion, a far cry from the $1.2 billion valuation it had just about a year ago. And for more on the deal, I want to bring on the CEO and co-founder of FTX, Sam Bankman-Fried, joins us once again. And Sam, appreciate you coming on here, man. I mean, you attracted money from a lot of big name investors, SoftBank, Sequoia, Coinbase Ventures, Paul Tudor Jones, even getting in on the deal, plus a lot of others. 900 million is a lot of money. I mean, what are you looking to do with it now that you have it? Because FTX has already been growing.
Bigger yachts. No. You know, we're in a fortunate position where we are profitable, and that is, you know, even sort of through the various endorsement deals that we've been doing. And so the primary thing that we're looking at with the funds is basically, you know, M&A. There are a lot of companies that we think, you know, we could do a lot with, and you know, some of those might be on the more expensive side. And this will give us a ton of flexibility on that front.
Yeah, I mean, when it comes to M&A, I wonder what looks most attractive to you for growth. If FTX is already growing rather quickly, we're showing the exchange volumes there per month on the screen. But when you look at what looks most exciting to you, what is it you'd want to add to FTX?
Yeah, so I think that there's two pieces of this. One is when you just look at the user base. I mean, we're, you know, really happy with the growth that we have in the product we've built. We're also late to the game as far as crypto exchanges go. A lot of them had tens of millions of users before we turned on. And so any ways that we can really get our product out there in front of a lot of users, I think has huge value to us. And so I think that's one piece of this, you know, products that already have very large user bases. I think another piece, in some cases, from a licensing perspective, it can be useful. That depends. It doesn't make sense in all cases, but there's some where it can work and be quite valuable. And you know, we're aiming to be as licensed as we can be, as you know, as an exchange. And then the third thing is, I think there are cases where our products are very synergistic. You know, we can easily add crypto trading and payments, on ramps, off ramps, wallet services, to basically any product or application. And so anything that would, you know, that is sort of in desperate need of that, I think would be a really attractive company to be working with.
As you think about how to expand what you offer right now, I mean, to your point, you were a little late to the game when you compare it to your competitors. I mean, who do you consider your biggest competition right now?
Yeah, so I think it depends on which jurisdictions and products they're looking at. You know, I think if you look in the States right now, obviously Coinbase is going to be the first name that everyone says. After that, you know, Kraken. And then you have players like Paxos, which are on sort of more of the licensing and white labeling and backend provider front. But you know, you also have players like Robinhood, which are on the sort of consumer side and flexing into crypto. When you look internationally, you know, I mean, I think that we're something like the fourth biggest by volume today of exchanges, and you know, it's Binance is the biggest by far. You know, they're the biggest competitor globally. And then you have you know, Huobi OKEX. We're probably the largest exchange outside of China, but you know, we're still, you know, 5% or so of the market share globally, maybe 6% now. There's a lot of room to grow there.
You might have some people looking at it and scratching their heads and wondering, you know, obviously you still maintain majority control of the company here, and you look at, you know, raising 900 million and the pressure it adds. I mean, if you got 60 investors now to answer to, was there ever any idea here that you might not want to go that route, especially if, I mean, you know, how profitable the company is? If you wanted to go that route or wanted to maintain independence, and I guess what it sets up for the public road of FTX and what you're thinking on that front when it comes to what seems like, you know, you have this whole aura of doing things your own way.
Yeah, there's a bunch to unpack there. So one thing I'll say is, like, why bother doing this in the first place? And, you know, the capital for acquisitions, I think, is a piece of it, but another piece is just building out partners and allies. We have a lot of those in the core crypto ecosystem. We've had a lot of really great interactions with core players over the last few years. We have a lot less of that when you venture outside of crypto, and we're trying to build that out. And I think this round was a key piece of accomplishing that. So I think that's sort of the impetus for it. And then when you look at, I mean, you bring up what I think is an incredibly important point of, can the company still be able to function in a nimble way? And I think the answer is yes. And, I'll be frank, that's how this was designed, and that's how this round was designed. This was not a round where I was selling out of the company, taking a back seat, and it was going to be sort of, governance by committee. This is, we're going to continue charging forward in the same ways we have been, except hopefully with more ammo behind us as a company. And that sort of is something that's been explicit to everyone in this round. We're really excited to have them as partners and advisors. But this is not a thing where there's going to be 60 votes on every product tweak that we're going to be looking to make.
You've had, obviously, one of your competitors, Coinbase, come to market. There's a lot of people who are looking to your company to say, well, what's next in terms of a potential listing? You've made no secret about those ambitions, but you've been able to raise so much money on the private side. And I wonder what the incentive is. How attractive do the public markets look for you right now?
Yeah, mixed. I think, we still see significant upside in it. I think in terms of especially the exposure we get, how easy it would be to form partnerships with companies. I think those are huge upsides. As you said, the liquidity for the equity is not the biggest concern for us. It is fairly liquid in private markets as is, and we don't need to raise a lot more. And so I think it would be less from that perspective. And then on the, why not do it? It's a hassle. It's like, I think sort of we're coming back at you and thinking like, I don't know, we could roll out these 4 products, or we could try and go public. I don't know, which is better for the business, right? And maybe being a little bit glib there. And there's more going on than that, but that really is a lot of it. I don't know what the right answer is, but what we're sort of trying to do is position ourselves that we can do it if we want. We're, in terms of getting audited, in terms of obviously racing this round, put together a board, things like that. We want to be in a position where we can seize the moment if it feels like the right thing to do for the company, but where we don't have any pressure to go public if it doesn't seem like it's the right thing for the company. And, I don't know how this is going to play out, but we're working to keep our options open.
I guess, keeping your options open is a good thing. That's one way of measuring success, I suppose. But I am curious, just to kind of wrap up here, what success looks like to you now after already leading the largest round in crypto. What you are going to use as, I guess, your mark for success moving forward. Is it going to be kind of acquiring one of these major competitors out there now that you have this stash of cash, or is it going to be one of those white label deals that you're talking about to really cement FTX in that space? I mean, what is it that you're going to use, maybe the biggest measure of success in the year to come?
Becoming twice as big as whenever you ask me that question. I could give you an answer right now, but I very intentionally update those goalposts as we grow, because they're arbitrary, right? There's always more. There's always a better job that we can be doing. There's always more products. There's always more licenses. There's always more users, and there's always a better experience for everyone involved that we could be creating. I don't think we are anywhere close to being close to running out of opportunities or ways to improve. And any sort of like benchmarks we set for ourselves, they're going to be arbitrary, and the goal will be to blow past them and then create a new benchmark. I don't have a point in my mind where I'm like, yeah, once we get there, let's half-ass it. That seems like a good plan. No, that's not how we're thinking about this.
Yeah, I wouldn't expect that from a company that just went from 1.2 billion in valuation to 18 billion in a year's time, but also wouldn't expect it from Sam Bankman-Fried. Appreciate you coming back on here to chat with us again, man. Congrats on the deal, and we'll be chatting soon. Be well. We're going to take a quick break here on the show. When we return, shifting from crypto to the broader markets as we see this relief rally continue for a second day. The Dow now up roughly 260 points. We'll break down the biggest movers on the other side. Stay with us. Welcome back to Yahoo Finance Live. The relief rally we're seeing play out here today. It's carrying the steam here. The Russell up by about 1.7%. The NASDAQ still holding at its session highs, up by about 0.6%. And for more on all the moves we're seeing and the strength playing out in the second day of the relief rally, I want to bring on Yahoo Finance's chart master, Jared Blickery, who's been watching it for us. Jared?
Yeah, and let's go straight to the charts here. It's not as big as yesterday, but we are seeing some nice gains, and especially when you look at them on a 2-day basis. I'm just going to show you the Russell 2000 right here, up 3 days, and that includes Monday's drop, so that's pretty impressive. That's something I've been watching. Here is a year-to-date chart. You can see we hit this support level that got hit several times over the past few months and bounced up off it. So this could be the beginning of a decent-sized rally here for the value and cyclical stocks. Of course, we're going to need to get participation here. The mega caps having kind of a mixed day. You see Apple down over 0.5%. So is Amazon. And then Facebook is up over 0.5%. Some of the other mega caps just up nominally. We did see NVIDIA up a little bit more earlier. And this is a stock that now may join the Dow. That's the impression of CFRA, given that they just conducted a stock split. Everybody remembers Apple doing that. So did Tesla when they joined the S&P 500. Speaking of that, Moderna also in the S&P 500 today, and Netflix, one of our earnings movers, that is down about 3.8%. We've been talking about it a lot, but I just want to show this stock has been range bound. This is a year to date, range bound for over a year. So right in the middle there, probably not going to see a big catalyst in the near future. Here's the sector action. We got energy up almost 4%, clawing back a lot of those losses from yesterday. Financials up 2%, and they weren't losses yesterday. It was the laggard I was talking about Monday. So we got energy, financials, materials, and industrials. That's a very broad swath of the value and cyclical sector. Nice to see that outperforming. And then to the downside, the only laggards are the defensive ones. We got utilities, staples, and healthcare all trading to the downside. Want to get a quick look of the travel sector because this is just one day, and check it out. Looks like Carnival's up about 9%, Norwegian up 9% as well. Here's the 2-day view. Carnival's up 17%, Norwegian 18%, United Airlines 10%. So looking like a lot of the scares that the market had about the potential for more lockdowns or at least more restrictions, those have been fading. Some other sectors really in the green today. Banks, real quickly. Here's energy as well. And I know we've been talking about Bitcoin. We just had a great discussion about it. Got to check in on the price because this is a big one, guys. We cleared 32,000. This is 1 year. I'm going to go to a 3-day look so we get the entire week here, and we can see climbing back into the green after touching 29,500 yesterday. That was kind of a nail biter, got to admit, guys.
It was a nail biter, but we saw Fundstrat still reiterate their $100,000 price target there on Bitcoin and that $10,000 price target on Ethereum. Credit there. I mean, a lot of people are talking about breaking 30,000 and where we could go, but not the case today. A violent reversal. Of course, we'll be following what's to come when the B word panel kicks off there with Cathie Wood, Elon Musk, and Jack Dorsey discussing Bitcoin. But Jared Blickery, I appreciate you bringing us the latest there. We're going to take one more break here on the show, but when we return, discussing what some experts are calling cave syndrome after the pandemic and why some people might be hesitant to get back out there to the new normal, and crowds once again, how it could weigh on industries looking for a return to normal. We'll chat that on the other side. Stay with us. In today's Hot Takes, a reminder, if you feel nervous of coming out of the post-pandemic lockdown measures and getting back to crowds, you are not alone, as experts are looking at the syndrome, dubbing it cave syndrome in terms of the nerves in getting back into crowds. Interesting, Akiko, Wall Street Journal highlighting the results of an American Psychological Association survey, looking at about 3,000 respondents here, surveyed by the Harris poll, saying that they're uneasy about returning to in-person interactions after the pandemic. And interesting on that front as well, about equal breakdown between vaccinated adults, just as likely to say they were uneasy as unvaccinated adults. So, you know, cave syndrome knows no bounds here, and it's impacting everybody.
Yeah, I mean, and it's a good reminder that as so many of us sort of try to return to the normal we knew pre-pandemic, there's so many who are just having a hard time stepping out of their homes. And Zach, when you think about it, 18 months, I mean, that's sort of roughly when we had the more stringent restrictions in place. I mean, that is a long time when you think about a change in behavior. So if you look at the story, for example, from the Wall Street Journal, they've talked about some people who felt much more social before the pandemic, but because they have been holed up in their homes for so long, they have a hard time going out and socializing again. I mean, you know, you mentioned that you're probably a little more intrigued by those who have not been vaccinated, who have cave syndrome, because you think, well, the first step in getting out is to get vaccinated, especially given that study after study has shown how safe it is. But, you know, I think this is just a good reminder that despite all the talk we have about the economic rebound and things bouncing back, it's just not the same for everybody, largely because there's no real victory day, if you even want to call it that. There's no way to say the pandemic is over. And so long as those headlines persist, especially around the Delta variant, you would imagine it's going to make those who are already hesitant even more hesitant to step out.
Yeah, and you know, I got vaccinated and got COVID too, and so it's a question of, you know, when are you going to feel safe? It's not necessarily that I didn't feel safe because, you know, vaccinations have proven effective here, but it is a question of, you know, when you feel comfortable getting back into those crowds. And we talk so much about, not to turn this into a market discussion, Akiko, but you talk so much about those industries that have been banking on people finally getting out. We talk about Live Nation and concerts getting back out there, but then you see Green Day saying that they're only going to have their concert here be for people who can say they've been vaccinated, and some of the concerns around it. And I just think, you know, this is an overhang that I think people aren't giving enough attention to, just because of the way that, you know, as this poll shows, there are people who are still nervous even after getting vaccinated. I'm not sure that there's a lot there that's going to make people more comfortable, even if you are in a crowded environment against something, as you're saying, haven't been in a long time. Even if everyone around you is vaccinated. It's a weird time, and I think it's something that's affecting us all. Cave syndrome. There you go. We got a name for it now. That's going to do it for Akiko and myself in our hour. Stay tuned, though. We got much more coverage coming your way on this day 2 of this relief rally, including a discussion in the next hour with Senator Cory Booker about his plans for federal marijuana reform. Stay with us. We're back in 2.
Hello, everybody. Welcome to Yahoo Finance Live. I'm Alexis Christoforous here with my co-host Kristen Myers, and here's what's happening. New cases of COVID-19 may be rising due to the highly contagious Delta variant. That's not stopping economists from being bullish on the recovery. Many see continued spending, hiring, and limited disruptions as health officials try to avoid lockdowns and boost vaccinations. Even United Airlines CEO went on the record today to say he expects a recovery in travel demand to continue despite the resurgence in COVID-19. The coronavirus vaccine certainly helped Johnson & Johnson post better than expected profits last quarter. The pharma giant also raising its guidance for the rest of the year. The news comes on the same day a recent study found J&J's vaccine may be less effective in battling COVID-19 variants than vaccines made by Pfizer and Moderna. And a group of Democratic lawmakers are pushing legislation to make cannabis legal on the federal level. We'll be speaking with one of the authors of that pending legislation, Senator Cory Booker, about why this could be marijuana's moment. But first to the markets, where stocks are building on yesterday's gains. And Kristen, it looks like investors are finally focusing on those strong corporate earnings for a change.
Yeah, so actually looking at earnings right now, we had actually seen earnings estimates really being revised upwards. And yet right now, so far, we have a beat rate of about 85% for the companies that have reported so far. So, of course, that's injecting extra optimism right now into the markets. As you can see, all three major indices, a lot of green across that screen. The Dow right now up over 250 points. The Dow right now in record territory. The S&P 500 and the NASDAQ also getting a nice boost here. S&P 500 up about 0.6 percentage point. Just want to take a quick look on a sector basis right now for what's leading and lagging in the market. As you can see there, energy right now up over 4%. Financials continuing to do well. You might remember that they were leading yesterday, up over 2%. On the flip side, however, consumer staples and utilities right now not doing so well. Utilities lagging down almost 0.5 percentage point. Now, you mentioned Johnson & Johnson, Alexis, so I just want to take a look at another big Dow component that also reported, and that's Coca-Cola. Coca-Cola right now getting a nice pop here, up about 1.25 percentage point. They also beating those Wall Street expectations. They also raised their full year forecast, and their revenue for the second quarter, Alexis, surpassed their 2019 levels. Again, just really adding more support to the fact that we are seeing that economic recovery really continuing full steam ahead. Also want to mention, however, Netflix. Now, Netflix also reported earnings. They are sliding today, down over 4% right now. Now, they missed estimates on earnings per share, although their revenue did top analyst expectations. And Netflix also added more than 1.5 million global subscribers for the quarter. And the company says that it is also going to be pushing into the gaming space. But I want to head over now to Jared Blickery, who's in the studio at the Interactive Board for a further look at the market action. And of course, Jared, as we were just talking about, we had Johnson & Johnson and Coca-Cola reporting earnings earlier today.
Yeah, some big Dow components finally reporting. Let's take a look at some charts here. I have a longer term chart, candlestick chart of the Dow. Well, it's not longer term. We're going to go to a 3-month look, and you can really see the recovery here. Here's that steep drop off on Monday, and we're right back. We've reclaimed all of those losses. Very similar story for the NASDAQ within shouting distance of its record high here, and a very similar story for the S&P 500 as well. I do want to take a look at the transports. This is Dow Jones Transportation Index, and we are reaching a little bit of resistance right here. We do need to clear this, but I just want to contrast the small caps. This is the real value cyclical play that we've seen resurge over the last 2 days. This is coming off an important low, and it's still at the bottom of, or let's say the lower third of its range, but that's a good start for it. And also got to check out the bond market. That has been jumping lately. 10-year T-note yield, we remember when that dropped to about 1.2%, well, that was a low, and it's being confirmed today, unless something drastic happens over the next hour or 2 hours into the close. Also want to check out the U.S. dollar index. That is down slightly, forming an interesting kind of formation if you take a look at the year-to-date chart, a nice rounded cup there, maybe we'll get a handle. I do want to take a look inside the market. We'll do some heat maps now. NASDAQ intraday, we got a mixed picture for the mega caps, but if we sort by performance, we're going to see a lot of chip stocks at the top. And guess what? In the upper left, that's Moderna. Welcome to the S&P 500. As I've been saying, this stock has been on a tear over the last month. Hopefully not a sell the news event. Let's move on to the travel sector just to show you a lot of green. We're going to take some standouts here. Carnival, Norwegian, each up about 10%, even more when you consider the moves that they had yesterday. And semiconductor space. NVIDIA is a standout. I've been talking about the CFRA note. Maybe they will join the Dow, but check out Lam Research. That's up 4%. Applied Materials, 3%. This is a sector that's been lagging recently, so it's nice to see them get some steam. Finally, want to check out the banking sector. We do have the yield curve expanding, so banks, they like to borrow low and lend higher. That's what's happening. That's what's being baked in here. Net interest margin possibly getting a jump. These guys have already reported, but that is a value sector to watch, guys.
All right, Jared Blickery, thanks so much. Want to stick with the markets now and welcome in Sean O'Hara, president of Pacer ETF Distributors. Sean, good to have you here on the show. So we are looking at possibly back-to-back rallies for the market after that big dramatic sell-off we saw on Monday. Are you a buyer of this market right now at this level?
Well, good afternoon. Thanks for having me on. I'm not generally a buyer of the overall market. I still think the overall market is relatively expensive on a PE basis and so susceptible to some negative shock, which we saw on Monday. That doesn't mean that I'm not an investor looking for opportunities. And so in some of our funds, for example, we like streaming. But just to compare and contrast where we look for streaming opportunities versus the broad market, you talked about Netflix earlier, down for the day. The two streaming names that we own, CBS, Viacom, and Discovery Networks, are both up today, and they just have different business models. Netflix's problem is growth going forward. 200 million subscribers here in the U.S. That means in order to grow, they've got to, 10%, they need 20 million net new subscribers, or they got to launch a whole new business, which is what they announced today. Whereas you take Discovery or CBS Viacom, CBS has content with their Paramount acquisition, and Discovery is a reality-based kind of a platform where they have a very inexpensive input in terms of their content. So, and on top of all that, they are new entrants so that they can grow their subscriber base faster. So I'd be thinking about the market that way. If you want to invest in the cloud, for example, you can buy the big names, Amazon, Microsoft, Google, or we own IBM in the tech space. That's a cloud player now. And we saw what happened Monday and Tuesday with IBM versus the broad market. So I think you have to be a little more selective and not just focus on the total market today.
All right. So, Sean, I know that you're saying that right now equity's pretty expensive, making them even more susceptible to all of these headlines. On Monday, it was headlines around the Delta variant and the spikes that we're seeing around the country. Do you continue to see that, just looking out ahead at the second half of the year? Do you think that the Delta variant is going to be the main catalyst behind some of these swings, these sell-offs, or are there other headline risks that you think are existing out there right now?
Well, I can think of four. The Delta variant would be one. I think inflation would be another. I think interest rate could be a third. And then, we've sort of got an easy quarter year over year in terms of earnings. I think we'll close out this quarter with pretty remarkable year over year gains. I think the third quarter probably remains a fairly easy bogey to hit. But then once you get beyond that into the fourth quarter and the first quarter of next year, then the comparables become more difficult. You talked about Coca-Cola a little earlier this year and their sales finally getting to the 2019 level. Well, the stock is now back there. So in order for them to get growth going forward, they've got to start to exceed that number. And so that's going to be the big question is forget about the percentage change in earnings quarter over quarter or the revenue change in terms of percentage. We have to look at the real dollars to determine where the overall market goes. And we're trading at a high level. I think we're expected to make $165 a share going into 2020 on the S&P. We're not quite back there. We expect we'll get back there sometime third quarter, fourth quarter. But the S&P 500 is 20 to 25% more expensive than it was going into 2020. So that's going to be the real challenge. I think there's more headwinds on the progress going forward, upward movement in the market than there is on the other side of it. And so again, you don't have to buy the market to make money in this market. You can buy cheaper stocks that are higher quality, that generate free cash flow, that pay you today to own them. And that might be a strategy that, going forward, at least take some of your profits, don't go away from the market, but reduce your overall PE exposure, buy higher quality names, and ride it out from there.
Sean, I want to talk a little bit more about IBM. You briefly touched on it, but I know when you're looking for exposure for companies that deal with the cloud, you actually like IBM over Amazon, Microsoft, and Google, even though IBM seems to be quite far behind all those companies when it comes to cloud. They are quickly playing catch up, though. They were out with earnings this week, beat on the top and bottom line. They're spending a lot on acquisitions. Make the case for IBM, and obviously you hold the stock.
We do. It's relatively inexpensive on a free cash flow yield basis, so that's why it's in one of our portfolios. It's an ETF, the ticker COWZ. But they generate $20 billion a year in free cash flow, so they can afford to sort of move into these new areas. They've made a commitment. They're not going to go head to head with the other cloud players. They're going sort of in this quote unquote hybrid way. And so the big surprise on the top line was that their cloud revenue surprised everybody on the top line. And if they continue to execute like they have been, you should continue to see these positive surprises. Whereas I'm not sure that there's going to be that level of positive surprise going forward for some of the other big cloud players because they're so entrenched.
All right, we're going to have to leave it there. And of course, need to point out IBM continues to pay that quarterly dividend, making it pretty attractive as well. Sean O'Hara, president of Pacer ETF Distributors, thank you. Coming up on Yahoo Finance Live, Johnson & Johnson reveals its vaccine may not be as effective against the Delta variants as some others. We have that story coming up.
Welcome back. Well, as the Delta variant continues to spike around the country, there's a new study out that suggests that the Johnson & Johnson vaccine might not be as effective against that Delta variant of coronavirus. So we want to chat this more now. We're joined by Dr. Amish Adalja, senior scholar at Johns Hopkins Center for Health Security. Doctor, always great to have you here with us. So let's just start with this worrying news that Johnson & Johnson vaccine might not be as effective against that Delta variant. Do you think that we're going to start seeing a lot more people around the country that have been vaccinated and have now been getting coronavirus? And if so, what then do you say to those folks that are out there that have not yet been vaccinated and say, what is the point of me becoming vaccinated if I can still get infected with COVID anyway?
It's important to remember that no vaccine is 100%. And what we're seeing is that breakthrough infections, although they occur, are very, very rare. And when they do occur, are usually asymptomatic or really clinically meaningless. So that means the vaccines are doing their job, that they're protecting you against severe disease, hospitalization, and death. And that's all we've ever wanted these vaccines to do. And if you walk through a hospital now and look and see who's being hospitalized, by vast numbers, it is people who are not vaccinated. So I would tell the unvaccinated individuals, breakthrough infections don't change the value of these vaccines. Breakthrough infections are rare, and the reason you're getting vaccinated is not to prevent mild illness, but to prevent severe illness, prevent hospitalization, and prevent death. And that's where the vaccines are really off the charts.
Doctor, we got some news today that New York City's mayor says that the city is going to require healthcare workers to get vaccinated or undergo COVID-19 testing weekly beginning in early August. This is just for those who work for city hospitals. But do you believe that those kind of mandates will be spreading to municipalities and cities across the country as the virus gains more momentum?
It is something where I think mandates by private organizations, by hospitals, are going to be indicated, because we have large swaths of the healthcare organizations that are not fully vaccinated. So, for example, doctors might be 96% vaccinated at a hospital, but when you get to the nursing staff, it's much lower. So this move by New York City with their Health and Hospitals division is important, and I think it is the right move. And I think what we want to do is show people that vaccination should be a norm, especially if you're a healthcare worker. And we will likely see more organizations outside the healthcare industry mandate the vaccine as a condition of employment or as a condition of participation, probably much more after we get the full FDA licensure of the Pfizer vaccine, which hopefully is imminently coming. But this is one way to move the needle, and I think it's important. The nurses unions need to back down when they oppose these mandates for healthcare workers. I think it's a sign of professionalism to be vaccinated, and I think it's deplorable that we don't have higher vaccination rates among healthcare workers.
So, Doctor, I want to ask if you think that another vaccine or perhaps even a booster is going to be needed. If so, by when? For those that are vaccinated to really be able to battle against these new variants and mutations that we are seeing crop up.
To me, it's very premature to talk about booster vaccines, because what would be the threshold for a booster vaccine to me is seeing individuals who are fully vaccinated get breakthrough infections that are severe enough to land them in the hospital. That's not happening to any high degree. So the vaccines seem to be holding up with really good durability. There might be questions about third doses, for example, with immunosuppressed populations. But for the general population, our vaccines are doing really well. They're doing what they're designed to do. They're keeping people out of the hospital with COVID-19. And that's what flattening the curve was always about, preserving hospital capacity. So I think in the near term, for healthy people, boosters are not going to be something that's required. It's important to study boosters and have a quick pathway for approval, but we're not ready to pull the trigger yet on them.
And now, we're coming up on school beginning in many parts of our country in just the next few weeks. Doctor, what do you think the recommendations should be there? Should these students, especially given the fact that those under 12 still cannot yet get vaccinated, how should we be prudently reopening the schools?
It has to be a priority to have in-person learning be the norm. And we've got a lot of lessons from the pre-vaccine era about how to do this safely. And children have suffered a lot during this pandemic, not because of what the virus did to them, but because of what adults did to them and what teachers unions did to them. So I think there is a pathway forward. It's easier now because we've got vaccine for teachers, vaccine for those above the age of 12, and children tend to be spared from the severe consequences of disease. So I think when you're dealing with vaccinated children, vaccinated teachers, and by the way, I think that schools should mandate that teachers be vaccinated as a condition of employment, that becomes a pretty easy prospect to deal with. It's the unvaccinated individuals where you need some flexibility in terms of when do you pull the trigger to use masks. And I think that's going to be something that's going to vary from school district to school district, depending upon what the vaccination rate is in the school and how much community spread is going on. But we have a pathway forward with schools. We've done this even before the vaccine. So I think this is something that can be done safely. And the more vaccine we have in people, the better it's going to be.
I actually do want to ask about those folks that haven't yet been vaccinated. And just as a anecdote, I recently traveled, and it was a requirement. And in fact, if you wanted to enter into a restaurant or go into establishments, you had to show that you were either vaccinated or a very recent, within the last 2 or 3 days, COVID test that showed that you were COVID negative. But I do want to ask, because we do have these pockets around the United States where folks are unvaccinated, and we are seeing the hospitalizations and the death rates really start to rise. So how do we get those folks, those last holdouts, to really go out and become vaccinated, especially as vaccinations and frankly just this entire pandemic has been so politicized? How do we go about convincing those folks?
It's going to be very, very difficult. People who are eager to be vaccinated are already vaccinated, and we've sort of hit a wall. So what you have to do is really address what's preventing someone from getting vaccinated. Listen to them, ask them what questions they have about the vaccine and try to address them. And we have tons and tons of data on the safety and the efficacy of these vaccines. So you really have to see what's driving their decision. It's also something about, getting the vaccine fully approved by the FDA. That may push people because that's a talking point of the anti-vaccine movement, that this is somehow an experimental vaccine. And also when it's fully approved, you'll see more organizations mandate that as a condition of participation. We also have to just really go door to door. I think that's something you can do, but you have to do it with trusted community advisors. So primary care physicians, community health leaders that people trust, and have them make the vaccine available to them. It's just going to be a lot of effort for each each additional dose that you get into somebody's arm. And I think it's the thing to do. And it's something that we have a lot of great evidence for, and everything that's going on in this country with the Delta variant is completely now vaccine preventable. So this is something that is really self-inflicted. And I think we have the tools in place to move the needle on vaccines. It's just going to take some time, and it's going to be difficult.
All right, Dr. Amish Adalja from Johns Hopkins Center for Health Security, thanks so much for joining us today. And coming up next after the break, Trump friend and ally Tom Barrack has been indicted on charges of acting as an agent of a foreign government. We have all of those details right after this.
A former advisor to former President Donald Trump was charged today with illegal foreign lobbying on behalf of the United Arab Emirates. Our senior columnist, Rick Newman, here now with more on this developing story. So, Rick, we're talking about Tom Barrack here, and I know just days before his arrest, he was talking about Trump and he was talking about real estate.
Yeah, this is not trivial. These details actually matter. So Barrack is a personal friend and a business associate of Trump. He has helped him do deals in the past. And apparently he was talking directly to the president and to other people in the Trump administration, trying to influence U.S. policy that would affect the United Arab Emirates, the UAE. At the same time, the UAE was funding his private equity firm. So he had a financial stake in the outcome, because he was basically doing this on behalf of clients or investors, if you will. And he never disclosed any of this the way you're supposed to. You're supposed to register as a lobbyist for a foreign government if you're going to do this kind of thing. And he never did this. So the UAE has a direct interest in several different types of U.S. policy. Number one, it's a bitter foe of Iran, which sits right across the Persian Gulf from the UAE. So it's very interested in what happens with U.S. policy toward Iran's nuclear program, for example. And the UAE is also a very large purchaser of U.S. weapons systems. So there are a lot of things the UAE would want to influence U.S. policy for. And Tom Barrack, Trump's personal friend, was apparently helping them do that without telling anybody.
All right. Thanks so much, Rick Newman, for bringing us that story. We'll continue to watch it unfold. All right, coming up here on Yahoo Finance Live, an inside look at the spectacular collapse of WeWork with the authors of the new book, The Cult of We. We're back right after this.
Welcome back.
Well, not too long ago, the real estate startup WeWork was a rising star until then CEO Adam Neumann decided to take the company public in what would ultimately become a failed IPO, thanks to questions and concerns over the company's financials. Now, our next guests have charted the spectacular rise and blazing fall from grace for the former WeWork CEO Adam Neumann, and they pull back the curtain on the startup unicorn. We're joined now by Wall Street Journal reporters Elliot Brown and Maureen Farrell, co-authors of The Cult of WeWork, Adam Neumann and the Great Startup Delusion. Great to have you both here with us. So let's just start with this. If you had to pinpoint, the reason behind WeWork's failure, essentially boiling down what you have uncovered throughout this book, this expose, what would that reason be? Does it all fall squarely on Adam Neumann's shoulders, or do you think there is plenty of blame to go around?
I'll start. I think, we think in sort of the main theme of the book is it's the whole finance system that created this. And there was just so much money pouring into this concept of founders who had visionary ideas that this was the result of what happened. This guy had full control of a company. He had sort of messianic type views, which is what venture capitalists in Silicon Valley were looking for. And when you sort of combine those, it was this toxic brew that when mixed with tequila and jets led to the sort of result we got here.
Maureen, when you look back, I think a lot of people forget WeWork was actually a functioning company. When it made a profit all the way back in 2012. What happened? When did it all start to go so wrong?
So it had this one brief year of profits. From there, you could start to see it when the venture capital funding started coming in. It started getting more and more money, and Adam Neumann, the whole team, started spending it. And after 2012, you basically see this company chart this incredible growth path. You could walk into any city around the world almost and see a WeWork, yet the company was losing just as much money as it was spending. And Adam Neumann, masterfully kept on finding new pockets of money in the private markets, kept on expanding, and just didn't have people sort of putting the checks and balances on him to say, how is this going to be a profitable company? And he was always saying, oh, we'll be profitable any minute. And then the public markets came, and there was the real check on him.
Elliot, when I think about this story and even just, hearing your answer just a moment ago, I think so much about how Adam Neumann as a CEO and a visionary and figurehead for the company, but also WeWork itself is really a cautionary tale, especially as we see so many companies going public and there's lots of questions around profitability. And there's also just so much greed right now going on in this market. What do you think one of the big lessons is learned, perhaps, from this whole WeWork debacle that folks like yourself and, me and Alexis, other financial reporters, but also folks on Wall Street and investors really should be taking heed of?
I think that there's sort of two parts there. I don't think the market has really learned many lessons. You see a lot of the same stuff that was happening with WeWork going on in different pockets. I think as a journalist, one of the things that I took away from this is you just have to employ more critical thinking, and it's not that hard. I'm not that smart. We wrote a lot of stories about how this appeared to be an overvalued real estate company, and the finance system wasn't doing that. So I think when you have a bubble, you really tend to obscure critical thinking in a way that's really important, and it's important to keep track of gravity.
Yes, it is. Well said. Important to keep track of gravity. And you're right. Lots of companies are not doing that. Lots of venture capitalists. Maureen, what about the big guys? The firms like the JP Morgans of the world. Did they not take a close look at this S1 filing? How did so many red flags get missed along the way? And I must say, this is not the first time we've seen this happen with a company. It's been going on for decades. But what in particular maybe, got in the way for those who should have known better not to see it?
I think it was two things. Number one, this FOMO. We write about this a lot, this fear of missing out, and Adam Neumann pushing the envelope every step of the way, and everyone sort of being scared to stand up to him. You'd think, the titans of the finance industry, like JP Morgan, Goldman Sachs, Fidelity, that they would, why did they should have the power, not Adam Neumann. But there was this fear, there was so much private capital. And then getting to the public markets, there was this fear of, wanting to be the bank to take WeWork, be the lead advisor to them going public. And Adam Neumann played that every step of the way. So there were red flags, they were pointed out. There were just so many of them. The banks and WeWork were kind of drowning in these red flags, and they would push back a little bit, but people just did not stand up to them. And it was, just a complete wreck when they tried to get to the public markets, and the public at large saw all these red flags and wouldn't put up with them.
Elliot, I think several examples have been published about some of those conflicts of interest, from Adam Neumann essentially renting his own property to WeWork, paying exorbitant sums to trademark the word we, to even their S1 filing, which was strange. Some of the language that was in there around the essence or the energy of we, I can't really remember right now off the top of my head. The energy of we, exactly. But as the two of you were doing, so much of the research and investigating, I'm curious to know if you can share perhaps some of the lesser known, surprising, perhaps more egregious, weird, strange examples of that greed, of what you guys call that greed, of that almost cultish-like vibe that existed at WeWork.
Yeah, so I like to break it into two components. There was sort of the grandiose lifestyle and some things. I mean, Adam was always getting in trouble with private jet owners that he was renting from for spitting tequila was one thing that happened on a jet that he was on. Another one, the oxygen masks needed to be employed by the crew because there was too much smoke from marijuana in it. So he was going surfing constantly. He got a yacht for his 40th birthday in the Maldives and had all his friends go there. He had a hairdresser that followed him around, and school teachers from their own elementary school. So that's sort of one bucket. And then the second is the personal enrichment bucket from WeWork. And yeah, I mean, he just at every step of the way, he took money out of the company. He would get these giant loans from the company, and then he would at the very end he negotiated, so he was paid hundreds of millions of dollars to go away from the company that he built up and burned a lot of money at. And he had restructured the entire corporate system within the structure of WeWork so he could get a better tax benefit on some of his compensation. So it was I was continually surprised about his sort of avarice.
Wow. Yeah. You kind of forget all the kind of crazy things that Adam Neumann did. I'm going to put this to both of you, and either one of you can jump in, or both of you. But it seems like WeWork is getting a second chance, and it has plans to go public now through a SPAC, which has become very popular, these blank special acquisition companies. Do you think that the market is going to embrace WeWork, especially in a post-pandemic world when, shared office space may not be top of mind for everybody right now?
I think it's going to be a really interesting time for them now, particularly, as companies are cutting their office space. I think it's a huge question mark right now going forward, how they're going to fare. But you could see a world in which companies cut office space back, people work from home more, and give part of that office space they used to have to WeWork. I think it's a little too soon to tell, and the market's jittery. They've got the SPAC deal done, about $8 billion. They once were valued at $47 billion, but it was up from $2 billion. So there's some signs of a comeback, but I think it's a little early to tell just yet.
All right, we'll have to leave that there. Elliot Brown and Maureen Farrell, authors of the book, The Cult of WeWork, Adam Neumann and the Great Startup Delusion. Thank you both for joining us today. And coming up next after the break, Senator Cory Booker is going to be joining us to discuss federal marijuana reform. You're not going to want to miss that conversation right after this.
A group of Democratic lawmakers are pushing legislation to make cannabis legal on the federal level. Yahoo Finance's Zach Guzman here now with one of the authors of that proposed legislation, New Jersey Senator Cory Booker. Hi, Zach.
Hey, Alexis, that's right. We got Senator Booker here. Thanks for coming on here to chat, and congrats on getting the draft legislation out there to end the federal prohibition on marijuana. Ambitious, not just in ending that prohibition, but also adding the restorative justice piece that you and I have talked about in the past in redirecting the tax revenues here to communities impacted by the war on drugs, also expunging records for nonviolent criminal cannabis offenders. But critics are saying that it's a little ambitious, so ambitious that it might not get the 10 Republican votes needed in the Senate to pass. How confident are you that you're going to get there?
Well, I know this. We are on the right side of a history in America. If you poll Americans of all parties, independents below the age of 50, it's overwhelmingly popular. You see marijuana decriminalization efforts to approve adult use in red states and blue states. So here on the federal level, we know the side of history, and this is not a matter of if we ever get this done, it's a matter of when. But as you said, my big issue is in this rush to end prohibition, we need to address the outrageous injustices that have existed in a system, frankly, that was so much hypocrisy. People running for president, people running for Senate and Congress readily admit their marijuana use while continuing to condemn millions of other Americans to a life of having a criminal record for marijuana use. And it's disproportionately, unfortunately, low-income people and people of color. And so we need to see, as you just said, people's records being expunged. We need to see a reinvestment of a lot of that tax revenue into areas that have been disproportionately targeted by the war on drugs. And in this billion-dollar industry, we need to make sure that people who may have had past marijuana convictions aren't held out of getting equal opportunities at business. We need there to be equity and inclusion in the economic opportunity as well.
Yeah, it's pretty interesting. I mean, we've seen some states tackle that restorative justice piece at the state level. Illinois kind of doing something similar in setting aside the tax revenues there, redirected to communities impacted by the drug war. Your state, New Jersey, setting it up similarly, New York as well. But how important is it to do it at the federal level? And how does it look in your eyes, maybe a little bit of a different question when you think about all the states that so far haven't legalized marijuana?
Well, remember, the war on drugs was accelerated by the federal policy. We gave incentives to states to build prisons, incentives to states to raise mandatory minimums, incentives to states to really prosecute the war on drugs, which made it proliferate quite considerably. And I think the federal government now has a responsibility to provide incentives to states to begin to balance the scales of justice. And so it's very much a federal role, as we've seen on the wrong side of the war on drugs, in doing the things that have caused such extreme damage. The federal government has an obligation, I believe, to right those wrongs.
There's the other piece of this restorative component that I've been covering for a while, which is kind of minorities making up a shockingly low share of these cannabis businesses, and the states have tried to put in programs to kind of fix that as well. But when you look at it, there is a key component here that's looking to be addressed from a bill that has passed the House 4 times. That would be the Safe Banking Act that has bipartisan support here that would make access to capital easier. And that's something that we've seen kind of minority businesses owners struggle with, as well as, you know, the larger corporations as well. You came out and said that you'd do everything in your power to block the Safe Banking Act from passing. Why are you so opposed to that in particular?
Yeah, because this is, again, an example where the financial business, the $15 billion business, to me, I'm an American like anybody else. I love capitalism and fairness and equality and all of that. But what happens often is the urgent social justice issues get forgotten about. They can't get the kind of coalitions necessary when it's an opportunity to make money. And what ends up people being left behind are those people that are trapped often in poverty because they can't get a business license, they can't get a loan from a bank, they can't even get a job at a fast food restaurant because of past criminal convictions for doing things that 2 of the last 4 presidents admitted to doing. So far be it from me. I am going to do everything I can to stop people just trying to do the easy stuff to make to open the pathways to creating great wealth that will leave behind those people right now that are struggling in the shadows of society for just doing the things that many of us who went to places like Stanford, Oxford, and Yale, like I did, watched privileged people do with no fear of consequence whatsoever.
Yeah, I mean, I agree that the restorative piece there is rather important. It's something that gets overlooked all the time. So it's ambitious, definitely, to include it at the federal level here. But when we think about that, we've seen companies, struggle to access the capital to grow. And of course, there are jobs being added there on that front. So you can make the argument that declining the Safe Banking Act might be letting the good get in the way of the perfect. If you are kind of like you and I, looking for the more important restorative justice components, I mean, how strong are you opposed to the Safe Banking Act, since it does seem like it would support maybe all cannabis businesses? I know it doesn't address the restorative justice piece in kind of the crime that we've talked about, but do you at least concede that businesses are helping in that front and bringing some people along for the ride as well?
Oh, first of all, don't get me wrong. I support the Safe Banking Act. I think it's a phenomenal bill. I'm one of these folks that is out here working with cannabis industries, not only across the state of New Jersey, but around the country. I feel like I am one of their greatest champions when it comes to ending the nightmare of prohibition and the ridiculousness of so many businesses having to operate in cash. It increases danger, not to mention what you talked about, which is easing access to capital for a lot of folks. So please, I support this completely. But if there's anybody in the Senate, I hope that's earned a reputation for being at the center of driving some of the greatest bipartisan criminal justice reform bills in a generation, things like the First Step Act, for example. I know how hard it is to get the kind of coalitions necessary to get across the line the kind of justice that is urgently needed in so many communities, from low-income rural communities to inner cities where so many people are forgotten about. So for me, a good bipartisan bill like the banking bill is a necessary sweetener to get people to move along on the equitable justice elements or restorative justice elements that are really critical. And so I agree. We need to get that banking bill done. And I'm hoping that all the industries that are out there that know that they're going to make tremendous profits join me in standing up for what I think is the greatest act of patriotism there is, saying, I'm not going to put my interests alone. I am actually going to look out for my fellow American. I'm actually going to pledge to them that I'm going to fight for those people who are in economic devastation because of a nonviolent marijuana charge, that I'm going to make sure that we take care of everybody. That's what this country was founded on. Our founders signed the Declaration, and it's ending with this ideal of pledging to each other our lives, our fortunes, and our sacred honor. Well, dear God, let's make that kind of pledge and all go together in reforming our marijuana laws, leaving no one behind.
Yeah, comforting to hear you say that you would be kind of supportive there in the Safe Banking Act as well. I mean, your name comes to mind in thinking about pushing for big changes here, as well as your colleague in the House, Ed Perlmutter. We've had him on, God bless him, 4 times that we've seen the Safe Banking Act pass the House. Still not making much progress there in the Senate. But it raises questions, and we're seeing this play out right now in the infrastructure battle as well, kind of the good getting in the way of the great. I'd be curious to get your take, too, as we're kind of watching that play out and what it looks like going to be taking another week to get the GOP votes on that compromise infrastructure bill, how you're seeing that battle shape up, and how, if that plan falls through, what you're expecting to see on the infrastructure front.
Look, at the end of the day, none of us remember whether the Eisenhower Highway Act, which would have been well over $1 trillion in today's money, was done with what the vote was in the Senate and how it got done. We just know that it created a transportation boom for businesses all across our country. We are still living off of the investments made 2 generations ago. We need to get massive infrastructure done, not just repairing the 20th century infrastructure, which is going to cost about $2 trillion to bring it up to today's standards. But we need to begin to start to reimagine what infrastructure is. It most definitely is broadband penetration for all Americans. It most definitely is making sure that we have the kind of human infrastructure necessary to run a 21st century economy. Our competitors understand that. The 36 richest nations do things for families to empower their workers that we just don't do. We're at the bottom of those lists. So I want to get this done. Generations from now, we'll celebrate what we did, the investments we made, however we do it, through reconciliation or through a bipartisan compromise. I know that that's the question of the day, but I promise you, the things that we are investing in are going to make our economy stronger, make us more internationally competitive, and empower working Americans who have seen decades of stagnant wages and more stress on families, because we're the only developed nation that doesn't have something as simple as paid family leave. Afghanistan and the Congo have paid family leave, and the United States of America doesn't.
Yeah, there's a lot of initiatives here that we're discussing there in that big infrastructure bill that I know progressive Democrats like yourself want to see through. On the same side as marijuana and the new bill there, congrats on getting that out. Thanks again for taking the time to chat. Senator from the great state of New Jersey, Cory Booker. Thanks again for the time. Alexis, we'll send it back to you.
All right. Thanks so much, Zach Guzman. Thanks for bringing us that interview with Senator Booker. And stay with us. A quick check of the markets on the other side of the break.
Welcome back. Let's do a quick look at the markets right now before we head off to break. As you can see there, the rally continuing to extend in its second day after the sell-offs that we had seen on Monday. The Dow right now up over 250 points, being boosted from some really great corporate earnings. We heard from Johnson & Johnson and Coca-Cola, big Dow components earlier today, both exhibiting beats on both bottom and top lines over analyst expectations. Just a quick look at the sector action right now, mostly green across the screen. We are seeing energy right now taking the top spot over financials, which had led the markets yesterday. Energy right now up over 3.5%. On the flip side, however, utilities and consumer staples continue to lag. Coming up in the next hour, we'll be chatting with Chris Meekins from Raymond James to talk about those budget negotiations. That's after this.
Hello, everybody. Welcome to the 2 o'clock hour of Yahoo Finance Live. I'm Alexis Christoforous here with Kristen Myers, and here's what's happening. New cases of COVID-19 may be rising due to that highly contagious Delta variant, but it's not stopping economists from being bullish on the recovery. Many see continued spending, hiring, and limited disruptions as health officials do all they can to try and avoid lockdowns and boost vaccinations. It is Judgment Day for President Biden's infrastructure bill as Senate lawmakers get ready for a key vote on the $1.2 trillion proposal. We'll speak with a policy analyst about the hurdles ahead and what it could mean for investors. And Taco Bell is the latest fast food chain to run out of ingredients and face a food shortage. And customers quickly turn to social media to share their disappointment. We've got the latest for you. But first to the markets, where stocks are building on yesterday's gains. Jared Blickery here now with a closer look at some of the action. And Jared, it looks like finally, investors are paying attention to those earnings reports.
Yes, and they're going to be paying attention for quite a few weeks here. First, let's take a look at Netflix. This is our first candidate. I'm going to show what's happened over the last 5 days. Not the best price reaction, but it's only 4%. And I do have some analyst notes from the street, see what they're saying about the stock. Now, we know that their subscriber outlook was a little bit shy of what analysts had been hoping for, and that's kind of what happened last quarter. Plus, they missed on their bottom line. Profits not as big as was expected. So here's Wells Fargo. They hold it with an overweight price target of 700. They're saying the streaming giant is in a period of relative financial predictability, supported by strong EPS growth. Gaming is incremental to the story rather than risky. And we've spoken with a number of analysts today, and they agree gaming is going to take a long time to take off, if at all. Netflix says they're already producing games. I think it was a choose your own adventure, not exactly Call of Duty. So not looking for a big spend there, but they're probably just going to dip their toes in the water, as Wells Fargo is saying. KeyBank Capital Markets, overweight price target lowered to 645 from 650. You can see that's well above the current price of 509. But investor worries surrounding annual operating expansion will likely moderate, with more attention on EPS growth and free cash flow, writes the analyst, led by this gentleman, Patterson. Entry into video gaming akin to dipping a toe in the pool. So I guess that was KeyBank that I was reading before. But those operating margins, think about it. They got kind of a pass last year. Everybody signed up for Netflix who didn't have it, probably, and then they didn't have to pay the development costs. Well, all of those come into the forefront this year. And one of the key takes from an analyst we spoke to from Bank of America in the morning was, given all the hype around, and not the hype, given all the attention around the subscriber numbers, we didn't learn that much this morning if they are approaching that key threshold of peak streaming. Have they edged out all the cable players? How much room is left? We still don't know. Alexis.
All right, Jared, let's look at another company that reported earnings, and that is Chipotle. Tell us how they're doing today.
Chipotle is doing very well. Let me cancel this right now. Just show you the stock. Up 12% today to a record high. So it's nice to see that. Of course, their digital strategy has been paying off many dividends here. And let's take a look at what the street is saying. Truist, they rated a buy with a price target of $1,800, and they're raising that from $1,750. You can see almost there. It's about $24 away. And they're saying same-store sales, they remain strong, driving earnings estimates and price target increases. The company is guiding to acceleration in two-year same-store sales in the third quarter, driven by increase in menu pricing, recovery in dine-in sales, and strong retention of digital sales. So Chipotle is working on a number of fronts. Their digital strategy paid off, and people are finally coming back in the restaurants. But we do have to contend with what the analyst is saying. Food costs and wage increases will limit margin expansion, but pricing should drive, they have pricing power, so it should drive probably increases in sales. So it looks like we're done there. But I just want to show a longer-term chart of Chipotle. This is over a one-year basis, and you can see it's been kind of fits and starts here, but nevertheless, from the lower left to the upper right, on a 5-year basis, you see what a strong stock this is, up 325%. Pretty impressive given the size of the company. Market cap now $50 billion.
Wow. All right. Thanks a lot. Jared Blickery there for us in our studios. Let's talk about the markets a little bit more now with Timothy Chubb. He is Chief Investment Officer at Gerard. So Timothy, thanks for being with us. A lot of people thought that Monday's big sell-off was needed. They said valuations were really high. They actually thought the market was due for a 10% correction. What's your feeling on that now that we're looking at possibly two back-to-back days for this market of moving higher?
Yeah, and thanks for having me. We're certainly more optimistic about the economic recovery right now than the broad market valuations. I think when you look at a lot of the indices at a high level, we certainly are at a point where I think we've probably gone too far too fast, and especially in the short period of time that we've seen the last 2 days. But overall, we've seen these little pockets of value open themselves up within the market. This has been a year that, in our opinion, has been very much a stock picker's market. We've seen these large factor rotations take place between stay-at-home and reopening trades. It's secular versus cyclical growth, and ultimately that's presented some opportunity already in the first half of this year with growth stocks selling off in March, April, and May. Cyclicals obviously performing extremely well following December vaccine news, and then recently seeing cyclicals pull back a little bit right before what is to be expected a pretty strong earnings season for many of those sectors and industry groups.
So to that point, then, where are you really seeing the most opportunity, especially as you mentioned, this market pretty expensive right now?
Yeah. Well, I think it's really important for most investors to really not try to be in and out of these two factor groups. I think maintaining cyclical and secular growth exposure are extremely important in this environment because you really can get whipsawed by some of these rotations that are taking place under the surface. I think one of the things that we think is most important is really the rebound in the U.S. consumer. Being that U.S. consumer 2/3 of GDP, seeing consumption decline some 53 some odd % last year at the low, but ultimately, the extra unemployment benefits, the $1.8 trillion in stimulus, really plugged the hole in the economy, allowing the U.S. consumer to get back on its feet much more quickly. And so, as we start to see some of the benefits run out on state-by-state case with some of the extra unemployment benefits, we're hopeful to see continuation of the decline in the unemployment rate, and ultimately that makes us pretty bullish about companies that are really exposed to the consumer. We've seen personal income, savings rates, retail sales, continue to climb and surpass pre-pandemic highs. And so one of the areas on the consumer side of things in particular is really in the housing space. And I think as we look at companies that are sort of the interaction or the intersection rather of reopening and stay home, we've seen a huge acceleration in the shift towards online real estate activity. And certain businesses are able to certainly have quite a bit of ad growth during this time as more and more users are jumping onto their apps and seeing what houses are coming onto the market with such short supply.
Timothy, if we have likely hit peak growth and peak inflation, what's the most prudent thing to do with one's portfolio at the moment? And are you hedging for higher inflation in the short term?
Yeah, I think the short-term inflation, answer the second question first, right now in our view has been that it will be transitory. And so earlier this year, as a result of that view, we had certainly taken up our exposure to big tech in particular, which had really wonderful results last quarter, and we're expecting to be the same this quarter, contributing about 14% of S&P earnings for the second quarter. But I think ultimately as things start to likely revert back to the old way of things where growth and rates will remain slow and low for quite a long time, I think investors really need to focus on big tech. And given that they're expected to see earnings grow meaningfully once again this year, and certainly a lot of these long-term trends of especially related to the consumer are likely accelerating as a result of COVID. I think that's really an area where investors don't want to have too little exposure within their portfolio, as unsexy as it may be to be going back to the big five. But I think in the fixed income markets, that's where we see a lot more risk as far as that environment. We're getting close and not too far away from record low spreads in the credit markets. There's definitely a lot of risk there, especially as yields have pulled back quite a bit, I think. And so we're a bit concerned, just generally speaking, if we were to see a bit of a pickup in inflation, or at least this transitory inflation that we anticipate lasts a little bit longer. I think that's an area where ultimately it would cause investors or sectors such as staples and utilities and some of the more rate sensitive sectors, real estate, of course, to pull back a little bit more here. So I think technology, communication services, I think having some exposure certainly to the industrials and consumer discretionary sectors as we continue to see the economic recovery take place. But I think the big takeaway is while economic momentum is slowing, the absolute level of growth is still very high. And so it'll be some time, I think, before we get back to that trend, 2.5% GDP growth.
Timothy, we haven't actually asked anyone about Bitcoin today, so I'm going to throw the question at you. You're the lucky one up for today. Just because Bitcoin has been mentioned, and it's been argued against this, but has been mentioned as one of those inflation hedges. We've seen Bitcoin sliding lately, especially on a lot of headlines around crackdowns out of China. What are you making of Bitcoin right now? Are you viewing some of these slides as really good buying opportunities to get into the cryptocurrency, or are you giving Bitcoin a miss right now?
Yeah, I think there are plenty and really exciting long-term applications for blockchain technology. Bitcoin is not an asset that I personally own, nor is it one that we've recommended as a firm in direct sense. But, I think as we continue to see regulation take place, I ultimately view that as a positive. And so personally, I've been adding a little bit here on these dips, and especially in some of the DeFi opportunities that are out there. But I think, as far as Bitcoin being a potential inflation hedge, it it is so much being driven by, I think, this unwinding of leverage and certainly derivatives that we've seen in the market and some of the risk taking that's been, far above what I think is prudent and appropriate for any capital market. And so, it's hard to say. We don't have a forecast on where Bitcoin may go, but I think there's a lot of exciting, opportunities within the DeFi space. And ultimately, this pullback was one that I, personally took advantage of to invest in some companies that, or at least some technology that I think is very similar to a lot of venture capital investments, and obviously in liquid form.
All right, Timothy Chubb, Chief Investment Officer there at Gerard, thanks so much for being with us. And you can step up your investment strategy starting today with a free 14-day trial for Yahoo Finance Plus. You hear our Jared Blickery talk about it all the time. You can get expert research reports, some actionable investment ideas, also advanced portfolio tools, and a whole lot more in a sleek ad-light experience. All you have to do is log on to yahoofinance.com/plus. Coming up, President Biden's infrastructure deal faces a key test in Washington. We'll talk about it next.
Welcome back. Well, budget negotiations are ongoing as Democrats right now are hoping to spend big on both infrastructure, healthcare, and more. We're joined now by Chris Meekins, healthcare policy research analyst at Raymond James. Chris, always great having you here with us. So let's just start with the bipartisanship in the budget negotiations, because we're seeing a lot of tensions really increase over that infrastructure package, which is separate, but still in some measure tied to that budget deal. What do you see as some of the biggest hurdles to that bipartisanship, at least when it comes to the budget?
Yeah, I think what we see is you've got a group of Republican senators that want to work together, want to have a bipartisan package. You have a President Biden who says he wants bipartisanship, but Democrats do not want this to drag on forever, right? So you already had Speaker Pelosi earlier this year saying they wanted to get a budget done by July 4th and get reconciliation bill done before the August recess. Well, July 4th is far in the rearview mirror, and we still don't have sights on when a reconciliation bill could get done. So what they really are trying to do is force a vote today, this afternoon, which is unlikely to pass, but just moments ago, Republican Senator Rob Portman with 11 Republicans, so enough to help you get to 60 if all Democrats vote for it, say they'll have a bill and they'll be ready to vote on Monday to proceed with this bipartisan infrastructure deal.
So, Chris, I know that Senator Portman, the lead negotiator here, the Republican from Ohio, coming out today and saying they still have 4 or 5 issues that they need to discuss with the White House before they bring this infrastructure bill to a vote. Can you just, I know your area is really healthcare, but you sort of have your finger on the pulse of what's happening there in Washington, Chris. What are some of the sticking points left over?
Yeah, at the end of the day, it's all about where they're going to get the money from to offset some of the spending, right? So there was a big fight over whether or not you could just spend more at the IRS, which Republicans, with the history of going after, in their view, the Tea Party and a lot of other actions, were not really gung-ho about spending more at the IRS, with the idea that you can then help collect more of these unpaid taxes that are out there at this point in time. So they had to come up with other agreements on how to pay for it, which is really what we come down to. One of the things they're looking at is within healthcare itself. The Trump administration did this big action on drug rebates that would have actually cost the government more than $180 billion. Well, Democrats want to use that $180 billion by repealing this rule that the courts will likely strike down anyway for a permanent package. However, Republicans now are like, well, let's just delay it a couple of years and get 60 or 80 billion. So it really all comes down to what spending are they going to offset in this, and can they reach agreement there? But with Senator Portman's letter just moments ago that he sent Majority Leader Schumer, I think we're really close, despite what's going to happen in the vote today, of them getting something, be able to advance something the beginning of next week.
So, Chris, as part of these budget deals, essentially Democrats want to expand Medicare benefits to cover dental and other expansions essentially in healthcare. And it is, as your note even suggested, incredibly costly to make some of these healthcare provisions, or to keep some of these healthcare provisions. How likely is it, do you think, that especially on some of these expansions, which we've heard Republicans don't want, we've already seen the long, drawn out and protracted battles, at least when it comes to the Affordable Care Act. How likely is it, do you think, that some of those provisions are actually going to end up on the chopping block?
Yeah, I think that's a great question. And I think we are looking at, if you just look at what they're saying they're going to spend on healthcare as part of the separate $3.5 trillion package. So we're talking today in the votes on the hard infrastructure package, which is roads, bridges, broadband, that type of stuff. And then a separate human infrastructure package that's only going to get Democratic votes if they're able to get it across the finish line. They're talking about expanding Medicare to cover dental, vision, hearing. They're talking about making permanent ACA subsidy increases. They're talking about potentially finding a way to cover individuals eligible for Medicaid expansion in the 12 states that haven't. So really, at the end of the day, that's like $600 billion to $700 billion that they would, generally speaking, need to find offsets within healthcare. And that's a lot of money to cut out of healthcare. So at the end of the day, I think they probably expand one of those areas. So either dental, hearing, or vision. On the regulatory side, Medicare already covers some of dental when it's a medical necessity. So maybe they can say, we're going to broaden that definition that Medicare has, and then it doesn't actually cost the government money. So what we're really on the cusp of, there's a big balancing act. But what Democrats realize is that when you're in the minority, as Republicans are, the best thing you can do is try to delay the majority actions, eat up legislative days, and so that they don't have as much time to get something done. And that's why we're seeing these forcing of votes like today.
Chris, this news broke just a few minutes ago, so I'm not sure if you're aware, but certainly it's been an ongoing story and would love to get your reaction to it. It looks as though states have now announced a $26 billion settlement to resolve those outstanding opioid lawsuits. This could bring, we know, an end to the thousands of lawsuits brought against Johnson & Johnson and 3 of the nation's largest medical distributors, McKesson, AmerisourceBergen, and Cardinal Health. This is a milestone, certainly, in these cases. Do you think this is going to clear the way for money to be received by states, maybe even as soon as early next year? Because goodness knows they need the money.
Yeah, no question. We've seen the opioid epidemic, which had been making some small progress prior to COVID, just really take off again with overdose deaths dramatically increasing. It's really a scourge in the nation at this point. So obviously, if some additional money can be put into states, that's possible. But when I go back and look at other massive settlements, the one that comes to mind is tobacco. That took a good little bit of time to actually flow its way through the states and money to get there and all the way down for people to actually put it to use to make a difference. So I think any settlement we're going to see is probably going to take twice as long as people assume it'll take to get money actually to help individuals that need it right now.
All right, we're going to have to leave that there. Chris Meekins, healthcare policy research analyst at Raymond James. Thanks so much for joining us as always. And coming up next after the break, might be hard to believe, but Taco Bell is facing food shortages. We've got all of the details right after this.
Sorry to burst the bubble of Taco Bell fans out there, but it is the latest fast food chain to face a food shortage. The company notified customers on its app and its website, warning that they might not have some items on the menu, and that is because of national ingredient shortages and delivery delays. Say it isn't so. Brooke DePalma here now with the details in this week's Brooks Bites. Give it to us, Brooke. Not sure if Brooke is. All right, you know what? We're going to be right back. I'll try to get you, and we'll be right back after this. We are back with Brooks Bites and Brooke DePalma here with all the details on this food shortage that Taco Bell is being plagued with. Brooke, what do you know?
Alexis, this is really a mix between Wall Street and Main Street, as these everyday customers really get a lesson in economics when they go to Taco Bell. Customers flocking to social media to share that they can't take or can't purchase their favorites, including beef, chicken, hot sauce, and those 10-inch tortillas that are used to make the burritos. Now, while Taco Bell cannot confirm that these were the exact items that were facing the shortage, they did tell Yahoo Finance in a statement that due to national transportation delays happening throughout most of the industry, we may temporarily be out of some items. Apologies for the inconvenience, and we hope to feed fans current Taco Bell cravings again soon. Now, when I logged onto the app, I tried to order one of my favorites, which just came out in May, that naked chicken chalupa. And sure enough, I got a notification prompting me to check another location, saying that my local Taco Bell was unable to fulfill my order. Now, I do want to note that Yum Brands shares are really unaffected by this. They're bordering the flat line here and remain in the green. So it seems that Wall Street not too bothered by this food shortage, but I can certainly share that customers are.
And if customers don't eat at Taco Bell and instead eat at some other fast food restaurants, Brooke, it looks like they might also be disappointed because Taco Bell is not alone in some of these food shortages. What can you tell us there? What other companies are also impacted?
Kristen, that's right. This is really not just particular to Taco Bell. This is the entire fast food industry that is really facing this shortage, this increase in demand, and not enough supply as people begin to recover and dine out and return. And also, not to mention that labor shortage also impacting the food industry. But another company that is impacted, of course, Kraft Heinz with those ketchup bags. Yum Brands in the April earnings report, CEO David Gibbs saying that KFC, a sister brand of Taco Bell, was unable to fulfill their chicken sandwich orders due to the poultry shortage. And back on June 10th, I visited my local Starbucks, been there again, and they continue to face a national shortage in ingredients. They too are prompting customers to, be patient with them and seek another location if they want a specific menu item that's not available at that location.
All right, Brooke DePalma, thanks so much for bringing us all of those details. I want to go to Jared Blickery now for a look at the oil and energy markets. I'm seeing energy getting a really nice pop and a boost today. Of course, green right all across that screen, Jared.
That's right. It's not just today, and your picture's worth 1,000 words, right? Over the last 2 days, you can see gains of almost 5%, at least 4.5% for both Chevron and Exxon over the last 3 days. This includes that huge Monday sell-off that really whacked energy especially. You can still see a lot of green. So that's pretty impressive, having clawed back all those losses for most of those names. Now, this is a 2-month chart of crude oil. You can see it's holding above $70 a barrel. This is pretty important. This is that level right there, psychologically important before. And it was only 24 hours ago that I was saying, given the small bounce back in crude oil yesterday when everything else seemed to be bouncing, we want to make sure that we get some continuation today. That is exactly what's happening, not only in the underlying WTI, but also in the energy market as well. Now, going forward, what's going to drive the oil market? Probably the reopening story. It looks like the jitters of some of the Delta virus are in the past, at least with respect to the market, and that's going to drive the price action in the near future. Having said that, OPEC Plus is always a driving force, but that seems to be settled for quite some time now.
All right. Thanks so much, Jared, for breaking all of that down for us. I want to turn now to our ETF report brought to you by Invesco QQQ, and we're going to be chatting a little bit about space and space exploration, especially after we saw that successful launch just yesterday from Amazon founder Jeff Bezos. We're joined now by Andrew Chanine, CEO of Procure AM. Andrew, great to have you here with us. So let's just start with the best way and how to best really invest and really play in this space. If space and space exploration is of interest, if you watched that launch yesterday, Richard Branson's launch last week, and you think now is the time to put some money into it.
So I'm not allowed to give investing advice, but that said,
Blue Origin is a private company. It's difficult to get exposure for many investors to that company. So people looking to play the broader space economy, the commercialization of space, and the many different businesses that comprise the overall space industry, we created UFO, the first pure play space ETF that gives investors instant diversification to currently 35 companies from around the world specializing in all different areas of the space industry.
So tell us about how people are getting some exposure. We actually were talking to a space expert yesterday who was saying, while space tourism sort of gets all the glitz and the glam and the attention, investing in the space data is really where the growth opportunity lies.
Space data is one important part of the space industry. But if you look back at the 2019 numbers, the space industry was estimated to be roughly a $424 billion industry. Roughly 1/3 of that is comprised of communications and satellites. And when you look at the various projections for the future, Morgan Stanley at $1 trillion by 2040, Bank of America by $2.7 trillion by 2045. And they view about half of that growth for the space economy coming also from communications and satellites. And UFO has numerous companies from that part of the space segment of communications in our 35 holdings. And there are many different players, and they all do so much and so many varying different things that are also already very vital to many industries today.
Curious how much headwinds you see coming out ahead. We've already heard from a couple members of Congress that are actually talking about taxing and creating other, regulations around some of this space exploration. Do you see that weighing on this industry going forward?
I think it's severalfold. One, I think it's very important to regulate space because space is a precious commodity and it's a new frontier, and we don't want to spoil it in any way or make it harmful for others to be able to explore space. From the other standpoint, having more regulation will help us better understand what can and what can't be done, and hopefully hold everyone to playing by the same rules. So I actually could see that being a very positive thing for the industry as companies gain more confidence in that what they do will hopefully be able to see the light of day, as opposed to spending fortunes on money in technologies that aren't allowed to access space.
I'm wondering how many ETFs there are out there that are pure plays in the space area. You talk about the Procure Space ETF with the ticker symbol UFO, which I think is actually pretty cute. But what other kinds of opportunities do investors have to invest in these basket of stocks without going for individual stocks with exposure to space?
So right now in the US, UFO is the only pure play space fund. And in order to be able to call it a pure play space fund, the underlying index actually needed to prove that over 80% of the index was focused on companies deriving a majority of their revenues from space. And to my knowledge, there's no such other ETF in the US that allows for that. So really, if someone's looking to get pure play exposure to space in the US and looking for a US listed type of security, it's UFO for a basket of pure play names, or you could try to build your own by trying to pick and reweighting and doing all your research on individual pure play space companies.
Now, of course, Alexis asked you a little bit earlier, and, because of our conversation that we had with Chad Johnson yesterday from Space Capital, talking about the fact that space tourism isn't right now the most lucrative or the biggest portion of this space exploration space. However, what are you projecting from the space tourism piece of it going forward? Are you imagining that and forgive the pun, at least that the revenue here, that the investments in space tourism really could get on a rocket ship and head to the moon?
We'd love to see this become a growing industry, because what it does is it allows more people to access space. Right now, the costs are fairly prohibitive for most individuals looking to take this once in a lifetime space tourism opportunity. And I've seen projections from others saying that by the end of this decade, that segment will represent roughly just north of $3 billion annually. But really, if you think about it, the technologies that they're building hopefully will be able to help lower the cost for future travelers, help lower the cost to send things into space. And maybe, the space tourism won't be just a couple minutes going in a rocket with a couple minutes of weightlessness, but hopefully, much longer types of opportunities. And those various technologies that they're building today can hopefully propel us to that reality in the future.
All right, we'll have to leave that there. Andrew Chanin, CEO of Procure AM, thank you so much for joining us today. And coming up, it's our Funding Our Future segment. We'll be chatting expanding supplemental security income. That's next.
In today's Funding Our Future segment, we're shining a spotlight on supplemental security income. Here to talk about it is Kathleen Romink, Senior Policy Analyst at the Center on Budget and Policy Priorities. Kathleen, thanks so much for being with us. I know that you believe this program needs to be simplified and expanded, but before we get into that, just explain for our viewers, what is supplemental security income and what purpose does it serve?
Sure. Well, Supplemental Security Income, or SSI, is sort of the lesser known program that the Social Security Administration administers. So everybody knows about Social Security and its retirement and disability and survivors benefits, but not as many people know about Supplemental Security Income. And as the name suggests, it's intended to supplement Social Security benefits. And that's for people who either earn a very low Social Security benefit or don't qualify for Social Security benefits. And it's intended for low-income seniors and people with disabilities.
So then let's now go into what needs to be changed about it. I know that SSI essentially hasn't changed at all since it was first introduced several decades ago. So what are the overhauls really that we now need to be made for 2021 and beyond?
Pretty much, yeah. So SSI was signed into law by President Nixon back in the early 1970s, and it has been changed very little since then. So one example of an outdated rule that hasn't been changed in nearly 50 years is how SSI treats Social Security benefits. And starting in 1972 and for every year since, SSI recipients can only keep $20 of their Social Security. And after that, their SSI benefit is reduced dollar for dollar. So that's a big deal for a lot of people receiving SSI. A third of them have also earned a Social Security benefit, but they can only keep $20 of it. And it hasn't even increased for inflation in nearly 50 years. And another rule like that is how much people can have in assets. Back in 1972, 401ks didn't exist. IRAs didn't exist. Lots of other, we just weren't expecting people to save as much. And again, the program parameters for savings haven't even been updated for inflation, let alone for, how much we are asking people to save for their futures. And so right now, individuals can only have $2,000 in the bank, or $3,000 if they're a couple. And the last time that was updated was in 1989. If that had been increased since, just with inflation since 1972, it would be 4 times as high. And arguably it should be increased even more now that we're asking people to save more, especially for retirement. So those are 2 of the rules that Congress is looking at right now. And then also looking at increasing benefits and changing some of the really intrusive and outdated rules about accepting help from family members or marrying other SSI recipients.
Do people or recipients need to reapply for SSI year after year?
No, they don't. But if they are receiving disability benefits, they do have what's called a continuing disability review that ensures that they continue to meet the medical eligibility requirements. And they also have something called a redetermination, which just makes sure that people continue to meet those financial criteria.
I want to ask, how costly would it be to make some of these changes?
Yeah, it's a good question. It really varies. There's a bill in Congress right now called the SSI Restoration Act. And if that bill were passed in its entirety, it would be about $500 billion over 10 years. The Social Security actuary just came out with that estimate. And, I don't think that that's probably in the cards for the kind of package that we're talking about right now on Capitol Hill. But if you just took parts of it, like if you just took, for example, the income rule that I mentioned to you and the asset rule I mentioned to you, that would be less than $100 billion over 10 years, significantly less. And that might be something that, that policymakers could fit into a package like the one they're discussing now.
So you talked about expanding it, but what about simplifying it? What is it about the current structure of SSI that needs a little retooling to perhaps make it easier for folks to participate?
Yes, great question. Well, one of the most complicated rules is they're called the in-kind support and maintenance rules. And that's just a fancy way of saying help that you get that's not cash. So, people get, the benefits are so low, less than $800 a month at the maximum. And so as a result, people get help from family and friends. They maybe a bag of groceries, maybe a room to stay in. And if they do, the value of their benefits is reduced dollar for dollar. And in order to administer a rule like that, you have to ask people all the time, are you getting a bag of groceries? Where do you live? Who do you live with? All kinds of intrusive questions asked repeatedly over and over. As it turns out, only about 1 in 10 SSI recipients receives that kind of help. But every single applicant has to be asked. And then over the years, every single recipient has to be asked repeatedly all of these intrusive questions about their lives. It's very expensive to administer, very prone to error. And one thing that's included in this SSI Restoration Act is just getting rid of those rules. There aren't rules like that in any other federal program. And just getting rid of those rules altogether and allowing people, to support their friends and family without being penalized.
I did want to ask about the current racial gaps that do exist inside of the program. Racial inequity is something that Alexis and I have been chatting about a lot, especially during this pandemic. So what are those gaps? Do they exist? What are they? And how can some of these changes essentially eliminate or perhaps narrow them?
Yes, that's a great question. So people of color make up the majority of SSI recipients, and that's especially true for younger recipients, children and adults with disabilities. And, as I said at the beginning, this program supplements Social Security benefits, which are earned through, through work. And so that by improving the supplemental security income program, it's a way of trying to mitigate some of those labor force disparities that we see by race. And it's a way to help counteract some of this inequality that we see in all parts of our society.
All right, we're going to leave it there. Kathleen Romig, Senior Policy Analyst at the Center on Budget and Policy Priorities. Thanks so much for being with us today. And a reminder that Funding Our Future is an alliance of organizations dedicated to making a secure retirement possible for all Americans. Want to get you another check of the markets here before we go to break, because it looks like we are into day 2 of a pretty nice rally after Monday's dramatic sell-off. Once again, we've got financials and energy, also tech helping to lead the advance today, with the Dow Industrials now up better than 250 points. We've got the broader market higher as well, with the NASDAQ up 94. And it looks as though investors are paying attention to some really solid earnings reports for a change, something they weren't doing on Monday, when it seemed as though talk about the Delta variant and how it is spreading like wildfire in parts of the country got investors worried about the strength of our economic recovery. We're going to be back with much more right after this.
Welcome back. Well, Bitcoin has been sliding lately as we see crackdowns on the cryptocurrency. But Bitcoin might have some knights in shining armor to save the day in the form of Elon Musk, Jack Dorsey, and Cathie Wood. Zach Guzman is here to tell us more about their appearance at the B Word conference today. And just a note, that is B for Bitcoin, just to make sure that everyone knows. Zach, tell us a little bit more about their conversation at that conference.
Well, Kristen, this one got kicked off around 2 p.m. Eastern time, and shortly thereafter, we saw Bitcoin hit a new high for the day, crossing that $32,500 level. And it's been interesting to watch it all play out, still ongoing here, because you got ARK Invest, Cathie Wood, alongside Jack Dorsey and Elon Musk. A lot of people listening closely to what Elon Musk had to say in regards to his holdings there, highlighting that SpaceX, as well as Tesla, hold Bitcoin. Of course, we knew that Tesla disclosed that earlier this year, but also his own personal holdings, noting that his holdings in Bitcoin far outsize what he has in Ethereum as well as Dogecoin. A bit of a joke there from Elon Musk, though, when he talked about his holdings, noting that neither Tesla nor SpaceX have sold, nor he, and that he loses money when these things go down. And he admitted to his own influence on the crypto, saying that he might pump, but he doesn't dump. And I got some laughs at the conference there. But also a lot of questions around when Tesla, the company, might return to accepting Bitcoin for transactions. Of course, he's been critical of the way that some miners on the network have not used renewable energies like solar, wind, or hydropower, and really focused in on China. Of course, we saw that crackdown, now kicking some of those miners off the network that had been using coal to power their rigs. So interesting so far here as the panel is still ongoing.
Yeah, fascinating stuff there, Zach. I know that I was watching SNL, I don't know if you did, in early May when Elon Musk was the host. And we were all curious to see what he was going to say about crypto, especially Dogecoin. He did mention it once. I think it was during the news update on SNL. But since then, I mean, Dogecoin is down like 80%. Did he talk at all specifically about Doge yet today? And also, I'm curious if there's some sort of a timeline as to when Tesla is going to accept Bitcoin as a payment again.
Yeah, he definitely talked a bit about Doge, Alexis, and we talked so much about kind of his reasoning, and it baffles a lot of people in the crypto community as to why he's so excited about it. As he laid out, there's kind of that theory there around focusing in on, the most entertaining pieces will win out in a sector, and to him, he combines not just the most entertaining, but also the most ironic, noting that Dogecoin was created as a joke to basically make fun of the rest of the crypto space. And he says that's a piece of why he's so bullish on Dogecoin, and how ironic it would be that would be the one to knock Bitcoin off its path there, specifically in the transaction space. So still putting his eggs in that basket, perhaps behind the humor of it all. And he enjoyed that. But also, as we talk about Tesla's timeline for where it goes in accepting that, he has been pretty vocal about setting the parameters that he wants to see, which includes more than half of the Bitcoin network using sustainable energy, and not necessarily that being the threshold that it has to meet, but at least coming close, as well as a trend towards more renewable energy. And Cathie Wood and Jack Dorsey were quick to highlight that has been the case as of late. Elon Musk conceding that those coal-powered miners in China have been, clamped down on, and we've seen that come off the network. So he did admit that it does look like Tesla will be returning to accepting Bitcoin at some point in the near future. Didn't exactly give a date in his mind, saying that he wants to do a little bit more due diligence there. But overall, you look at the moves today, and investors clearly are kind of cheering some of the takeaways thus far, and the tone coming from Elon Musk there, back potentially on seeing the net positives here for Bitcoin. One of the key things that all three panelists there have been talking about is the net positives that it comes when it comes to Bitcoin kind of supporting people around the globe, maybe less so here in the US, but looking at other countries dealing with hyperinflation, as well as maybe authoritative regimes there turning to Bitcoin as kind of a freer currency, and investors cheering maybe some of the progress being made in convincing Elon Musk to see the light there.
All right, Zach Guzman breaking down the updates from the B conference. Thank you so much, Zach, for bringing us all of those details. Let's just take one quick look at the markets before we wrap up in this 2 p.m. hour. We are seeing the rally continue. The Dow right now up about 260 points, while the S&P 500 and the NASDAQ both in the green. S&P 500 up about 0.75 percentage point. But the 3 to 5 hour is going to kick off next after this break to continue us through to the end of the trading session. They'll be chatting with Brett Taylor, Salesforce Chief Operating Officer and President, on Slack and Salesforce closing that deal. That's up next.
WHO warning of another wave as the Delta variant spreads at a rapid rate. And a new study from NYU finds that Johnson & Johnson's vaccine is less effective against a highly transmissible variant. We will hear from J&J's CFO, Jay Wolk. Bitcoin rallying as Elon Musk and Jack Dorsey come to the rescue. The CEOs of Tesla and Twitter wrapping up a panel right now discussing crypto with ARK Invest's Cathie Wood. Ethereum hitting its highs of the session after Elon Musk confirms that he owns it. We're going to have more on that in just a bit. And Salesforce closing its $27 billion deal to buy Slack. It's the cloud giant's largest acquisition ever. We are going to speak with Salesforce's COO and President Brett Taylor. We've got an hour to go until the closing bell. Welcome back to Yahoo Finance Live. I'm Shauna Smith.
And I'm Adam Shapiro. We're watching these markets climb ever higher since the sell-off earlier this week. The S&P 500, the Dow, the NASDAQ, all in positive territory, around 0.75% each. Let's go to Jared Blickery. He's got the latest for us on these markets. Jared?
That's right. And it's not just the three majors, it's also the small caps. Russell 2000, really the biggest outperformer over the last 2 days. And we can check out a chart on the Wi-Fi Interactive. Now, this is today, and we're going to do a year-to-date where we can really see the sideways price action just bouncing off support here that we saw earlier in the year. So that's important to note. Now, let's check out some heat maps here because we got a mixed picture in the mega caps. So that's not it. That is the 2-month chart of the Dow. Let's get to the mega caps. There we go. So the mega caps are mixed with Facebook up 1%. But I'll tell you what, the standout here in this space are really the chip stocks. We got ASML up 5% in the upper left, followed by Lam Research. Also, Moderna, that's up there, joining the S&P 500 for the first time. Also, Moderna will now be the best performing stock in the S&P 500 year to date. I believe it's up over 100%, 205%, excuse me, year to date. And that's pretty impressive because the next best stock is L Brands, and they're up just over 100%. So we'll check out the sector action real quick before we go. Energy is the real standout here, and financials. Those are the two leading sectors. Utilities and staples are the only ones mired in the red, guys.
All right, Jared, thanks. Let's continue the conversation here as we're looking at gains of all three of the major averages. And for more on that, we want to bring in Malcolm Etheridge, CIC's Wealth Executive Vice President. Malcolm, good to have you. I guess, what do you make of today's move? We saw a bit of a rally yesterday after we got the huge sell-off on Monday. Today, we're posting gains with the Dow up just around 270 points. What do you think's behind today's move to the upside?
Yeah, so the really interesting thing is like the market is playing this collective game of chicken right now is the way that it looks, where nobody wants to be the one to jump out before anybody else, but we all collectively agree that like we can't go on this way for much longer. There's no obvious catalyst for why things are happening. And so like Monday showed us that there are concerns still about COVID. There are concerns now about Delta. And then yesterday and today's snapbacks basically to even have shown us that like nobody wants to be the one to say it's over. It's probably more than what we're getting than any one catalyst that actually makes any real sense.
But wouldn't the contrarian view be that this economy still has a lot of runway, even if it's not going to be the dramatic growth we've seen in the first half of the year? And we're on the verge of a potential funding from Congress through the reconciliation. If they get that through, that would actually give this rally perhaps even longer legs. Wouldn't now perhaps be the time not to be afraid?
Maybe, but I can make the argument that that's already baked in, right? President Biden came into the White House pounding the table and promising that there was going to be an infrastructure deal, and it was going to be the biggest infrastructure deal we've seen in a long time. And so a lot of people have been buying, especially materials related and industrials, based on that fact. And so it could be that the positives for that story have already been baked into the market, and the gains have already been made on the anticipation that we would get the bill that's finally seeming like it's going to make its way through.
Malcolm, I think investors are trying to make sense, or really trying to, I guess, best estimate the threat of the Delta variant and what that means for the market here, at least in the short term. Has it at all, the developments that we've gotten over the last couple of days, has it changed your outlook on the markets here, at least in the short term?
Not really. I think what's happening right now is the government is doing a very good job of keeping us happy. They're doing a really good job of moving the conversation beyond Delta and kind of telling everybody nothing to see here. everything is all right. But I think Monday really showed us just how sensitive we collectively, right, the markets are to bad news around Delta and any other variants, and the likelihood that we'll see more shutdowns to come. And so I think, realistically, we have to at least plan for what if, it is as bad as India has shown us that it is, and as Europe has already shown us that it is, because we sort of are trailing what happens in the European markets, right? Which is why Monday, the market opened, we had a chance to see what was happening in Europe. And that told us, that forecasted what the day was going to be like on Monday. And then same thing with yesterday and today. And I think that right now what's happening is the messaging coming from like the CDC and folks in the know from the federal perspective is they're trying really hard to walk this fine line of keep everybody calm and cool and collected, so that we don't have a similar reaction all of a sudden one day, like we had back in March of 2020, where, the fear got real and the markets reflected it.
Looking for some opportunities here, one of the things you've suggested that people should consider is Lincoln Financial, LNC. I'm thinking, and this goes back more than 10 years, but during the great financial crisis, and I'm thinking of the insurance side, they had some real, it was sketchy there for a while. So why now do you think they're a positive equity to look at?
So the interesting thing about Lincoln from what we've been seeing is that they're going through this transformation where they're getting away from doing things the old way, right? They're one of the few insurers, because you got to think about insurance and even banking as sort of the slower, more conservative industries to change. And in Lincoln's case, they're moving more to use once again the most overused phrase in finance. They're moving to where the puck is going and not so much staying where it is. And so in Lincoln's case, we can see where they're really revamping a lot of what younger consumers, millennials, Gen Xers even, don't like about the insurance industry. And they're streamlining things and stripping out some of the quote unquote bad habits, if you will, that have gotten a bad taste in a lot of people's mouths when they think about the insurance space. And Lincoln seems to be on the forefront of leading some of that change. And so we can really see where there's going to be an opportunity over the next 2-3 years while they're still transforming things, but other insurers are staying put, that Lincoln, it seems like, is gonna have a really good opportunity to the upside, where not a lot of people are thinking about insurance as a good place to invest right now.
Hey, Malcolm, what do you make of this whole inflation debate? Because we heard from the Fed, Jay Powell, insisting that is transitory. Some out there that are a little bit more, I guess, skeptic as to whether or not that will hold true. It sounds like you might be on the case that maybe it's not as transient as we initially thought it was. Why is that the case?
Yeah, I feel like the resident skeptic now, as we've going on with sort of what's not happening versus what we're being told. But I think that falls into the same camp as the federal government, the Fed, doing everything they can to keep us calm. And one of the ways that they're doing it is by pulling down everyone's fear around inflation, where they're saying it's transient, it's not going to be here forever. We don't really have to adapt and react to it the way the Federal Reserve normally is supposed to, because we don't expect it's going to last here forever. But ask anybody who's bought gas recently or groceries recently or any of those kind of staples. We've all seen the pressures of inflation already, right? And at the same time, we've got cash piles that are at historic highs, right? Everybody's hoarding cash right now. That's constantly dominating the news. And also workers can't get butts to fill, employers can't get workers' butts to fill seats, right? So at a time when we have not enough labor, we also have way more supply of cash than we actually have goods to meet that. And so that's kind of the challenge that the market is trying to work its way through. And I think calling it transient is really underselling just how much cash is sitting on the sidelines and has the buying power to really, drive these prices up in the near term, sure, but also more in the intermediate term, 12 months plus.
Malcolm Etheridge, CIC Wealth Executive Vice President. Thanks so much for taking the time to join us. We want to get to some of the other big headlines of the day. Next up, we're talking COVID. WHO out warning that we are starting to see the beginning of another wave. We're going to have more on that after the break.
All right, let's check markets to see where we stand as we head toward the closing bell. Roughly 45 minutes to get there. And you can see as we pull those markets up that the Dow is still rising at this point. We're up about 274 points. The S&P 500 up 33 points. NASDAQ up 111 points. So much for the sell-off earlier this week. The volatility continues. But something else that remains volatile is concern over the various variants of the COVID-19 virus, especially the Delta variant. Let's bring in Anjali Kamlani with the latest from the WHO. Anjali.
That's right, Adam. Thanks so much. We definitely heard from the World Health Organization Director General, Dr. Tedros, today addressing the games before they begin, the Olympics, and talking about how while it was, delayed, it's not gone away, but still we are looking at the Delta variant and the concerns that are piling up there. We know that we're seeing the surges here in the U.S. as well as across the pond in the U.K., where they have really high vaccination rates. And so that's really spreading the concern about what happens to some of the more vulnerable countries out there that have not had the luxury of access to vaccines, as well as the high vaccination rates that we're seeing today. We know there are also reports out there of the U.S. sitting on a stockpile of some vaccines that do potentially could go out there and help the rest of the world. So a lot of concern right now brewing. Dr. Tedros with some strong words there saying that the pandemic is a test and the world is failing.
All right, Anjali, thank you. We want to continue this discussion. We're going to bring into the stream Dr. Sejal Hathi, faculty at Johns Hopkins Bloomberg School of Public Health and host of Civic RX, the podcast. It's good to have you here. Want to ask you first, this concern from the WHO. I mean, they missed it originally, kowtowing to the Chinese authorities and not letting the world know we had a problem. What should we take from there now trying to warn us? Are they behind the eight ball? Are they playing catch up?
Well, firstly, I want to emphasize my profound respect for Dr. Tedros and all of the brilliant scientists and physician policymakers at the WHO and other international policy-making bodies across the globe who are urging caution, who are advocating vaccine equity. Look, this is an unprecedented global pandemic. None of us, even what many thought to be the most prepared country, that is ours, the United States, none of us was equipped. All of us made mistakes in the course of the last 18 months. But what Dr. Tedros stated is that we are now in vaccine distribution and allocation around the world. 75% of all vaccine doses, that's more than 3.5 billion shots, have been administered in just 10 countries. Only 1% of people in low-income countries around the world have received even just one shot. We have the magic bullet. Vaccines are safe, effective, they work. And this pandemic will continue to rage unabated so long as we don't afford equal access to that magic bullet to everyone across the globe. So it's imperative that as infections rise everywhere, including here at home in the United States, that we do more to ensure that we get shots in arms.
Dr. Halpy, what are you personally seeing just as the number of cases continue to tick up? Because the last time that we spoke, we're in a bit of a different situation now as the Delta variant continues to spread and very rapidly throughout the country. So what are you seeing on the ground?
That's an excellent question. You know, we are in a different place now than we were even just a month ago. The number of cases have increased by about 3 times. The number of deaths have nearly doubled. But what's important to highlight here is that more than 99% of recent deaths have occurred among the unvaccinated. The rates of COVID cases in poorly vaccinated counties are more than twice as high as those in robustly vaccinated counties, those with at least 60% of their population fully vaccinated. So look, if you are unvaccinated, this is probably the most dangerous point in time of the pandemic to date. It's incredibly important that if you're eligible, you get that vaccine. Otherwise, unfortunately, we're going to continue to see cases rise, and with that, hospitalizations and thereafter deaths.
Doctor, what should those of us who are fully vaccinated do to protect not only those who are not vaccinated, who are adults, but children in particular? Should we voluntarily just mask up until further notice?
So a lot of this, I would say, depends on a few factors. We are approaching August. Many schools are going to, again, resume classes this fall. Whether or not to mask will depend on a few things. One, what are case rates in your local community? Generally, communities should aim to have below 4 daily new COVID-19 cases per 100,000 people. If you belong in a neighborhood, in a community, in a city that has met that benchmark, you are vaccinated, you probably don't need to mask. Unfortunately, and in contrast, if you belong to a community where vaccine rates are very low, like many states in the South and the Southeast, you are probably, and you're in an indoor setting where vaccinated and unvaccinated people are mixing, you probably should consider masking. Likewise, if you are living with children who are unvaccinated, with immunocompromised folks, that is, people who are on immunosuppressive drugs for autoimmune or cancers diseases, or people who haven't been able to get the vaccine to date because of said diseases, and you are mixing with unvaccinated folks, then in turn, too, you should probably mask. So it depends on a few factors. What I would strongly encourage the federal government to do is to roll out additional guidance about indoor settings where unvaccinated and vaccinated people are mixing. Because right now, with the increasingly transmissible Delta variant, a lot of us are at risk.
Doctor, real quick, we only have about a minute. a minute here, but the Johnson & Johnson shot, that the study that was out from NYU last night, basically saying that the Johnson & Johnson vaccine isn't as effective against the Delta variant. I guess, how should we be viewing booster shots? And if you are one of those people, one of the, I believe it's right around 9 million people who have gotten the Johnson & Johnson vaccine, should you be thinking about getting a booster shot at this point?
So I think we're all going to need booster shots at some point. It's not really a matter of if, but of when. And I would not be at all surprised if those who have received the Johnson & Johnson vaccine are earlier asked to get boosters instead. But there are a few qualifying caveats that we should consider when thinking about yesterday's study. Firstly, that study has not yet been peer reviewed. It's not been published in any scientific journal. It is a preprint. And so a lot of those results we have to view, therefore, with a grain of salt. Secondly, that study was based on experiments conducted in a lab. It was not based on real world examples. Thirdly, and critically, the study looks only at neutralizing antibody levels, not the full spate of our immune response, not vaccine effectiveness. Therefore, extrapolating vaccine efficacy from that one study is a little suspect. And finally, what we do know from the real world data that we have is that there are not meaningfully more breakthrough disease cases, hospitalizations, or deaths with the J&J vaccine than with those who received either the Pfizer or the Moderna vaccine. So all of the vaccines that we have right now are safe and are effective. We'll see what the CDC says in its meeting tomorrow to discuss boosters. But as of now, I think that we should all, those who received the J&J or the mRNA vaccines, rest easy that the vaccine that we got was safe and effective.
Dr. Sejal Hathi, thank you so much for joining us. Dr. Hathi is on the faculty at Johns Hopkins Bloomberg School of Public Health, also the host of the podcast Civic RX. When we come back, we're going to be talking about the Salesforce Slack deal. But first, I want to remind you that you can step up your investment strategy with a free 14-day trial for Yahoo Finance Plus. Get expert research reports, actionable investment ideas, advanced portfolio tools, and more in a sleek, ad-light experience. Check it out today at yahoofinance.com/plus.
Salesforce shares are up just around 1%. The company, a big day, though, completing its $27.7 billion acquisition of Slack. Now, we want to get to Julia LaRoche, who is joined by Salesforce COO and President Brett Taylor. Julia?
Well, thank you so much, Shauna. And Brett Taylor, great to have you on the program again. And I've been wanting to talk to you ever since the third quarter conference call of last year when Mark Benioff revealed that when you and Stuart Butterfield of Slack presented this vision for him, he talked about being immediately sold. So I kind of want to go back to the genesis of the deal. What did you and Stuart recognize and then pitch to Mark Benioff at Salesforce to make this record acquisition?
Well, thank you for having me, Julia. You know, what we saw in Q3, I think, has even been amplified since then, which is we're in an all digital work anywhere world and we're not going back. You know, salespeople aren't just getting on airplanes to sell in conference rooms anymore. They're selling via Slack and Zoom. Call centers that used to be in buildings are now in the cloud, you know, and if you're trying to resolve a case, you're doing it over Slack, you know, and if you talk to any retailer in the world and you're talking about how do they run Cyber Week with their agencies and their merchandisers, their command center for Cyber Week is inside of Slack. And so we have this vision that as every company in the world has a growth agenda right now, as this economy reopens, Slack and Salesforce, our Customer 360 platform, are really the operating system for growth in this all digital work anywhere world.
I'm actually using Slack right now as I have this conversation with my fellow host here. You know, Brett, when we talk, we often talk about products. I know you as someone who's a big name when it comes to building products. Were you using Slack at the time and kind of had this aha moment yourself? Take us inside that conversation, the initial conversation with Stuart.
Well, first, I've known Stuart for years. You know, well, I was working on social networks. He was working on social networks, and I've just been a deep admirer of him as someone who can really see the future and build it. There's few entrepreneurs of his caliber in Silicon Valley. And for me personally, just the opportunity to work with him every day is just a huge benefit of this deal. But as you said, you know, we were users of Slack before, but we also saw so many in our customer base, like IBM, who has 380,000 employees using Slack every single day to connect to things like Salesforce, to connect over 3,000 workflows across their business. And when you look at it, it's not just a translation of the analog way of working to the digital. It's truly a transformation of the way we work. And I think as the entire world, because of this pandemic, is collectively reimagining the future of work, I think Slack really represents a best-in-class way that we can work digitally. And I think, you know, as companies look forward in this pandemic and as we recover and as the economies reopen, every aspect of the customer, employee, and partner experience has to be reimagined. And I think Slack is the tip of that spear for every company with a growth agenda right now.
Well, I also want to bring this up with you as well. When you talk about kind of this future of work, and obviously no one saw the pandemic coming, but you know, it kind of was this massive work from home digital experiment. Do you think you all would have done the deal at some point? Do you think it would have been inevitable if we didn't go through what we went through in the last year plus?
It's a wonderful question. My theory is that this pandemic didn't create new digital trends, it accelerated them, sometimes by a decade. You know, I think that with all these new digital tools, aspects of our lives had already been digitized. Aspects of commerce had already been digitized. But just to give you one example of that, you know, in 2019, around Thanksgiving, we talked about Black Friday and we talked about Cyber Monday. Last year, we just talked about Cyber Week. And to me, that just represents the digitization of the economy. And I think that the trends that Slack represented, which is really a digital HQ for your company. You know, our HQs aren't in San Francisco and New York anymore, they're in the cloud. I think that would have happened, but I think it happened about a decade sooner because of the pandemic. And I think it's really driven home for every single one of our customers that we need to digitize, and we need to digitize quickly. So I think Slack's relevance certainly was heightened by the pandemic. And as we reopen the economy and all of our customers deal with this digital imperative, Slack and Salesforce's Customer 360 could not be more relevant at this moment in time.
I think all of us agree 100% that Slack and digital platforms like this make work in some ways more efficient. But how, when you talk about Customer 360, how do you address the issues that many of us get inundated between email, text, and Slack? For instance, today had an issue that involved 3 different people, 3 different Slacks, and it ended with saying, oh, you know what expletive, let's just get on the phone. How are you going to improve it?
It's a wonderful question. What I would tell you is, when this pandemic happened, it happened so quickly, and most of us simply translated the way we were working before to the digital world. Maybe you had a meeting that was in a conference room and you moved it to video conferencing. I really think the new way of working is transforming the way we work, moving to more asynchronous forms of communication, really integrating all of your employees, all of your customers, all of your partners, all of your applications into really a single source of truth for your business. And, I think right now, many of us are sort of in this awkward middle ground, where we have all these digital tools, but we haven't actually transformed our company cultures. And I think that's really the opportunity for leaders right now. And you're seeing this all over. CEOs coming out, some of saying, you have to come to the office, other CEOs saying, there is no office. I think we're in this grand period of experimentation. But the thing I can tell you is the future of the work has not been written yet, and our cultures are being redefined before our eyes. And I think Slack and Customer 360 are going to play a big part in that. And I think it's an opportunity for leaders to step up right now too, and really define the culture they want to have on the other side of this digital revolution we've had this past year.
Brett, what are you hoping to see just in terms of growth numbers from Slack? Because I know that there was some concern ahead of this deal that some of those numbers were slowing. And then also just to that point, I guess, how does this better position Salesforce against some of the competitors out there, and specifically a big name like Microsoft, which has a big presence in this space?
We're really excited about the prospect for growth in Slack. I think the opportunity that we've seen at Salesforce with our previous acquisitions like MuleSoft and Tableau is our ability to take these incredible technologies, package them up as a solution to help our customers with their most strategic digital transformations. I think a great example of this, as I mentioned on our Q1's earnings calls, in Q1, 8 of our top 10 deals included Tableau, and 5 of our top 10 deals included MuleSoft. We've taken these technologies, we really integrated them into our value proposition. And I think that's a real opportunity when we bring Slack into Salesforce to really accelerate the opportunities for Slack. And as it relates to competition, we really are looking at it differently. We're really driven by our customers, and we think that's the way that we win. We're relentlessly focused on the success of our customers. And, we think that right now, when you look at the digitization of the economy, from the employee experience all the way through the customer experience, by focusing on bringing Slack together, the Customer 360, helping every sales team in the world, every customer service team in the world, every marketing team in the world transform themselves, will not only help our business, but help our customers accelerate and find success in this new normal.
Brett Taylor, thanks so much for taking the time to join us today, COO and President of Salesforce. And of course, our thanks to Julia for bringing this interview to us. We are going to take a quick break, but when we come back, Johnson & Johnson saying that COVID-19 vaccine sales to total $2.5 billion this year. Coming up next, we'll hear from J&J's CFO, Joe Wolk.
All right, it is time for the 2 and 2. Let's take a look at some of the stocks that I'm watching, some of the stocks that Shauna's watching. And first up, look at United Airlines. Now, they reported after the close of markets yesterday. We heard from Scott Kirby today. Shares had been trading higher earlier this morning. They were up about 2%, and right now they're up even higher, almost 3.5%. CEO Scott Kirby, during the earnings call this morning, said he expects the recovery in travel demand to remain largely unabated despite the increase in COVID-19 Delta variant infections. They also ended the quarter, by the way, $23 billion in liquidity. They had revenue right in line with expectations, $5.4 billion. Also, load factor, 72%. It was higher than what the street was estimating. Tomorrow, let's look at Southwest Airlines because their shares today have been trading up as well. We are up 3.5% for Southwest. They have resumed their international routes to Mexico and a few other places, Los Cabos, Cancun. You can have a good time if you want to get out of the United States. You can go Southwest. They're also going to be talking in the earnings report tomorrow about the transition that's coming up in 2022. Bob Jordan will be the new CEO, but he's not new to Southwest. He has been there since 1987. And again, with Southwest, you're looking at all international travel resuming early 2022. They also say they will be cash flow break even in June. We're going to find out if they live up to that. Shauna?
Adam, let's take a look at Netflix. We covered their earnings yesterday, but shares under a bit of pressure today following those missed earnings results that they had out, and then also the fact that guidance came in a bit light. So you can see shares off just around 3.5%. Now they're forecasting just in terms of their subscriber growth for the coming quarter. Netflix saying that they now expect to see 3.5 million new subscribers. The street was looking for about 2 million more than that. So that, of course, came as a disappointment. We're seeing some reaction from the analysts that cover this name. One name, KeyBank, cutting its price target by a bit to $645 a share. So still substantially higher from where it is trading today, but now they're seeing some worry about operating expansion and that could potentially moderate here going forward. Netflix has been a name that has struggled really to gain any momentum since the start of the year, with shares off just around 5.5%. Flipping over to Coca-Cola, it was out with earnings before the bell this morning, beating the street's expectations. Earnings per share coming in 12 cents above what the street was expecting at 68 cents a share. Revenue jumping to $10.1 billion. Now this is topping those pre-pandemic levels, so getting it back to the type of growth that we saw in 2019. The company also raising its guidance. Now, all drink segments reported double-digit growth during the quarter, certainly something to celebrate. As you can see, shares moving to the upside with Coca-Cola trading just above $56 a share. Adam?
All right, so we heard from Johnson & Johnson this morning, the pharmaceutical giant, reporting their earnings for the second quarter, revenue in the quarter over $23 billion, and they expanded their guidance, full-year guidance, for 2021. It's going to be around, at the best end of the guidance, $93.3 billion. But I spoke with Joe Wolk, who is the CFO, about the COVID-19 vaccine and other issues that are facing the pharmaceutical giant. And here's what he said.
What I would say is, the results across Johnson & Johnson is, at least during my tenure as CFO, I don't know that we've ever been in a healthier position. All segments are really clicking on all cylinders. You've mentioned medical devices. So we knew coming into the quarter, it was going to be strong, right? The comps were going to be favorable to Q2 of last year when elective procedures were essentially shut down. But you look at the underlying business and you compare it to, let's say, a more normal quarter of Q2 2019, that business is up 7%. Pharmaceuticals is up 17% and consumers up 6% versus that same time horizon. In medical devices specifically, in addition to the favorable comps, we're seeing just better execution. We are leading in some market share where we were already leaders. We're taking share where we weren't leaders. And we just have a much better level of cadence of innovation coming out. So we've got 17 new product launches in that segment, on pace to have 25 this year. And over the last 2 years, it's been closer to above 30. So we're in very good shape. Ashley McAvoy and her team have done a great job. And we're seeing great growth where we've placed investments, specifically in areas like Asia Pacific, as well as here in the US.
You brought up pharmaceuticals, $12.59 billion in the quarter. Infectious diseases, which includes the COVID vaccine, $1 billion. But in your guidance, and we should point out, you raised full year guidance, $90 billion to $90.8 billion. But if you include the COVID-19 vaccine that J&J has, $92.5 billion to $93.3 billion. You're really expecting demand for the vaccine to increase, aren't you?
We know, it's not only an expectation, it's almost a certainty, quite frankly, given the advanced purchase agreements that we have around the world. There's a lot of people who see benefit with the one shot. Certainly, we had very strong data published in the New England Journal of Medicine a few weeks ago that was peer reviewed, indicating that the durability is at least 8 months, better than other vaccines that are out there. And it really is taking on all variants, inclusive of the new Delta variant.
When we talk about the vaccine, you talked about peer review. There's a study which has not been peer reviewed that says your vaccine might require a booster shot. We should point out Pfizer's vaccine, they've said they're going to want people to get a booster shot. Where does J&J stand on that?
Yeah, so, we saw the study last night as well, Adam. I think we all have to be just a little bit cautious on a test tube study that looks at one element of protection. The data that I just referenced really looks at neutralizing antibodies as well as T cell activity for complete immunity protection. We know that that's very solid data, again, peer reviewed, as you noted. And I think it's really the responsible act to rely on health officials who have all the data at their fingertips to determine when and if boosters are needed for any of the vaccines. At this point, they haven't done that yet.
I want to switch gears when we move from the vaccine to other issues. There are the reports, which are not confirmed, that you're looking at perhaps spinning off the talcum powder and affiliated talc products into a separate business, then put that new entity into bankruptcy as a way to deal with, I think Reuters was the entity that broke the story, something like 30,000 plaintiffs. How do you protect the balance sheet, the company, the world's third largest pharmaceutical company, from lawsuits, whether they have merit or not, from constant litigation?
Yeah, so let's speak specifically about the talc. We're going to continue to defend the safety of that product based on decades of independent research by some of the best institutions in the world that prove that product was safe. With respect to the current Reuters report, we can only speculate that now attorneys are speculating about our legal strategies. They're probably somewhat frustrated with the Daubert ruling hearing of last year, where much of the so-called expert testimony from the plaintiff's attorneys that was being offered in these suits it has been barred from being presented, as well as experts themselves. So, we're going to continue to defend based on the safety record and let science dictate.
And it's not been announced yet, but a lot of news organizations reporting a potential opioid settlement. This would certainly remove a cloud from the balance sheet, would it not? Can you share with us when this might be coming down the pike?
Yeah, so obviously there's a number of parties involved in that. Adam, it's really been 2 years now that we've been on record saying that we've offered a settlement, we've reserved for it fully. So we'd like to see that come to conclusion in short order, but it is a complicated process, and we'll let that play out. But it's really not new news from a Johnson & Johnson perspective. We've certainly communicated this with the investment community and more broadly in hopes of finding a settlement.
And we'll be right back after this.
About 14 minutes to go in the trading day. You're looking at gains across the board. The Dow up 257 points. The S&P holding on to gains, as well as the NASDAQ up just over 100 points. We want to talk more about this with Brian Levitt. He's Invesco's global market strategist. And Brian, it's good to see you again. We've had quite a bit of volatility, I guess you can say, over the last couple of days. But today, as well as yesterday, we were looking at some gains across the board. What do you make of the recent action that we've seen in the market?
Yeah, so the market has been assessing what was going to be a slowdown as we start to move out into 2022. And that's why you saw interest rates come down as significantly as they did. I know that when you started to get into the 1-point teens on the 10-year rate, it had some concern that something more ominous was brewing. I have found that when the 10-year moves towards the 2, the 10-year comes down, that tends to be less of an ominous sign than when the 2 years moving up towards the 10, which tends to presage recession. So I think it's mostly just a market that is assessing a slowdown for a variety of different reasons, but we probably overdid it, particularly with regards to where the 10-year rate went earlier in the week.
Well, but the 10-year right now hasn't really recovered much from where it went earlier in the week. And what is that telling us? Because we keep getting told inflation, yet the 10-year yield's 1.28. I mean, this is a mixed message.
Yeah, I've never been in the inflation camp, and I've always believed that of all the indicators, the bond market gets it right most often. So we certainly have to pay attention. So yeah, when I say the bond markets come up a bit, it's 1.15 to 1.28, but still a very, very low rate. And that's telling us that growth is likely to be pretty modest over the next number of years, and inflation is likely to be pretty modest. It suggests to me that we're likely to move from what had been a disastrous recession to a very fast recovery, to an expansion of the economy that's played out relatively quickly, to a slowdown and call it a stabilization of growth, where you get back into a more normal environment, something that we got used to from, call it, June 2011 through 2019, which was a more modest growth environment. And I think we'll get back there. This is pent-up demand that had gotten unleashed on the economy. There was a lot of fiscal support unleashed on the economy. The fiscal support starts to fade. The pent-up demand is unlikely to be sustainable. And in my opinion, nothing structural has really changed. And that's what the 10-year rate is telling us.
Right. When we take a look at some of the leadership, though, I guess that's changed in recent days, just with this concern about the Delta variant, some of those reopening plays that have been catching a bid over the last several weeks. We saw some selling action, those especially on Monday. Are you expecting to see some leadership rotation as a result of the fact that investors are getting more worried about the Delta variant?
Yeah, to the extent that the Delta variant raises concerns, then you would think some of those names that are more tied to what we had called the reopening would be under some pressure. But I think importantly, I don't think that the Delta variant, let's hope that the Delta variant is not the event that leads to, huge shutdowns again of the economy. 65% of American adults are vaccinated. So that is a positive sign, particularly when you see that most of the hospitalizations or serious illness are coming from people who have not been vaccinated. So I don't. What I would say about market leadership is, we had a recovery phase. That's really economically sensitive parts of the market do well. That is the deep value. We're moving into more of an expansion. You tend to see returns sort of level off, whether you're talking about growth versus value, high quality versus low quality. You tend to see a broadening of that market, and we're seeing more of the tech names participate. And as you start to move into a slowdown, which what I would say is next year, you're probably likely back to the more growth-oriented parts of the market outperforming anyway. And so, a lot of those reopenings caught a bid. There may be some more room for that to play out, particularly if the Delta variant does not cause rolling shutdowns of the economy. But I would suggest that investors start to position themselves for a slowdown in economic activity anyway, which would take us back to the more structural growth businesses outperforming.
Brian Levitt, always great to speak with you, a global market strategist with Invesco. We will talk with you again soon. Just about 9 minutes to go until the closing bell. We're back with more from the floor of the New York Stock Exchange right after the break.
Let's go to the floor of the New York Stock Exchange to get the latest from Jared Blickery with roughly 6 minutes to the closing bell. Jared?
That's right. We're capping off a nice two-day rally here that has recovered all of the gains from Monday, or all the losses from Monday. And let's check out the Dow on the Wi-Fi Interactive here, up about 0.75%, over 250 points, just hovering around session highs. So pretty impressive price action. And let's hit some heat maps now and see what's going on inside the market. Looks like a probably still mixed picture for the mega caps right now. Still waiting for my interactive screen to update. But we have seen sector action that's very conducive to energy, financials, industrials, cyclicals, and so that means the value in cyclical trade probably back on, at least for the interim. And I'd be surprised if the major indices weren't able to notch new nominal highs. Of course, all eyes are on earnings. We have big tech earnings coming out, especially next week. We're going to be having those to you shortly. But in the meantime, I'll tell you what, we got a nice rally underway and things are looking up, except for Bitcoin. Bitcoin's still looking a little weak here, guys.
All right, Jared Blickery, thank you. We're going to see Jared in just a minute. And after the break, we're going to go to the closing bell. All right, 2 minutes roughly to the closing bell. We want to bring into the stream right now James Camp from Eagle Asset Management, Head of Strategic Income. Also, Keith Lerner, Truist Advisory Services, part of the Chief Market Strategist and Managing Director, Portfolio and Market Strategy there. It's good to have both of you here. James, I want to ask you a quick question. The 10-year yield, we were talking just in the last hour, below 1.3%. You would think a lot of people are panicked and they're trying to protect some money, but you think that the 10-year, the bond is overbought. Why?
Well, we had a big sell-off to start the year, so some consolidation was likely, but the move down to the 120, frankly, was quite concerning. Either we were going to have an additional lockdown or curtailment of growth, or somebody's off sides and somebody's got it wrong. In our opinion, the inflation story is just gathering steam. We think it is somewhat decidedly more than transitory, and real yields are just too negative to represent any value. So we're going to watch very closely as the summer rolls along, the Jackson Hole commentary, what comes out of there in terms of taper talk. But more importantly, and this is not to be too curt about it, but Labor Day is usually when the bond market wakes up and pays attention again. And they're going to be looking at some big data on the inflation front that we think is going to be problematic for these yields going forward.
We will keep an eye on that inflation data. I want to take just a breather right now because we have roughly 45 seconds to get to the closing bell. I want to take a look at where we stand. The Dow, the S&P 500, and the NASDAQ still on their recovery from the sell-off earlier this week. Some of the Dow components, though, that are struggling today, you've got Walmart, Apple, and Amgen in a bit of trouble. They're off. I mean, Walmart's only off 0.5%, but you got Apple down almost a full percent, Amgen off almost a full percent. Apple, we, of course, learned just the other day that they are susceptible to the spyware, and those of us who fight with our Apple devices trying to restore them don't wonder why they might be falling today. But as we head to the closing bell, you should know that those are the three stocks leading the Dow at the bottom.
And that does it for today. Again, you're looking at gains across the board. We saw some buying action here into the close. The Dow closing up 285 points. Outperformers in the Dow today: Chevron, Goldman, and Boeing. You can see the S&P closing up just around 0.8%, and the NASDAQ adding 133 points. In terms of what was working today, energy by far a standout today, with the XLE closing up just over 3%. Financials and materials rounding out the top performers sector-wise. But we want to bring back in James Camp and Keith Lerner to help us further break down some of the action that we've seen recently. And Keith, another day of gains following Monday's sell-off here. Certainly the trades that are working are, as Adam said, some of the hardest hit on Monday. I guess, what does this tell you just in terms of how the market is viewing the developments on the Delta variant and how big of a threat it could potentially be?
Yeah, well, first, great to be back with you. You know, Monday was pretty gloomy. I think it was really over the weekend where the public really started to understand the COVID cases rising. But I think after the sell-off, I think as you take a step back, I think what investors have felt a little bit more comfortable with is that you're seeing a bit of a decoupling between new COVID cases and deaths. And this isn't 2020. I mean, we're in a much better position as far as the procedures and medical treatments. Businesses have adjusted, consumers have adjusted. And also with these COVID numbers going up, you know, we think it's more likely that the Fed tapering gets pushed out a little bit as well. And also, I mean, at the end of the day, when the 10-year was at 1.15, unless you think we're going into recession, the relative attractiveness of equities only increased.
James, I'm curious because you do believe, as you said, that the bond market will wake up around Labor Day. And we had heard in the notes that Keith sent us that he's expecting the economy to stay on track. So if Keith is correct, James, what is that going to mean for us come September when people, not only the bond market, but also equity investors are waking up?
Yeah, to the extent that we can take income opportunities in the equity space, we are doing that, and we're doing that at a large overweight because of the overvaluation of the bond market. The things that we're looking at that are non-transitory, we're about to roll up owner equivalent rent into the data series of CPI, and we think that's going to come in very hot over the next couple of months. There's some inertia behind that, you know, if we get a 6% year-over-year print on owner's equivalent rent, we are in the mid to upper threes on CPI. Again, a 125, 130 10-year does not foot with that. And we're seeing some relaxing in commodity prices, but they're still elevated. And we're seeing these supply chain disruptions. We're seeing the longest gap between an order and a delivery in history. And most importantly to us, when we're on our earnings calls, we're hearing pricing and we're hearing cost and we're hearing companies moving the needle for the first time in over a decade on pricing. To us, that is suggestive of a reflating economy, good for risk assets, good for equities, but the bond market is going to have to get itself reset here in the next couple of quarters, in our opinion.
So Keith, with all that in mind, I guess just in terms of some of the opportunity then going forward, how would you suggest investors position themselves, especially over the next couple of months?
Yeah, well, what we've seen more recently over the last month or 2 months is a big move back into the mega cap tech stocks. We actually think that's not the right move for the second half. We think that money will rotate back into some of these cyclical areas that we've seen a bounce here more recently, because we think, you know, earlier this year it became such a consensus trade about going to the cyclicals. It got overloved, and we've seen a reset. we just before this rally, these areas became the most oversold we've seen since earlier this year. And if the 10-year Treasury does gradually move up, if the economy moves forward, and even if it's off that peak economic level, but is still above trend, we still think that's positive. You look at something like the financials, still a big discount to the overall market. And then small caps. What's interesting about small caps, the relative valuations of small caps are now even cheaper than they were last November before they had that big move up, and earning trends are firm. So we still think there's a lot of opportunity. It's likely to be a bit sloppy over the next few weeks and even the next few months, but we would still be positioned more on the value side.
Keith, I'm not asking you to pick a retail stock, but I'm curious. I saw a report that back to school spending is going to be ginormous. I'm making that word up, but enormous, as lots of kids finally get back to school after the pandemic. Would it be time to perhaps take a step back from tech and maybe look at some old-fashioned retail? I realize that's not a popular move for a lot of people, but there's a huge spending spree about to come.
Yeah, I think it makes sense. When you look at, like, say, the consumer discretionary sector, we're actually underweight because it has a lot of growth areas within that. But on some of these subcategories, these reopening plays that have been hit, we do think there's an opportunity. Our more favored areas, though, are still more like the financials, energy, industrials as a whole. But those other areas that you mentioned should also do well as this reopening play continues.
James, what do you think? Where are you seeing the most opportunity?
I think to the income investor, they almost have to decouple their eyes from the S&P, because 20% of the S&P is tech that doesn't pay dividends. If we're looking for the solution that equity income can provide, I agree with Keith, particularly on the financials. You know, we moved out of, say, the preferred sleeve in the capital structure of financials to start the year, went into the common sleeve on the steepening trade, and that has performed beautifully. I think dividends are strong. I think they're going to be continuing to grow. And as this interplay between debt, equity, and different parts of the capital structure continues, with record corporate issuance, record indebtedness, most times for the benefit of equity holders, we have to tell our individual investors, our retail investors that are not style boxed, be flexible within capital structures of great companies and look to the solution and the drawdown and the income earned, not necessarily a benchmark to evaluate your strategy.
I want to get you back to, by the way, around Labor Day as the bond markets wake up, because I think it'd be great to be looking at that. James Camp, Eagle Asset Management, Head of Strategic Income. Thank you. Keith Lerner, Truist Advisory Services. Always welcome here, both of you. Thank you for your insight. Got to turn our attention to something that happened today. You remember in the Mel Brooks film, History of the World, where he says, "It's good to be the king." Well, actually, it's better to be Jamie Dimon. Let's bring in our editor-in-chief, Andy Serwer, because Mr. Dimon just got the kind of huge stock award, at least options, that would make some people jealous. What do you make of this?
Well, it's a little bit surprising, Adam, because, you know, people have been waiting for an announcement from JPM and from Jamie Dimon that this is it. The time has finally come for him to step down. After all, he's 65 years old. There's been talk of succession plans. He recently, well, a couple of years ago now, named a couple of lieutenants as possible successors. He's been running the bank since 2005. That's 16 years. And for the past 10 years, you guys, he's been saying, oh, I'm only 5 years away from retirement. I mean, but now it appears that with this new stock plan, which is sort of starts to vest in 5 years and actually vests over a period of 10 years, it looks like we're in for another 5 years, or JP Morgan shareholders are in for another 5 years of Jamie Dimon. And I should say that the stock responded positively, up about 2% on a day when the market's up about 1%. So you got that beta because of Jamie Dimon.
Investors certainly do seem happy. Andy, you brought up the succession plans. I think now there's a question out there, the two people that have been floated, Marianne Lake and also Jennifer Pipsack, they were just promoted to the heads of JP Morgan's Consumer and Community Bank. There are two people that are viewed as possible successors to Jamie Dimon, but this brings up the question of whether or not two people like that will be sticking around for another 5 and maybe another 10 years. You never know.
100%, Shauna. And I mean, Wall Street has all manner of executives who would be Jamie Dimon's successors, running around, running various institutions. I mean, Charlie Sharp is another, and there's been a bunch of people who've, retired. And, I don't think this is necessarily great news for either of those two executives if they had their eyes on the prize, saying over the next couple of years. And I think you're absolutely right that this raises the real question of whether either one of them will ever get that top job at JP Morgan, which may be fine for them. On the other hand, I would not be surprised, if I may infer from your comment and question, Shauna, that they seek employment somewhere else over the next several years.
Andy Serwer is our editor-in-chief, joining us from an undisclosed location, but I bet they've got a lobster shack not too far away from that location. Andy, good to see you. When we come back, we're going to be talking to the CEO from United Wholesale Mortgage. Did you know it was Mortgage Brokers Day? Did you hug your mortgage broker? Right after this.
United Wholesale Mortgage, they're at the New York Stock Exchange today, ringing the closing bell at the top of the hour. And in case you didn't know, today is National Mortgage Brokers Day. We want to get down to Brian Sozzi, who's on the floor of the stock exchange with the CEO. Brian.
Hey, thanks so much, Shauna. Matt Ishbia, it's good to see you in person for a change.
Yeah, it's so exciting to be here and see you in person. We've been doing a lot of Zoom, so back to normal almost.
Yeah, for sure. So there's a sign out front of the New York Stock Exchange that says findabroker.com. Can you find brokers in this environment?
Yeah, findamortgagebroker.com, and there's a 1-800-BROKERS. There's places to find. The key is mortgage brokers are the best place to get a mortgage, and so we're trying to publicize that, get that out to consumers, educate consumers, and that's one of the big benefits of going public is to try to educate consumers about finding a mortgage broker.
Labor is scarce. How are you finding them?
Well, mortgage brokers are out there in the community, so we're able to find a lot of people, and they've been doing it for years. It's not like their first year, first month. These mortgage brokers are out there finding the best deals for mortgage for consumers, buying a house or refinancing, and so that's where you go. Findamortgagebroker.com to find them.
We've been talking a lot in the Yahoo Finance office on housing. It's not that affordable. It's been a heck of a year and a half, 2 years with housing prices. How has it impacted your business?
It's been great. Business has been great for UWM. We're excited about continuing to grow and continue to build the business with our mortgage brokers. But, with rates really low right now and obviously housing, there's a little shortage on inventory, but people are taking advantage of it. And so we're excited about it. It's been a great first half of the year. We're excited even a better second half.
We're done with bank earnings, but within those bank earnings, lots of focus on net interest margins, kind of weak. How do you make money? Are you making a good amount of money in this low rate environment?
Yeah, absolutely. So, you got a low rate environment, but you know what? The key is, besides making money, is take great care of consumers, take care of the client experience, and money follows. And so we're focused on winning and success, and money follows. Our margins are actually really good. Our profits are good. We're excited about the first half, and like I said, the second half is going to be even better.
What excites you about the second half?
Just, purchase business. Rates went up a little bit, so a lot of companies in the mortgage space only live on the refi. That's not UWM. If you want to live in the refi, we're going to do good, but purchase is really where the strength is, and you're going to see that in our second quarter, third quarter, and beyond, and we're excited about that with our mortgage brokers.
How does a Federal Reserve taper impact your business?
Well, it just impacts rates. So as rates go up, the way I'll tell you is there's one mortgage company you want to really be involved with if rates go up. That's UWM, because we do a lot on purchase. Rates go down. Rates are low right now. 30-year fixed in the twos. A lot of great mortgage companies out there. People can do business. So our business is focused on the long term, not just the short term with low rates. So tapering of the rates by the Fed won't impact us. Actually, I think it will help us from a competitive position, help us become the #1 overall mortgage company.
From your perch, how do you feel? How's the U.S. economy growing? How do you feel?
I feel good about it. I think, obviously COVID was a weird time for everybody, and so seeing how that's evolving right now and seeing people in the world getting back to normal, I think the economy's doing well, and I think it's going to continue to do well through the rest of this year and into 2022.
Last time we talked, you had, I believe, 9,000 employees. How many do you have now? Did you crack the 10K mark?
Yeah, we're just under. We're about 9,300 people. We're all back to work at the office, working hard, helping mortgage brokers grow, helping our consumers. It's a lot of fun. It's exciting. The energy's contagious, and it's glad to have everyone back.
Do you want people back in the office?
Absolutely. We want people back. We're better together. That's why I tell our team we're better together. We serve clients better. We work together better. We're collaborating. We have energy. We have a great campus. We have basketball courts and dry cleaning and arcades, and it's a lot of fun to have everyone back. And so we're excited.
We've talked a number of times throughout the pandemic. This is my first time actually meeting you in person. You have as much energy standing here as you do coming on the other side of a Zoom camera. Why are you so passionate about this business?
Well, I just love it. I love what I do. I love our clients, our mortgage brokers. I think it's the best way for a consumer to get a loan. So I'm really passionate about educating consumers. And I love my 9,000 plus people. We built it together. We're a family, and we're going to continue to build it. We're just getting started.
Well, it's good to finally see you. UWM CEO Matt Ishbia, good to see you.
Thanks for having me.
Shauna, back to you.
All right, thanks so much, Saz. And of course, our thanks to Matt Ishbia as well. Well, coming up next, we're talking all about sleep. The Cincinnati Reds and Seattle Mariners signing a sleep tech deal with Chili Sleep. We're going to talk to the CEO and the co-founder, right after the break.
News on the move. Smoke from the wildfires burning out west traveled cross-continent and blanketed New York City and other parts of the East Coast. The wildfires have caused electric power outages and burned more than 475,000 acres of drought-scorched Oregon. The number one ranked and reigning World Cup champion U.S. women's soccer team lost to Sweden at an Olympic opener. The U.S. has reached the gold medal match in 5 of the 6 Olympic Games since women's soccer became an event. The team came into the match unbeaten in its previous, are you ready for this? Previous 44 games. The last time it lost, January 2019. A different story for the Milwaukee Bucks, which won their first NBA championship in 50 years. The Bucks beat the Phoenix Suns in the final minute of Game 6, 105-98. They also became the first team since Cleveland did it in 2016 to come back from a 2-0 series lead to win the championship. Let's turn our attention to a business that is winning, and that would be the business of sleep tech. Tara Youngblood is Chili Sleep Products CEO and co-founder. It is good to have you here. When we talk about sleep tech, we're talking about a whole new way of looking at mattresses, right? At things like Casper and Purple and Tempur Sealy. And what should we know about choosing these kinds of products?
Yeah, so actually mattresses are a little separate from sleep tech. Sleep tech is often considered like wearables, like sleep tracking, or like a product like ours, which is an intervention. When you think of the overall sleep market, that does include mattresses, and a lot goes into picking how you choose your mattress and how you decide to look at sleep. But we're really focused on that sleep quality and that sleep outcome. So for us, it's less about the 8 hours you spend flat and what you're sleeping on. And it's more about what your day feels like afterwards. How do we remove fatigue? How do we make you feel better? And when we look at our partnerships, like with baseball, they're not at home in their bed. So we have to be able to manage that on travel in a hotel in an unknown circumstance.
Dara, talking about the quality of sleep and what this does, you mentioned the partnerships there with the Cincinnati Reds and also the Seattle Mariners. I guess, what is it that attracts those teams and specifically professional athletes to your brand and to your business?
Yeah, so sleep has been found to be attached to injuries. So when you look at like baseball, some of the statistics coming out on the roster is that one player out of a roster may get injured every single game. And if you can reduce those injuries, the ROI for the teams and the players is significant. From the player perspective, sleep is attached to the longevity of their career and how long they can keep playing and at what level they can play at. So the ROI for both athletes, the science behind them, from the sleep and strength and conditioning coaches to the team owners, is pretty significant if we can reduce that and improve performance.
What did it mean for you guys to win the CES 2021 award-winning product and app?
Yeah, so that was really great. We're a hardware company at our heart, but being able to affect people and how they sleep, having an app that schedules your sleep, we're really all about thermal regulation in the bed. So if you think about when you're in bed, you have your air conditioning or something that may manage the temperature of the room, but we're all about managing the temperature for you in the bed at night. And when you can do that, for our teams, that's affecting jet lag and circadian rhythms and performance. But for the average person, that just helps you sleep better and wake up less fatigued. And back to that quality metric of deep sleep, it really improves numbers like that.
Tara, what's growth been like for your business? And I guess, what are your plans to expand on that growth now going forward?
Yeah, so we took on funding from KKR in December. We've been growing at 20x for the last 4 years. Sleep tech is on a pretty significant trajectory as far as growth. Certain metrics are showing that the market for sleep tech is about 17 billion and headed up to the 40 billion market by 2027. So it's a really fast growing industry. People are finally recognizing that sleep is part of that three-legged stool of diet and fitness. And so now people are really investing in their sleep because it affects every bit of mental health. It affects cognitive load, performance. Lack of deep sleep has been shown to affect Alzheimer outcome, memory loss as you get older. Every disease of the elderly is attached to some form of lack of deep sleep. So we're seeing metrics where people are wanting to invest in feeling healthier longer. It's really about health span, not just lifespan.
Given the data that you get to look at, I'm just curious, can you help settle an age-old argument that goes back probably to the dawn of humanity? Do we prefer to sleep cold or warm? Because I believe every married couple, every couple period has had this fight.
Yeah, so actually it's a bit of both. Your body was meant to live outside when it comes to sleep. And when you think about it getting cooler at night, your circadian rhythm, your core body temperature does want to drop at night. But for some of us, myself included, I like to warm up and then fall asleep. But once I'm asleep, I really do need to be cooler. So it's kind of a bit of both. My husband and co-founder likes to be cold all the time, so he'd sleep on a bed of ice, hence why we invented something so he can sleep super cold all the time.
Tara, going forward, I guess what's next for your business?
It's really to expand into the technology space. When we think about sleep, the hardware helps us manage your sleep at night, but it really is about having a relationship with the customer, understanding their rituals around sleep, what is happening in their day that will affect their night. When we look at that relationship with the baseball players, understanding their schedule, where they're going to be, the flights, when they have games, when they warm up, all of those metrics come into play on how we can suggest a schedule for sleep and what temperature, when and where and how.
All the best to you, Tara Youngblood, Chili Sleep Products CEO and co-founder. When we come back, we're going to be talking crypto with Ollie Leach.
See Bitcoin getting a bit of a boost today. It's up just around 6%. Now, this comes after Elon Musk and Jack Dorsey. They spoke on a panel with ARK Invest's Kathy Wood a little bit earlier this afternoon. Now, we want to play one quick soundbite for you. Now, this is the answer that Elon Musk gave when he was asked what crypto investments he owns. Let's take a listen.
I'm not an investor. The only publicly traded stock I own is Tesla. And the only significant thing I own outside of Tesla is my SpaceX stock that could help create both companies. So, but apart from that, I do own Bitcoin, and Tesla owns Bitcoin, SpaceX owns Bitcoin, and then I do personally own a bit of Ethereum and Dogecoin, of course.
We want to bring in Ali Leach. He's CoinDesk Learn editor. And Ali, we saw the price of Ether, and it actually hit its highs of the day right after those comments from Elon Musk. Dogecoin also moving to the upside as a result of this. I guess, what's your reaction just in terms of the fact that investors get so excited that someone like Elon Musk is still buying some of these cryptos?
Yeah, definitely. It says a lot about the crypto market. I mean, for the last couple of months, a lot of people, especially on crypto Twitter, have been particularly angry at Elon Musk, saying that he pump and dumps a lot of coins. And now, obviously, saying that he's invested in Ethereum as well as obviously Bitcoin and Doge, and the price has gone up. So he clearly has a hold still of speculating traders, and people are still hanging on his every word and looking to get in on whatever he's getting in on.
But what about the words of crypto founders? I mean, there's Dogecoin, or Doggy Coin, as some of us prefer to call it. The founder there saying crypto, and he classified the entire asset class as something to stay away from, one of the co-founders. And then you get the co-founder, I believe, from Ethereum, said something similar. If you're a believer in crypto, what are you supposed to believe when these two individuals are saying, danger Will Robinson?
So, I mean, Jackson Palmer, the co-founder of Dogecoin, he'd actually left in 2015 at a time when the market was very much driven by a lot of kind of sort of scammy projects. There was a huge amount of projects joining the market every single day. A lot of these had no merit. They were promising the world and scamming a lot of their investors. And this is what he kind of moved himself away from. He said, I don't want to be a part of this anymore. It's not about the innovation of the tech. It's more about making a quick buck and sort of defrauding people. So he left for that reason. Vitalik Buterin, as far as I'm aware, I think he's still quite positive on the space. He's obviously a huge proponent in Ethereum still, and is looking to drive the space as far forward as it can go, and especially through smart contracts, DeFi, and everything like that. He still plays an important role.
Ali, another thing that stuck out to me during this panel was when Musk asked Jack Dorsey whether or not he would consider whether Twitter, I should say, would accept crypto for advertisers, for paying for ads on the site. And Dorsey, when in his answer, he seemed to indicate that he would be open to this. When you see that type of talk out there, the fact that crypto would go more mainstream, I guess, how big of a boost or how big of an opportunity could this be for the space?
Yeah, absolutely massive. And I think, the conversation in general was so important for the industry at this time, when there's so much negativity and focus on things like, crypto and ransomware and the threat of stablecoins and money laundering. It's come at a hugely important time. And absolutely great. It's great to see people like Dorsey and Elon looking at new ways to innovate in the space. I mean, it's great to even hear from Elon that he wants Bitcoin to succeed. He said that himself. He's like, people saying about pumping and dumping. He said, I actually own Bitcoin. Obviously, Tesla and now SpaceX does as well. And he says, it would actually hamstring me to sort of dump it. He wants it to do well. So incredibly important for the space. And it's exciting to hear their vision and where they wanted to go as well.
Ali, who are the voices? Because we pay so much attention to the same voices. Who are the voices, because you folk at CoinDesk are writing about this all the time, that we should pay attention to in addition to the old and getting older crypto voices?
So who should we be listening to, sorry?
Yes.
Okay.
On the likes of an Elon Musk. I mean, if Elon Musk can move markets, but Elon Musk in some ways is starting, I don't want to say aging out, but there have to be others who have insight besides the same. We keep going back to the same, round up the usual suspect.
Elon, he's at the forefront of a lot of technical innovation. A lot of people look to him in terms of people that are up and coming. I'm drawing a bit of a blank, to be honest. There's a lot of established people in the industry that we look to. Put me on the spot.
Are we okay? So are we susceptible that we keep going back to the usual suspects?
Yeah, I mean, the space, there's been people over the last 10 years have really fought to get to the top, and they're the people that have really stuck around. And I think that says a lot about who they are and their belief in this in the space. And a lot of people have come and gone in that time, but the core sort of 20, 30 people that a lot of people know, the common names in the crypto space, those are the people that stuck around. I think that's what gives them that sort of credence and why so many people follow them, because they understand that they're in this for the long run. They really see the potential in it. And yeah, that's why I think so.
Ali, another comment that Elon Musk made was that Tesla would start accepting Bitcoin once Bitcoin moves to a more renewable energy, and that's something that he has said in the past. Obviously, we saw the drop of Bitcoin once Tesla made the announcement, once Elon Musk made the announcement that they would no longer accept it as a result of how it was being mined. What's the likely timeline? I guess how long do you expect that to take in order to achieve what Tesla is looking for, and then therefore they would accept Bitcoin again?
In terms of timeline and how quickly things can get moving on the energy front in terms of mining, I think there's such a push right now to make Bitcoin mining and other proof of works mining cryptocurrencies more energy efficient. Jack Dorsey mentioned the Great American Mining Company, just one example of a company that is looking to use wasted energy and repurpose that as a means of fueling crypto mining. So yeah, it could happen very soon. It really depends on how quickly these companies can kind of get up to speed with everything and just make a name for themselves.
And when you look at these companies and the mining that they've got to do, is there any concern that other countries might start to take the lead that China has started to crack down on? Did my computer freeze? Did I lose this?
Seems like we might have lost. Yeah, Ali, I think we're losing our connection with you, so we'll leave it there. Thanks as always for joining us, Ali Leach, CoinDesk's Learn editor. We are going to take a quick break. On the other side, Novartis out with its earnings report. We will talk to the CEO right after the break.
So we were talking about pharmaceutical earnings today, especially with Johnson & Johnson, but Novartis was out too and had a good second quarter. Their revenue beating $12.95 billion. The street was expecting $12.4 billion. Earnings per share, the adjusted EPS came in at $1.66. Let's bring in the person who can help us understand what drove the strong quarter best, and that would be Novartis CEO Vas Narasimhan. Good to have you here. And what did drive it? Because we have focused so greatly on the huge names that are being directly involved with COVID vaccine. But there are other things that are going on in the pharmaceutical space. So what helped you folk get to this strong report?
Yeah, thanks for having me on board today. So when you look at quarter two, we saw a resurgence in demand in healthcare systems. We saw patients returning to the physicians that they had and visits that they had been putting off for much of the pandemic. So across the therapeutic areas that we play in, and we're very broad-based, we play in 12 different therapeutic areas across 5 different technology platforms. We saw good demand, and that demand then translated into the results you see, particularly in areas like immunology, cardiovascular disease, as well as in rare diseases and many of our oncology assets as well. Now, I would say that in some therapeutic areas like breast cancer, lung cancer, certain parts of cardiovascular disease, visits are still well below what they were pre-pandemic. But we feel optimistic now that things are going to get back to normal over the coming quarters, and if the trend continues, even in the face of the Delta variant starting to impact life a little bit more.
Yeah, Vas, let's talk a little bit more about that, because there's so much uncertainty now in recent days when we see the numbers, the rapid spread of the Delta variant. I guess, how are you now incorporating that into your outlook? Because it could potentially delay, I guess, some of the bounce back that you had been seeing in your business.
Yeah, when you look at it, the Delta variant to date has not led to significant increases in hospitalizations, and at least what we see in the major markets that we operate in, we haven't seen the same kind of behaviors from hospitals, doctors' offices to ask patients to put off patient visits. Patients are being encouraged to come back in, get the diagnosis they need, get the medicines they need, get the, in the case of certain cancer therapies, inpatient stays that they need. So we're confident that's going to continue. And one of the reasons for that is there's increasing recognition amongst health ministers, healthcare leaders in the US, that we don't want to create what we call a syndemic that we've already seen over the past year, where putting off visits leads to worse outcomes in cancer and cardiovascular disease. We saw earlier today, there's been a decline in life expectancy in the US, partially from primarily from COVID, but no doubt also from some of the impacts that COVID's had on other therapeutic areas. So we're hopeful that given that, there'll be a focus on maintaining healthcare system utilization across the world.
In the report, your oncology business unit sales grew 7%, and in a conversation with another pharmaceutical company, their R&D they're ramping up dramatically. Are you also, now that we seem to be emerging from the immediate, and you've talked about, people are not delaying perhaps, is there going to be a renewed emphasis to grow perhaps that part of your portfolio?
When you look at right now, there's been an amazing renaissance in oncology therapeutics. And recently, the American Society for Cancer has put out a report showing the cancer death rates have fallen in most types of cancer, though not all types of cancer. We are one of the leading investors in cancer R&D in the world. It makes up around 45% of our total R&D spend. We're the third largest oncology company in the world. So yes, we're continuing to invest. But one of the things we're working on is trying to invest in new technology areas. Traditional drugs, of course, biologics, yes, but one of the things we recently released was really pioneering data in an area called radioligand therapy to treat prostate cancer, also to treat another type of cancer called neuroendocrine tumors. We really are the pioneer in this space. And we're hopeful that will allow us to address many other solid tumor types. The key right now in cancer is to find new ways of attacking cancer. And from a business standpoint, finding areas where you can create a sustainable differentiation. Given that biotech is entering into cancer in a big way, other large companies also investing more and more in the cancer space.
Well, so let's talk about the Biden administration, some of the initiatives that we've seen over the past 6 months. I guess in just the last couple of weeks, we saw the Biden administration taking aim at drug pricing positions, President Biden signing an executive order. I guess, what's the impact there to your business, and how do you see the Biden administration's policies affecting your business going forward?
It's too soon to say exactly how the recent executive order gets translated into policy. There's also various legislative initiatives currently ongoing. I think what's most important to note is the industry has already offered to come together to offer savings to the healthcare system with the stipulation that this really goes to patients at the pharmacy counter. We actually reduce the cost for patients on the ground, and we don't use savings from our industry to fund areas completely unrelated to prescription medicines. That's, I think, a key focus area from us. One thing we're very concerned about is there's increasing efforts and noise around using prescription benefits from our industry to fund things completely unrelated. And what we would want to do is provide these savings and then not have people in the pharmacy be able to afford their medicines even better. So that's the goal. There's very sensible policies we could make to reform Medicare Part D, Medicare Part B, other elements of the healthcare system. We're all in to look for solutions, but it's critical that we actually ensure patients benefit at the end of the day.
Voss, I'm going to give you a chance to respond to an analyst. I'm not going to say the name, but they took a shot at the company saying that you did have better than expected results, but the failure to upgrade guidance, quote, indicates that the pandemic situation has not yet returned fully to pre-pandemic levels. What do you want to say to that analyst about the not returning to the guidance?
When we looked at how to approach the back half of this year, we wanted to be prudent. And when we looked at the situation, we do have areas in oncology, as I mentioned, that continue to be impacted by COVID. We have a generics business, Sandoz, which is the second largest generics business in the world. It had an impact in Q1, less of an impact in Q2. We're hopeful it returns back to normal in Q3 and Q4. On the call earlier today, we did guide that if things continue on their current path, we could be at the high end of the guidance range. But we want to be prudent. One thing we've learned through the COVID experience is you can't be entirely sure how these things will play out. We want to be sure that we're providing investors a fair perspective. Now, of course, our goal is to drive our business as hard as we can to continue to drive dynamic growth, not only for the back half of this year, but one of the things we've highlighted is all the way out to 2025, our aspirations to be over a $60 billion revenue company by that time.
Voss Narasimhan, thanks so much for taking the time to join us, CEO of Novartis. Well, we're 6 months into the Biden administration, and one of the priorities for President Biden has been vaccinations. And as it stands right now, 59% of the U.S. population 18 years of age and older are now fully vaccinated. I spoke earlier with Valerie Jarrett. She's a former senior advisor to President Barack Obama, and asked her what needs to be done in order to get that number higher here, especially over the next couple of months that seem to be so critical. Let's take a listen to what she had to say.
What we have to do is reach people where they are with trusted influencers. One of the organizations I chair the board of is Civic Nation, and it has an initiative called Made to Save, where we are using those people who are influential in their local communities where we are seeing vaccine hesitancy to try to convince them to do so. And we're doing this in partnership with the Biden administration. I think President Biden recognizes that he can't be the only one to carry this message. It has to be carried all across the country. We have to go into those communities that are being most hesitant and help convince them the only way that we're going to tackle this virus is that we have more and more Americans getting vaccinated. And the variant adds a whole new dimension. I was just looking at the news this morning, and we're seeing like 99% of the people who are being hospitalized are people who have not had the vaccine. But we are worried that as we see these populations continue to circulate with one another, even those who have the vaccine are being put at risk. Certainly the vaccine protects you in an enormous way. But with the variant exploding, we need to make sure that every American gets vaccinated. And so it isn't just up to the administration or organizations such as Civic Nation. Businesses have to be communicating. People in local communities have to use their voices. Even anchors on Fox News yesterday were beginning to say we need the vaccine to be taken. I wish that had happened since day one. Just imagine if when the vaccine first became available, every single influential person in America spoke in one voice about how to do this, we would have tackled it here in this country.
And speaking of that, I mean, the fact that it's become such an issue just on both sides of the aisle, and it's become so polarized, I think has taken a lot of people by surprise over the past year and a half or so. But when you take a look at where we stand today, compared to where we were 6 months ago. I guess just talk to us about the progress, and has it reached what you were hoping that you would see within the first 6 months of the Biden administration?
I think the progress has been extraordinary. I think President Biden and his team have come together with an evidence, science-based approach. The logistics that were a nightmare 6 months ago have been worked out and streamlined, and now we have vaccines available. In fact, we've seen in parts of the country where vaccines had to be thrown away because they weren't used. So there is not a problem getting the vaccine. The challenge here is to convince Americans who are reluctant to take the vaccine to do so. And that's why we have to look for those influencers. And these don't necessarily have to be people like the President of the United States. A local pastor in a church. I was on a church on the west side of Chicago with Roz Brewer, the CEO of Walgreens, several months ago, and the pastor opened up the doors of his church, and the Walgreens pharmacist went into that church and vaccinated people in a place where they felt comfortable. We have to see that happening all over the country. And again, every employer could open up their doors, could bring in people and talk to them about the importance of doing this. We can't be reluctant to talk about this essential fact, scientific-based vaccine that we have available. Everyone should be using their voices to communicate about its effectiveness, its safeness, and the importance of taking the vaccine.
Valerie, I want to switch gears here just a bit and talk about police reform. It's a priority for President Biden, and you served as President Obama's point person in the White House on criminal justice reform. President Biden met with mayors and a few police chiefs from some of the largest cities across the nation just a few days ago, talking about what needs to be done in order to fight some of the higher crime rates that we're seeing nationwide. When it comes to investing in police departments and then also investing in community-based solutions, I guess, what more do you think needs to be done at the federal level?
Well, I do think that the federal government, the Congress, should pass a law that gives us the ability to set some national standards. We should have a national data bank, for example, for people who have been in law enforcement, who've been bad actors, so that they can't go from one jurisdiction to another. We should be sharing information. We should be prohibiting chokeholds, for example, or no-knock warrants. The federal government is there to provide those broad parameters of what we should do to have a fair and just system of policing in our country. But then there's also a responsibility at the local level, which is why it was so great to see President Biden meeting with mayors, because that's where law enforcement happens. That's where decisions are made, where we need more training, we need investment, not just in policing, but social service providers who can go out when there's a crisis where the police are not equipped to handle the situation. We should be looking at the use of force. Last summer, President Obama called on our nation's mayors to look at the use of force, and over 300 mayors took him up on that challenge and are looking at new best practices for how police can better serve the community. So there are lots of ways in which we can all be helpful. Yes, the federal government should pass legislation. And yes, we should have local law enforcement working together with the community to figure out a safer way of providing fair policing, safe policing, which will protect not only our communities, but also those in law enforcement who are doing a good job.
Valerie, I know this might be a tough question because there's so many important issues that the Biden administration is tackling right now and needs to focus on over the next several months. But if you could pick one top priority for the Biden administration over the next 6 months, what would that be?
Well, I think this is what I learned in 8 years in working in the White House, is that you can't be a singly focused administration. And what's great about President Biden is that his team is organized to work down multiple fronts. We can't just get vaccines in arms. We have to make sure that our economy is rebuilding. We can't just focus on the economy. We have to make sure that every American has access to affordable health care. We can't just say that we need to grow our businesses if our workers are not trained for the businesses and the jobs of the future. And so I think what I respect about this administration is their ability to multitask, to move forward on multiple fronts at once in an organized, disciplined, evidence-based way that believes in science. And look what's happening around the country with wildfires. We can't ignore our planet. So while we're doing everything else, we have to focus on climate change. We have to focus on foreign policy. So I'm not answering your question, I suppose, by saying there's a silver bullet that's most important. What I'm saying is that we need a government that understands the importance of focusing on multiple issues at one time and moving them all forward. And I think that's what President Biden and his administration are doing.
Our thanks to Valerie Jarrett, former senior advisor to President Obama. And you can check out the full interview on yahoofinance.com. We'll be right back. Let's turn our focus to tomorrow because we've got a couple of important things that you should keep your eye on. Adam, what are you watching?
Most important for me, there are two earnings that we've got. We've also got the CEOs from the companies. First, we got Lance Fritz from Union Pacific. If you want to know what's going on in this economy, talk to the people who ship everything, Union Pacific, everything from the input to make something to the finished product. Then we've also got Gary Kelly's going to join us on Yahoo Finance Live. He is the CEO of Southwest. We're going to talk to him about the transition next year when Bob Jordan from the airline takes over as CEO. Shauna?
Adam, I'll be watching a couple earnings as well. We'll hear from Snap, from Twitter, and from Intel. All three of those will be after the bell. So we, of course, will bring those to you as soon as they break. Certainly important companies to keep in mind here going forward. And then also another reading on housing tomorrow. We will be getting pending home sales. We saw an unexpected jump in the month of May where we saw an 8% jump. It was actually the biggest increase that we've seen in 11 months. So lots of questions about whether or not that momentum will be sustained, and we'll be getting that reading out tomorrow morning. Let's take one more quick look at how the markets closed today before we let you go. The Dow closing up 286 points, S&P up just around 0.8%, and the NASDAQ up 0.9%. That does it for us today. Thanks so much for joining. We'll see you back here again tomorrow. Have a good night.